Hey everybody, welcome to Fool24. All of our Motley Fool members watching behind the Motley Fool member paywall. It's great to see you again. For everybody now joining us on YouTube via our YouTube live stream, it's awesome to have you here as well. I'm Motley Fool Foolish contributor Jason Hall, joined by my longtime colleague and friend, also a contributor, a little more nomadic than me, Tyler Crowe. Hey Tyler.
How you doing, Jason? I have to admit, right out the gate here, got a little bit of a sore throat, so I'm going to be nursing it, but it's okay because you know what? Today is the Brookfield day. This is your time to shine because this is the Brookfield Hour, built custom for Jason Hall.
Yeah, well, Brookfield Corporation and its subsidiary businesses are built custom for creating market-beating returns. So that's okay. It's a great thing for me to talk about. And Tyler, don't kid yourself. You're a fan. You're a shareholder as well. You'll be weighing in here along the way. So yeah, we're going to be doing a good bit of presenting and talking about the complexity that is the Brookfield group of businesses and all of the various publicly traded parts of it that make it very complex. We're going to try and help explain some of that. We're also going to talk about the risks and the yellow flags out there and things that investors need to be aware of that come with a complex business as well. But we also want to answer your questions. Fool24 is built around answering questions for Motley Fool members. And when we're doing the YouTube stream as well from YouTubers who are watching, we want to answer your questions too. You get us those questions by going to slido.com. The event code is Fool24. We use Slido because we're taking questions from people watching on two different streams. So we want to be able to get all those questions together. Again, slido.com. The event code is Fool24. I want to remind everybody watching too, we're going to answer your question. We're going to try to answer your question, but we're not giving you your answer. This is not a forum for providing anyone. We're not providing anyone with individual or personalized investing advice. We love to share our expertise and opinions, but remember, we're not advising anybody specifically what to do. All right, Tyler, any thoughts before we wade into the Brookfield businesses?
Well, I do have to confess, normally when, I sit at home and watch Fool24 and watch when Jason is doing it, I normally play a little drinking game. Any single time that Jason, mentions Brookfield, it makes it a little bit more fun and entertaining. But for me and anybody else who follows a similar game that I do, I would suspend that game for this 1 hour because it is all Brookfield all the time. And if any mentions of that, if we do that, if we actually were to play that game,
right? You won't make it 30.
We would all have a very, very good long hour together. But so suspending those rules, I'm excited to get into this because, I have vacillated many times over about Brookfield and its various entities. It depends basically what side of the bed I wake up in the morning, whether I think that Brookfield is an amazing capital allocator and compounding business. And then I wake up the next morning and go, man, this thing's really complex and hard to understand. And what if I don't know what the heck is actually going on here? And so I think this will be a good hour to discuss, how Brookfield makes its money, all the various entities that make the money for it and how it all kind of ties together. Because, it wasn't, I think was it this week or was it last week where the Financial Times, a big newspaper, did a pretty large spread on Brookfield and kind of started asking a lot of those pointed questions of like, guys, this is really complex. And sometimes they use the term circular cash accounting, but basically the idea of sometimes some assets that are held in one place are sold to the other, and they both happen to be Brookfield entities. So I wouldn't call it accusatorial, but a lot of hey, what's going on here sort of attitude for it. And I think that's a good jumping off point.
I think it is a great jumping off point, and it's asking important and necessary questions is the way that I think about it. Because a lot of what I'm going to talk about as I go through this, it may have a little bit of the perception of being a Brookfield apologist, and I don't want that to be the overarching feel at all. Because one of the foundational parts of the way that I invest is to be constantly poking holes in my thesis. We can always find reasons why we're going to be right, why the bull thesis we put together is going to be right. That confirmation bias is value destroying, and it will destroy your wealth over time. And it's far more valuable to spend time poking holes in your thesis and trying to figure out what you're missing and what you could be wrong about. And then when you find those things, act appropriately and decisively. Before we do jump into the complexity, though, I want to bring up a screen share here. Adam, if you can release that. This purple line, this is Brookfield Corporation. This is the shares that trade on the Toronto Stock Exchange. I've chosen those because this goes back to the IPO that happened back in the mid-1990s. The New York Stock Exchange traded Brookfield, ticker BN, hasn't been traded as long. It went public in the early 2000s. So to look at the full track record of the business, this is just the stock price gains. Roughly 5,600% in gains, compared to about 2,000% in gains for the S&P 500 over that same period. To annualize that, it's 14% annualized versus just over 10.5% for the S&P over that same period. The S&P, that's total returns. This is just the stock price. So I'm teasing you here. Total returns for a Brookfield Corporation over that period, 16.5% annualized returns. That is remarkable, Tyler. We're talking 10,000% in returns. That's 100 bagger, right? That is. Go ahead, Tyler.
Yeah, that is that. There's nothing better than a stock chart that makes the S&P look like a relatively tame and flat line.
Right. And the bottom line is that this is massively value accretive for the average person. That blue line, that's the most accessible, simplest way to create wealth that most people have access to. And to do 5 times better over the past 3 decades and change has been remarkable. And I'm going to put Brookfield Corporation, the New York Stock Exchange traded ticker on here, and I'm going to pull off the Toronto one just so the chart's not quite so busy. And again, we see pretty remarkable results. So this goes back in the early 2000s. Still 14% annualized returns in total returns, 40%, roughly 40% better than the market over that period of time. Just a remarkable run. So when you find businesses like this that demonstrate the ability to compound wealth, they get really interesting to me and worth taking the time to explore. Okay, so here's what I want to do. I'm going to jump into some slides. Tyler, I'm going to ask you to be actively monitoring our Slido. So again, anybody that didn't join right at the top of the hour, remember, if you have questions along the way about the Brookfield entities or otherwise, please ask us those questions at slido.com. The event code is Fool24. And remember, we're not giving anybody individual or personalized investing advice. So just remember that when we give our answers. But what I'm going to do, and interrupt me as you see fit here, I'm going to jump into a few things that kind of break down what the Brookfield businesses are. So I'm going to do this first. So this is where things feel like they're extremely complex, and they are complex. The waterfall of different publicly traded Brookfield businesses, and I think I got all of them. Brookfield Corporation, the parent company, Brookfield Asset Management, which it spun out over a year ago, and it is the pure play asset management business that generates its income off of management fees and performance fees on capital that is invested with it from high net wealth investors, pensions, large endowments, other large wealth entities that are looking to invest in non-correlated alternative assets to stocks and bonds. And that's what Brookfield Asset Management does. And then below that, all of these businesses, these are the publicly traded operating businesses. Because we'll see when we get into some of the slides from Brookfield's Investor Day presentation, that was back in the last summer. So it's a little bit dated in terms of some of the the returns numbers that you might see on some of the slides. But directionally, it gives us good information about the structure of the business. So in these in the asset management business, there are a number of different funds that are focused on specific cohorts of investment types. And what these different operating entities do is partly just that. So, for example, if there's the Energy Transition Fund and Brookfield sees an asset to acquire that's in energy transition, whether it's going back to the legacy business and the hydroelectric businesses in Latin America that they acquired back in the late aughts or early 2010s, or it's a solar farm or energy transmission lines, those sorts of things, they need somebody to operate. If they acquire the assets, they need somebody to manage those assets. And Brookfield Renewable Partners exists for that. Also, there's other tickers I'm going to mention later in this that expands the addressable pool of investors to give us more options depending on where we're going to invest on the different kind of accounts that we can invest in. So Brookfield Renewable Partners is the operating entity for energy largely, primarily renewable as it's there in the name, hydroelectric, wind, solar, largely utility scale, but they do have some commercial large distributed solar, like on top of parking decks and large commercial buildings and things like that they also own. And then you have infrastructure, maybe the business that's evolved the most. They used to own timber assets and toll roads and things like that. And the core of that business now is largely things like data and telecommunications and some energy transmission that they also well. But again, it's the infrastructure that drives the modern economy. The operating business is for that. Brookfield Business Partners, Tyler, this is their private equity business. So if they see an opportunity to acquire a manufacturer, another type of business that doesn't fit in one of these other buckets, Brookfield Business is the private equity unit that handles the acquisition and management of those assets. And typically Brookfield Business Partners is a pretty typical private equity approach. And it's kind of built into the core ethos of Brookfield, which is you want to be value buyers, you want to be opportunistic. And then with the private equity business, one of the things they do is look for those deeply discounted opportunities for businesses that they can acquire, improve, and then sell. The idea is to recycle the capital from those over time. Sometimes they sell those assets to another Brookfield subsidiary. For example, you got to remind me the name. My brain's doing that thing. The nuclear business that's Brookfield. Westinghouse, right? They acquired it out of bankruptcy. It's like the textbook case of the kind of thing that they do. They acquired it out of bankruptcy in Brookfield Business Partners with co-investment through the asset management business and from Brookfield Corporation. Brookfield Business Partners helped stabilize that business, recapitalize it, find more partners, and then they spun it out. Cameco, the large uranium producer, and Brookfield Renewable co-own it in a joint venture, roughly 50-50, where, again, Brookfield Renewable is the managing partner, but part of it is also owned by other Brookfield affiliates. So that's where the complexity starts to get in. But again, these businesses exist as the operating units for these different lines. Then you have Brookfield Wealth Solutions. Go ahead, Tyler.
Well, I was going to see if I could try to, because it does, for somebody who's never seen Brookfield before, and you see like 7 different listed entities for all of it, it can feel a little overwhelming. So I was going to see if I can maybe just try to simplify just a little bit. So basically, if you start at the bottom, there's this giant pile of assets. It's got real estate in it. It's got infrastructure. It's got renewable energy stuff. It's got
kind of looks like this, right?
Yep. And lots of real estate, malls, office towers in downtown Manhattan. Just think of it as assets, like hard assets that they don't own equity in, they own them outright. And then what they do is they carve up the ownership of those assets among these various entities, both publicly traded and privately traded. So like the renewable stuff, it will have part of that asset will be partially owned by the publicly traded entity, but then there's also some private vehicles that own it. It's like they're the Brookfield funds that are typically institutional investors like pension funds and in major insurance companies and things like that.
This
They
shows a little bit
invest
of
in those private
this
funds.
shows a little of where that capital comes from. So, they have $1 trillion in assets under management at Brookfield Asset Management. The float from the insurance business, that's the wealth management business, is insurance largely. So the insurance float, and then the perpetual capital that's at Brookfield Corporation,
Yep.
right?
And so though all those entities, the private and the public, are used to raise funds to acquire the assets. And then Brookfield Asset Management is the manager of all of these entities and like distribution of funds, capital allocation, underwriting, all that stuff. And they get a management fee from both the public and the private entities. And then so you get that flow that all flows up into Brookfield Asset Management, and then Brookfield Corporation on top of Brookfield Asset Management is kind of the owner, the overseer, who on top of it. So you have like assets, operating subsidiaries, a manager of those subsidiaries, both public and private, and then the corporate entity on top of it. So I hope that maybe a little simplifies it a little bit, because it can get a little overwhelming.
Yeah, no, there's no doubt about that. I just want to hit these two again. So again, Brookfield Wealth Solutions, they recently renamed as it has expanded, but it's primarily insurance and reinsurance, but also some of those businesses do other things, some investment products as well. Hence renaming the business. And then Oaktree Specialty Lending, Brookfield owns around 2/3 of it, maybe 3/4 of it. So of course, Oaktree is one of the great business successes in corporate lending, in a very, very important specific niche. And that is, they're almost, Tyler, you could say they're kind of the payday lender in corporate finance, where if you need money quickly, they can get you money very quickly. And the terms are generally very favorable for Oaktree, to make sure that even if you are a business that has risk, Oaktree's capital is more protected, but also giving these companies a lifeline and something that they can access and tap to continue to move through a tough period that they've gotten into, without necessarily, just taking the business away from shareholders, for example, if it's a publicly traded business. But it's an exceptionally well-run lender. But the key is, as we were talking about, these large pools of money, who else wants access to the results of those sorts of businesses? Institutional investors, high net wealth, private investors, public investors, the public markets for all of these companies. That's a big reason that these entities exist as standalone publicly traded companies, because there's appetite from investors to own these companies. And it's another way to source capital to help fund those deals. And it also creates a lot of alignment across all of the different entities when everybody has some skin in the game to see the assets produce. And you're not just aligned with making money on your 2 and 20. The assets have to work. They have to be profitable. The investments have to deliver, because the parent company all the way down is counting on that because of a stake that they have either directly in the assets, directly in the subsidiaries, or in a lot of cases, both, that make it really, really important that it's successful.
Yep. So and this is a time, because we were just talking about complexity, and it kind of gets at the crux of one of the most challenging parts about Brookfield. And it's a question that Cinta put in. It says, Brookfield has been accused of using complex internal transactions. How can investors trust that Brookfield's reported financial health and dividends are valid? And this is kind of the crux of what we were talking about at the beginning with this article from Financial Times. There has been other short reports. There have been lots of other critical pieces of Brookfield that very much follow this lane in the idea of complex internal transactions. Because of those assets that we were talking about, they have what they call core assets, permanent capital things, like the assets they bought at good rates of return. They plan on holding them for a very long time because they're incredible value. Then they'll likely appreciate in value over time. Thinking things like, I think it owns like the shopping center at Canary Wharf in London,
Right.
and some like prestige office buildings in towers in Manhattan. These are what they call their permanent assets. So things they think they're going to hold on for a very, very long time. Then they also have kind of this like development turnover. Let's tune this business up. We're going to try to, we'll acquire it. It probably doesn't look great now. We're going to tune it up. And then, either we're going to sell it because we can think we can get a really good deal, or sometimes some of those businesses that they tune up, they will take from their tune-up funds, and they'll sell it to one of their core funds.
Right.
As like
Right.
hey, we got this thing going really well. Maybe the market to sell it, like, maybe price, we tuned up this office building, for example, and on its cash flow alone, it looks pretty attractive. But the market rate for that particular asset is on the market today, because of higher interest rates or whatever you want to be, it doesn't look as attractive. So they will transfer it or move it, or make a sale transaction to one of its permanent capital funds because the underwriting on it is relatively good. And this, when you say it like that, it's kind of makes sense, but also you can see where that can look, I don't want to say shady is too extreme of a word, but a
Yeah.
little fuzzy, right? Because you do
Right.
have to wonder, like, well, if I'm in one of those permanent capital entities, how am I absolutely sure that what they sold from their, tune-up side of their business is like the going rate? And that's been kind of the crux of a lot of this internal transaction stuff. And one of the things that they mentioned in the Financial Times article, and they did give justice to Brookfield in that sense, is like, well, based on the prices that most of these transactions have occurred recently, they have been at market or ever so slightly above market rates. So it's not like they're, they're selling things at a huge premium to their permanent capital vehicles, and like you and I, who own like Brookfield Infrastructure or Brookfield Renewable, are paying out the nose and for these
Right. And
assets.
or like a couple that have been highlighted specifically is because a lot of Brookfield Corporation's permanent capital is in real estate, because one of the things they did was they rolled up the publicly traded real estate entity a few years ago because of the commercial real estate crisis that we went through. And that was basically, they had to salvage the business. And that was the move that was made. And they've kept it private as part of Brookfield Corporation, even though it's a separate entity. It's a wholly owned subsidiary, right? So it's its own standalone business unit, but within wholly owned by Brookfield Corporation. And it sold some real estate assets to the insurance business. And it wasn't an accusation, but kind of what was almost intimated was the question of, are the real estate assets that are being sold generating excess realized carried interest for Brookfield Corporation, and now these insurance businesses that are buying them as income generating assets eventually going to take a haircut, right? That was kind of the thing that was sort of hinted around with that. So they're artificially propping up the carried interest, which carries over to what they say distributable earnings is, and I directionally agree, as the best proxy for earnings per share for that, because of the complexity of the business. So that's the biggest thing that kind of gets called out is this kind of a shell game where you're moving assets around to create fake profits, right? I think that's one of the things that is cautioned investors about. And I have a couple of answers to that. And again, this is where Jason maybe starts to sound like an apologist a little bit. And I don't want that to be the case, because with complexity becomes more risk, right? There's no doubt about that whatsoever. The way that I think about it is, when I think about publicly traded companies where we see the sorts of behavior that is egregious absolutely egregious, it's where there are related party transactions with entities that are controlled by insiders of a particular business. And those closely held entities are almost always private. That makes things a lot more opaque, and creates situations where, because of the way incentives work and the way humans are driven by incentives, the public company may be giving up some of its best profits by having agreements with companies that are owned by the controlling shareholder or the CEO of these businesses, where you're stripping out the profit from the public company, and the outsized profit is now going to the privately held businesses that are owned by the founder or the CEO or whatever that company. I mean, we've seen a lot of it, like in some of these dry shipping companies and offshore maritime businesses, where it gets absolutely egregious. My pushback on that with Brookfield is when you have so many of these entities that are publicly traded and are filing audited financials, it makes it, you're adding more layers of complexity to try to hide that stuff, that if you were trying to do that sort of thing, you don't have these as separate publicly traded subsidiaries. So that's my biggest pushback on that, is that yes, while it's complex, you're making it harder when you have auditors looking at these different entities. And the argument there is, well, it's all the same auditors who are all being paid very well to audit these businesses. So they want to keep the money coming in too, but there's always counter incentives that are at play with that sort of thing. And I think, again, we're talking about, decades of success that makes it harder to hide doing those sorts of things over the long term, particularly with businesses like this, where so much of the return, and this is why I highlighted it at the very beginning, Tyler, so much of the return is money you're giving to shareholders. You're taking that money out of the Brookfield ecosystem that you no longer have the capacity to be able to use to create any sort of false or artificially elevated results, because you're giving it to people that are outside of the business. So that's a little bit of my pushback with that. You're muted. You and that magic mute button on your microphone.
Magic mute button was touched, but we're back. So I want to continue with this complexity issue, because it is something that I have thought about a lot too. And obviously there's a lot of questions of it, but there's one here I can actually address, and I think will help clarify things a little bit. So 19 minutes ago, Oakville dude asked or said, I noticed that BEPC, which is Brookfield Renewable Corporation, this is one of the publicly traded entities. It has a corporation entity. That's another, we can probably get into that in a minute.
Yeah.
But it says
I'll do that closer to the end. Vihan's got, and others I know have the same question. What are the different ones and where are they appropriate? So this is the corporate equivalent to BEP.
Yep.
Go ahead.
Yeah, but I'll just, the renewable energy entity, either the partnership or the corporation, looks over leveraged with ending financial leverage, total assets to shares of more than 30 times. Should I worry? And so this is where, again, that complexity comes in. Let's go back to that analogy I made, where you have pile of assets and then it's carved up into the operating subsidiaries that own them, both on the private and on the public side. And this is where it gets a little bit confusing, because on the balance sheet, it will show the entire value of those assets, but not necessarily the publicly traded entity's proportional share of them. And so what you do is you have very large aspect of what's called minority interest. And so I'm going to try to pull up a share screen here. I'm not very good at nearly as competent at this as Jason is, but if Adam, you could pull this up. So this is Brookfield Renewable Partners here. And let me see if I can zoom in a little bit so we can make a little bit more sense of what we're talking about here. If we look here, this is this section right here is basically the market capital, the enterprise value of Brookfield Renewable Partners. This is the entire entity. And what you see here is you have the market capitalization of $14 billion. And assets on the books are roughly equivalent to $72 billion. So it looks like it's very levered on a per share basis compared to what it has. But I want you to focus on this number right here that I'm kind of circling with my mouse. I hope people can see it, but it says it's minority interest. This is the private entities that Brookfield Asset Management owns for its institutional investors, its wealth clients, things like that.
So again,
that have
that capital stack. Let's go through it again. So you
Yep.
have an asset that they want to buy, and generally a lot of it's going to start either Brookfield Renewable says, "Hey, we found this opportunity." They go to the people at BAM and say, "Hey, this is a thing. Do you have capacity? What kind of capacity do you have in your energy transition fund to invest in it?" And they'll say, "We have this much." And Brookfield Renewable has this much. And it's almost always a much smaller portion than that. Again, that $1 trillion assets under management at Brookfield Asset Management, that's kind of the engine that makes all this work. And then in some cases, you might actually have Brookfield Corporation with its own, $100+ billion in perpetual capital that maybe it'll take a stake. And then you have the developer who might also want to keep a stake of it as well. So that's the whole capital stack, which is the 100%. And then you have a portion of it that's broken up here.
And so that minority interest is what represents those private capital investors into those assets. And as a result, a lot of times their financial data providers may not necessarily reflect that when they're doing their statistics and things like that, because most companies don't have very, very large minority interests on their balance sheet like these entities do. And so it can kind of deceive them and make them look incredibly over leveraged. Now, talking about Brookfield Renewables leverage right now, it's, if I can do it from like a debt to EBITDA ratio or things like that, interest expense is a little bit low. Its debt to capital is 41%. It is elevated historically speaking. So I'm not going to, try to dance around the bush about it being, in perfect financial health. It is at an elevated rate, but I don't know if I would say that it is such an elevated rate that I am intimately concerned about its current financial position.
Yeah, I think that's fair. And I want to spend just another moment before we start just really delving into the questions, because we've got a good number more in here. The purpose of the Brookfield subsidiaries versus what we've seen in other companies that have subsidiaries. The publicly traded partnership MLP structure that exists, and it's more commonly used in the oil and gas industry. A lot of pipeline companies, midstream businesses that kind of own the infrastructure in the oil and gas industry. That's where this kind of originated. And largely those businesses have existed in the past in a lot of cases as kind of drop-down finance entities for a parent company. We saw that carry over into the renewable energy industry with NextEra Energy, with its subsidiary. It's actually, I think, structured as an LLC, but it's a partnership. Was called NextEra Energy Partners, and it's no longer called that. I believe was it XPLR, I believe is what it is now. But this is a case where that strategy of using, I'll find the ticker for sure, because they just renamed it a month or so ago.
Jason, I'm going to interrupt you for 1 second. We have somebody that wants to come say goodnight.
Oh boy.
Hello.
Hey buddy. How you doing?
Can
You gonna say goodnight to everybody?
Good night.
All
I'll
right.
see you next
Bye, guys.
time. Love it. Love it. So that is Tyler's why right there. That's one of Tyler's why right there that just came on the screen. And it's always, I just want to pause and remind everybody that we do this for the pursuit of wealth, but that wealth exists for the things that we prioritize in our lives. And it's always good to reflect on that. So yes, XPLR Infrastructure, Tyler, that's the new name that was NextEra Energy Partners, which exists solely as a finance vehicle for NextEra Energy, the utility. It would build out these projects, it would finance them, and then it would want to get that debt off of its own balance sheet, and it would sell those assets to NextEra Energy Partners, now XPLR, and that just imploded. It absolutely imploded, and we cautioned investors for the better part of a year that the story was starting to come unravel just based on the math of its balance sheet. in its operating statement. And the difference with the Brookfield entities and Clearway Energy, which is another one that I'm a big fan of, is the fact that they exist as co-finance vehicles, but mainly as the operating entities, right? They exist to help run and manage these assets through their life cycle. Because all of the Brookfield Asset Management can bring in plenty of capital to acquire a lot of these things, but having a separate entity that can act as the operating partner is compelling. And then having them as publicly traded entities, one of the reasons they spun out Brookfield Asset Management was a little more clarity in what does this business do and how can the market more appropriately value it, right? So being able to value these things as standalone entities also creates some value.
Yeah. And I want to focus on a couple other things here too, because like we were mentioning on the debt levels, interest rates, because it's a real thing. And part of the reason why we saw issues at other limited partnerships and things like that in that entity, and it hints a little bit at the question that, let's see here, DILF, DYLFF asked 8 minutes ago, saying all three asset managers, Brookfield Asset Management, APO, I think is Apollo, and Ares, are all down 32% over the last 52 week peaks. The thing being is, like, number one, higher interest rates means that, more money is going back to service debt, because these are leveraged entities. They have, when you have alternative assets, especially in real estate, you're going to use a lot more leverage than you're going to use in most other businesses, because the average rate of return on a office building, like unlevered, is actually not very high. It's like 2-3%, but that's why you have, like, 60, 70, maybe even 80% of the asset is paid with, long-term stable debt at relatively low rates, and then you can juice your equity. As those interest rates rise, obviously it starts to compromise that a little bit, where you have to pay more in interest. Therefore, the proportion of that excess cash doesn't go as much to your debt, to your equity holders, and actually, in a sense, will lower the valuation of those assets, because when you go to underwrite new deals, it's going to be worth less because you need to keep a certain rate of return. And for these entities, and I think why a lot of people have been kind of wringing their hands a lot with these sort of businesses, is because they have a lot of debt. They use a lot of debt to make a lot of these deals work. But at the same time, one thing I have always been immensely impressed with Brookfield entities is their ability to underwrite their deals. Unlike some of the other ones that we just mentioned, Brookfield has I speak specifically about its Brookfield Infrastructure and Brookfield Renewable, because these are the two that I own, and the two that I have followed most intimately. Is when they acquire assets for these publicly traded entities and the private wealth, the private funds that also are involved with them, they are immensely good at finding value across all of these assets. I mean, like you said, Brookfield Renewables founded when they needed to raise capital to buy Colombian hydroelectric dams out of near bankruptcy. It basically sprungboard its solar assets when it bought it was called Terraform Power, and Terraform Global bought them basically out of bankruptcy. It bought Spanish utility assets basically out of bankruptcy. It's been extremely good at underwriting deals. And yes, when you use leverage, obviously it impacts it, but when you're underwriting so conservatively and making acquisitions that way, you can handle debt. And I think, going back to, somebody like Warren Buffett, and not to be super cliche and talk about, Warren Buffett, but he has always said, like, debt can be your friend if you use it wisely. And I think at first blush, you might look at a Brookfield entity every once in a while and say that does look a little bit more leveraged, but because it has been so good historically at underwriting its deals, that, maybe that a little extra leverage isn't as big of a deal as it might seem on the surface.
Yeah, I think that's right. I just want to take a quick question that Shotgun Santa asked close to the beginning of the hour. It's an interesting question. Why won't Schwab reinvest the dividends for Brookfield, ticker BN, and Brookfield Asset Management, BAM, BAM? Possibly. And I'm not sure. Some brokerages, if you own a foreign stock and there's a tax, they will not allow you to reinvest dividends. Depends on the broker, and I think Schwab may be one of those. So Shotgun saying, I'm guessing here, but I think there's a good chance that could be the reason why. And I would just suggest send a message to their customer service, and they can give you an answer. Their online chat, you give an answer in a minute, but that's probably the case. Tyler.
I was going to say, yeah, it depends on the brokerage and it depends on the country. Like at times that I have owned Canadian companies or ones that are have ADRs or something like that in the United States, they will reinvest the dividends. But for example, a company I own, Total Energies, which is a French company, has ADRs here. I have Fidelity. They don't allow reinvested dividends. So sometimes it depends on the brokerage that you have and the type of and the country in which it operates.
Right. And the domicile of the company, or where the company is domiciled as well, can affect whether the brokerage will do it.
Yeah. So it ends up being a smorgasbord of issues that sometimes if you just call customer service, they'll sort it out for you. And if they can't, if it's really frustrating and something, sometimes it's worth shopping around for brokerages, because as you start to invest in more, I don't want to say complex, but you start investing in international markets or in things like this and using reinvested dividends, it might be worth just checking to make sure that the functions of those brokerages work in your favor.
So I would like to, as we continue answering questions as we go along here, I do want to take a moment and talk about the different tickers, the different corporate structures for the operating businesses, why they exist, and where they're.
I was looking to take a nap during this hour, so this is a great time.
Well, you can catch some snooze, but Vihan and other people have asked the same question. We'll use Vihan's as the question to answer. Jason, as you present, which Brookfields, and you keep calling them Brookfields. I don't know if you're doing that just to tease me, or if you're misspelling it on accident. But which of the Brookfields are suited in which account? Taxable versus retirement, like IRAs and that sort of thing. This is where we want to avoid mistakes when starting positions. I absolutely agree. And I've got good news for you on this regard. So with the Brookfield businesses, the entities, and it's Brookfield Corporation, or excuse me, Brookfield Renewable, Brookfield Infrastructure, and Brookfield Business are the three that are publicly traded partnerships, the ones that have the 3-digit tickers. They also each have a 4-digit ticker that is a corporate entity that's an equivalent, one-to-one equivalent. That if you have one unit, which is the MLP language for share, you have one share of BEP and you have one share of BEPC, it's the same percentage of ownership of the business. Now, there's a difference in the stock price and the dividend yield. The dollar amount of the dividend or distribution is the same on a quarterly basis for both, but you'll see a difference in those 4-digit corporations consistently trade for a higher price, which means a smaller dividend yield than the publicly traded partnerships do. There's a specific reason why that we can talk about. But before we get to that reason, I want to explain the biggest thing that investors should be aware of before you buy any of these. Assuming you've already done your due diligence and vetted and decided you want to own one of these businesses, there's a difference in the tax statement that you get at the end of the year. If you own Coca-Cola or some other dividend paying stock, you get that 1099 div. And a lot of that dividend is what's called a qualified dividend, which means it qualifies for the lowest long-term capital gains rate that you pay for the dividend if you own it in a taxable account. And the 1099 div, super simple, super easy. Most of the TurboTaxes, et cetera, of the world, it's like they can pull that stuff up automatically. Like they can download it and you don't even have to type the information in. If you use an accountant, they probably have software that can pull that as well. So it's super easy and simple. You start investing in the publicly traded partnerships and you get the lovely Schedule K1 that adds a level of complexity And also, when you own a publicly traded partnership, the tax rate on your dividend is different. It's a distribution, not a dividend. And part of that distribution that you get, different parts of it are actually taxed at different rates based on whether it's like a return of capital, which just lowers your cost basis and is actually non-taxed when you receive it. But a lot of that distribution is taxed at your marginal rate. So it's taxed at the same rate as the last dollar that you earn. So that highest tax rate that you're taxed at. Again, speaking to U.S. investors, I want to be clear there. This is how it works. So the yield is higher because the price is lower, but your tax effective yield typically is going to be pretty close to the same, right? Because things are going to wash out with that qualified dividend that you get through the corporations. Now, that's holding in a taxable account. If you own inside of a retirement account, a lot of the brokerages out there, whether it's an IRA, a Roth IRA, a solo 401k, any of those vehicles, there's a very good chance that your brokerage is not going to let you even buy the shares of the publicly traded partnership. Because with publicly traded partnerships, there's a risk of something called UBTI, unrelated business taxable income. And the short version of the story is that at certain levels, I think it's $1,000 or more across all of you. Maybe you've got like 3 or 4 separate accounts. Across all of those accounts, if you earn $1,000 or more of UBTI, you're going to have to pay taxes out of a retirement account, right? So most brokerages don't even allow you to do that. The good news is if you have a brokerage like Fidelity that I use, that they'll let you. Brookfield has been abundantly clear that UBTI is not a risk and it's not something that their publicly traded partnerships will generate. So I actually do own them in my retirement accounts, the publicly traded partnerships, deal with the Schedule K-1s, and that higher yield, because it is tax-free inside the retirement account, is worth it to me for that additional complexity. But your mileage may vary. I want to caution that. I'm not advising anybody what to do in their situation, but that's the thing. So these are the only publicly traded partnerships that I own inside my retirement account. You start wading into the enterprise partners of the world, and you're going to hit UBTI really quickly. And it's not just from the Schedule K-1. You might use it on realized gain. You might get it on realized gains on the price appreciation of the stock of the unit as well. So it can get really, really complex and have a negative implication that you might not want to deal with.
Yeah. So just to answer Vihan's question, because he was asking about what I own them in retirement accounts as well for the same reasons. I have Fidelity. They let me do it, and it hasn't been an issue. To kind of drill into the why the partnership 3-letter ticker ones and why the corporation 4-letter ticker ones, to be frank, it's not really for us, like individual investors. The reason that they have this is that there are a lot of institutional investors who invest in public equity or index funds or pensions or things like that, who have mandates that say no publicly traded partnerships.
Well, a lot of home offices will not invest in MLPs or publicly traded partnerships because they absolutely do not want to deal with the Schedule K-1.
Exactly. So for that reason, a lot of these businesses, people in the partnership business have either converted to C Corps or in the case of Brookfield, they have created a corporate entity separate from the partnership so that those family offices, so those institutional investors can invest in these entities without having to go through the same K-1 rigmarole. As somebody who tried to do his taxes alone, unassisted, without an Intuit or anything like that once, I can assure you, doing a K-1, you will want to pull your hair out. It's a pain in the butt because you have to pay state taxes in every state that they operate. It stinks. So, for the most part, I know we can talk about this till the day is long, but for the most part, if you see those 2 separate tickets, just keep in mind, it's not really for you. It's for, I don't know, maybe somebody watching this is
a
an
lot more
institutional
money
investor.
than you, I think is the, yeah.
Unless there's somebody here who runs a family office.
Right. No, I think that's exactly right. So this is from, I'm sharing this on the screen. Adam, if you can release it. This is from Brookfield Renewables investor relations site. Does Brookfield Renewable Partners generate UBTI? No, we do not generate UBTI. That is the risk of owning these assets inside a retirement account. So that doesn't mean your brokerage is going to allow you to. So you have to follow, you can only buy what they will allow you to buy. So I think that's the key there. All right. What have I missed? Is there anything in terms of the different entities, the structure, the tailwinds? I want to talk about the tailwinds real quick because I think that's important. The what Brookfield has always been really good about is across these different alternative assets, these non-correlated with the stock market assets that they try to find, is looking for tailwinds and trends that are favorable, that they can make money in, that they can leverage their superpower, which is largely being really focused, disciplined value buyers to create value. And then also being very disciplined when they determine to sell assets. So they do a lot of capital recycling. There was a Spanish renewable energy business that they bought, Saeta, I believe is how it's pronounced. I'm probably pronouncing that incorrectly, but we'll just go with that for the sake of brevity, that they bought sometime in the past 5 years and made the decision to exit relatively recently. They made money. They sold it for a higher multiple than they bought it for. They're typically able to do that really well. They're deeply connected with buyers of these sorts of assets. Like a lot of the Canadian pension funds love to do business with them because they know they can buy a good quality asset that's going to be income generating, that when they're buying it, they're not buying a DIY project. They're not buying a fixer upper. Brookfield's already done that. Brookfield loves to sell to them because they know they're going to get a good multiple because they have a good relationship that's been built on years and years of trust. So there's a lot of things about the way they're structured that I think are really great. And like their infrastructure business, Tyler, they've largely rebuilt the asset base in a lot of ways over the past 10 years, shifting away from some of those legacy, like we talked about timberlands and owning ports and toll roads and things. That
My favorite assets.
They're great assets, but they moved into a lot of the more modern infrastructure assets that are driving the world, like moving energy around, power transmission, data, telecommunications, liquefied natural gas is something that they've moved into. So they're really that mental flexibility, I think, is really, really useful as well. All right, we got 6 or 7 minutes here left to answer questions before they show us the door.
Yeah, so there's some people who are on the fence. I see a comment, Lovely Lilies. I'm wish-wash on Brookfield entities. I see Matt saying that where it's maybe not the best idea based on leverage and it being aggressive. And so there's a few comments here that it's kind of pointing at like the bearish thesis, and I'm gonna. There's obviously the complexity is a tough thing to wrap your head around, but I do want to point out something that I would say is a legitimate threat or concern for Brookfield and a lot of private asset managers over the years, is just kind of like to bring it a little bit full circle. So one of the things that they really talk about in their presentations is the expansion of assets under management moving into the alternative asset space, because pension funds want to get into it, insurance companies, institutional investors, people looking to, they talk about it being uncorrelated, not volatile assets, because, it's a toll road. You don't need to price a toll road on the publicly traded equities so that it changes in valuation by 3 multiples every 6 weeks. That's the benefit that you get to go to a pension fund, be like, it's going to be a stable asset. It's going to pay you cash. You don't have to worry about it. We'll park it. So one of the reasons that more and more and more of institutional pensions, insurance have moved into the alternative asset space over the past 25 years is because those institutions have been so starved for yield for a long time, where the alternatives, the conventional things that they invest in, U.S. treasuries, corporate bonds, European debt, things like that, those yields have been incredibly low. I mean, you look at from 2020 to 2022, we saw basically, federal funds rates drop from like 6-7% down to practically zero.
Money was free for a year and a half. Yeah, money was
for
free
a long period in Europe. Bond yields were negative.
So
there was so much like low yield, negative yield assets out there that pension funds were like, how can we fund our future obligations with these low
Right.
returns?
Well, and
So
coming out
that's
of as low as the rates were, the coming out of the global financial crisis, interest rates were exceptionally low for most of a decade. And it was only in like 2018, 2019, we started to see rates start to move back up. And then the pandemic happened, right? So we're in this environment now where things have changed. So I think that's your point, is that the options for earning yield are starting to broaden.
Yeah, the options that these big institutions have broadened again. They can invest in treasuries at 4.5 to 5%. If they're opportunistic, like I don't know, Berkshire Hathaway, you can get 5.5. European debt is starting to increase again. So there are other, I would say, safer assets providing yield so that these companies can go there. And so one of the things that could be an issue in the coming weeks, months, years is that the growth of investment in alternative assets might not be quite as robust as it has been, for the simple fact that there is a wider variety of decently yielding assets out there for these institutional investors to meet their mandates.
Yeah, no, that's exactly right. So we'll see how that affect. I'll tell you this: over the past couple of years, we've seen all of the alternative asset managers, the KKRs of the world, the Blackstones, have continued to acquire capital. So the appetite doesn't seem like it's weakening, and a big part of it is because private debt is a big part of these businesses already. So there's that as yields have moved up, what they can offer to their clients has continued to move up as well. So it's not just shopping on the bond aisle when they can get even better yield than that through some of the funds in these asset managers. Swing for the fence 88. Jason, aren't K1s not applicable when partnerships are held in retirement accounts? You still have to convince your tax filing software that that's the case. So I guess you could call it digital yelling. So it does take a little time for me to tell TurboTax that I don't need these. It does add a little bit of time, but broadly that's correct. But again, UBTI is the thing. So depending on what partnership you own and the K1, that UBTI, it's going to be listed on the schedule K1. So be careful there. So, okay. Yep. John Gagos, you're in Arizona. So I think you guys don't do daylight saving time. It's not our fault. It's not our fault. You're not keeping up with the time. That got to keep up with the times, man. Got to keep up with the times. Back it up. Watch the whole hour. I think you'll appreciate it. We got a couple questions about not Brookfield I'd like to answer in the last minute before we turn it over to who's coming on with Will. Who else is going to be on with Will?
Me.
You and Will. That's right.
You're leaving and Will's joining me.
Grab the Mike's question about Enbridge, ticker ENB. You got quick thoughts on Enbridge?
I do. And if I can't remember if we published it yet or not, but Nick Seipel and I did a Motley Fool scorecard on Enbridge. I don't know if it's been published yet, but if not, it will be soon. To keep my answer very brief, Nick and I didn't think too highly of it.
Didn't love it.
For various reasons.
So for people watching, just real quick, so Motley Fool members, of course, you'll see the scoreboard published on the ticker page for Enbridge. For those of you watching on YouTube, on our YouTube channel, we are also publishing some of the scoreboards. And the short version is that so you have a couple of analysts that battle it out and duke it out over their thoughts, rating a company based on the number of categories. And they're 7 or 8 minutes long. They're well worth checking out if you're interested in companies you want a little more depth.
But the short gist of it is that Enbridge has been, compared to Brookfield, much more cavalier about its debt and its ability to service that debt in the history. And sometimes you start to wonder if it can continue to do so. So
I'll take Ed's really quick. I'll take Ed's really quick on Target really quick. Target points out stock price is about $105. Not sure. I haven't looked at it today, so I can't confirm that. Target ticker TGT looks like a strong buy. What am I missing? 4% dividend yield. So I will say this: looking at their last earnings, still challenges. The macro environment is going to put pressure on a lot of retailers. This is exactly the kind of retailer that if we do see tariffs remain kind of the law of the land and start impacting companies, these kind of retailers are probably the ones that are going to be impacted. So it could take a bite out of the results in the near term. I do think the business is structured where the dividend is perfectly safe. So you're going to have to, anybody that invests in Target is going to have to hold through all of the uncertainty with the economy right now and the pressure on consumers, because they fit in this weird spot where we've seen some of their businesses struggled and they've lost customers to maybe the Targets of the world, and they don't serve necessarily the highest end of consumers that are a little more insulated from it. So they still have work to do on the business, but I think the risk reward is appealing. And that 4% yield, Tyler, that's about as high as the dividend yield's been in years. So I don't think it's a dividend trap. I think it is compelling, but there is some risk reward at play. Are you going to kick me out now? We're going to wrap this up.
I think that does put us at the top of the hour. And I mean, you started answering questions about Target on the Brookfield hour. So I feel like that is the opportune time to boot you and bring Will in for our next hour, where we're going to be discussing let me see, stocks down big. And there's a lot of them because it's been
Target. I was just foreshadowing you guys. I was just kind of setting things up for you.
You let us in with Target.
Target,
So
definitely one of them.
Perfect.
Yep.
All right, fools. We'll see you next time, Tyler and Will. You guys have a great hour. Okay.
Thanks, Jason.
Thanks, Jason. So thanks for joining me, Will. For everybody who is just joining us on Fool.com from the membership portal, welcome again. And anybody who is just joining us on YouTube, please also welcome. Since we are at the top of the hour, I'm going to do the obligatory disclosures that we do here. Will and I are going to be talking about stocks down big because there's quite a few of them lately, and a lot of discussion to be had here. But please note, everything that we do here is for educational purposes only. We are here to share our thoughts, our expertise, our views on companies, maybe even opinions on things that might not necessarily be companies. But please do not view this as personalized advice. We want you have to make your own decisions when it comes to making decisions about companies like this. If you are looking for personalized financial advice outside of, what a company is doing, something like that, please go consult a professional wealth planner or financial advisor or something like that to get the personal advice that you're looking for. Also, if you are joining us on YouTube, keep in mind that we don't use the YouTube comments because we're trying to take questions in from two places at once. So we'd like to kind of consolidate them all together at slido.com. If you go there and you enter the code Fool24, you can get into our board of questions that we have. There are, I believe, over 100 of them, and we try to work through them as much as we can. And there we can answer your questions as best as we can in real time. So, Will, you've been sitting in the background, in the backstage a little bit, or digital backstage, if you will, while Jason and I opined on Brookfield for a while. And I'm sure there's some questions that you saw in the queue. Was there anything that stood out to you right away? Or maybe there was a stocks down big, since we're talking about the theme. If there was like one that you're like, man, I really want to get this off my chest because it's a stock down big that I really like, or one that's like, yeah, this is down big probably for a reason.
Well, there is. I did want to touch on Adobe a little bit just because it reported earnings yesterday. So we're kind of towards the end of earnings season now, but we still have a few of these coming in. So just to go into Adobe, it's down 13%. So investors didn't seem to like its report. It did beat on revenue and earnings, not by much. And then the outlook was marginally lower. But it was not so much lower that would really should concern investors per se. Most of what I saw I liked, but there are some definite concerns here. Remaining performance obligations of 20 billion, so they have plenty of business that they need to address. So they're not in trouble or anything, but again, there are some concerns. They are starting to get into AI. So they have so far 125 million in revenue from these AI products. They're also splitting their company into two segments. Based on who they serve. One side being the business segment, another segment for creative and marketing professionals. As someone who's played with Photoshop, I kind of identify with this, and think that's a great idea. But they repurchased 7 million shares in the quarter, so that's considering they have about 435 million shares, that's a pretty substantial reduction in the number of shares for one quarter. That unfortunately has not stopped the stock from falling, as it's down by about a third over the last year, and like I said, by 13% today. I will say though, the PE ratio is at 31, which I know that doesn't sound low when you look at, say, the S&P 500 average, but Adobe's typically been a much more expensive stock. And then you look at the forward PE ratio of 18, it's become pretty cheap. Now, from a certain point of view, it is cheap for a reason. I think mainly because of the disruptive potential of AI. There's a lot of people who make their living through Adobe software. In some cases, a very good living, being graphic illustrators, artists, professions like that. And you have to wonder with all the AI capabilities surrounding that, how that's going to affect Adobe. And I don't think it's clear. Adobe's kind of pivoting into this a little bit by developing AI tools of its own. But yet it still remains to be seen how people who function purely on their creative talents, they're not going to be competing with AI. So we'll have to see how that shakes out. And I think that did spook a lot of analysts, as a dozen of them lowered guidance. So is this a bargain? Yeah, maybe, but it's. I think there's still a lot of uncertainty. So I mean, it is somewhat cheaper for a reason. Do you follow Adobe, Tyler?
I do not. This is one of those ones that's tech is never been my forte. Probably something I should get into a little bit more. But we talked about Adobe a little bit in the 8 to 9 o'clock hour this morning. A lot of opinions that you had. Jason Hall was with me and shared very similar thoughts. So I'm going to actually pivot then, because since I don't do Adobe too much, we'll talking about stocks down big so far, because Kent asked an hour ago during the Brookfield hour about the question is very interested in Brookfield opportunity, Brookfield renewable, and Brookfield infrastructure in particular. We covered that a lot, so I'm going to skip that part of the question, but there was a follow-up within the question. Also very interested in hearing more about ticker TBBB. And this is BBB Foods, a company that went public in, I think, April of last year or March. I can't remember precisely, but that's not the biggest concern here. This is a what's called a hard discount grocer. Hard discount is kind of the no frills type of grocery store that you go into. Typically, that's the one that instead of stocking it on the shelves, it tends to be sitting on pallets on the floor for a lot of like the high turnover sort of stuff. No frills, not a lot of curation of what's going on in the entity. It tends to be, the whole objective is it's almost by design of trying to make it look like, hey, we're not going to spend a lot of money on making this look good for you, because we want to keep our prices low and we want to turn over inventory as quickly as possible and provide that image. So BBB Foods is very much in this hard discount grocer kind of model. If you've ever been to a grocery outlet bargain market or a Aldi or a Lidl, same kind of idea. BBB Foods is that iteration for the Mexico market. The stores are tiendas BBB, so not BBB Foods. So if you're in Mexico, it'll be going by tiendas BBB. This business, in my opinion, is one of the better businesses I've ever read when I read an IPO's perspective, because when you read it, the level of detail that they put into understanding their customer, understanding the demographic of what they want, how they buy, their habits, their needs, and things like that went into levels of details that I've rarely ever seen before when you're looking at an IPO perspective. They're talking about things like, well, we're in neighborhoods. Most of the shoppers are, the matriarch of the family. They don't have a car. So we need to make sure all of our packaging fits in 2 paper bags that they can carry home in their arms, walk home, and probably visit our shops 2 to 3 times a week. This is literally in the IPO IPO perspective. Things like that you don't see anywhere else. And this is why I've loved this business, because they communicate that so well. It's clear they know what their customers want, and they deliver that. You look at the operating metrics, they have inventory turnover, which is kind of like the most important thing you want in a grocer. I think most recently, I think their inventory turnover was something like 19 times their inventory turn. So every single store is turning over the inventory in its store 19 times. That is absurd when it comes to grocers. I think of like the gold standard of grocers in like the United States is, from an operating perspective, is Kroger. And I think theirs is in like the 14 times range. So, the turnover is kind of an indication of profitability. If you can turn over inventory very, very fast in groceries, you're going to make good returns. Even if it's a low margin business. Everybody knows that. But if you turn over your inventory, you're going to make good returns. And so this is what I really love about this business. High inventory turnover, knows exactly what the customers want. For multiple years, it's had same-store sales growth in the double digits range, and they're looking to do expansion to go from like 2,700 stores to 20,000. So huge store growth, huge same-store sales growth that seems very promising. Yes, it has a high debt level because it was private beforehand. Now that it's public, perhaps it can, get a corporate debt rating and bring its interest rates down. But all in all, the stock's down like 14% so far this year. It's obviously a startup. It's not very profitable, very, very low per share earnings. So its price per PE ratio looks absurd, and I can see why it would scare off a lot of people. But the reason I'm so excited about it is for the things that I just laid out. Despite like the year-to-date numbers looking awful, it hasn't even reported yet. So I'd love to give fourth quarter earnings numbers, but they haven't reported yet. I'm going to guess it's going to come out sometimes towards the end of the month. So anybody who's like heard me opine about this company, check in back in April, because I feel like that's when we're going to get to the fourth quarter earnings report and be able to give a little bit more of an update other than, no news. It's the stock movement.
Yeah, Tyler likes to cover these obscure, more obscure sites like Mexican grocers. I probably need to check this out though, because sometimes some of the best stocks start off in obscurity. So it's probably a good bet to have, and I think that turnover is incredible. So that's one I need to take a closer look at.
All I have to say is that when Amazon went public, it only went through one funding round beforehand. And it was like $400 or $500 million market cap when it went public. It was an obscure company. Obscure companies can turn into something great. I'm not saying it's the next Amazon, but it's kind of the idea of like small, obscure can do wonderful over the long term.
Yeah, if it's in Mexico, a lot of American investors are going to miss it for that reason. Which I guess that's just the way it is. There's so much going on in America. It's very easy to ignore what goes on elsewhere. So. Now I want to touch on a Canadian company, and Sadaf had a question about 3 hours ago. Do you like Shopify, symbol SHOP, at current prices? Well, I do not like it because I'm a shareholder, and I liked it much better when it before the 30% drop that we just experienced. But kidding aside, I do like it here. Looking at the valuation, that because of the 30% drop recently, that has fallen significantly. We're looking at a PE ratio of 58 right now. That's not a record low, but it's only a few times in its history has it traded at such a low valuation. Its revenue growth is still well above 20%. For those of you who don't know Shopify, they sell e-commerce platforms basically, and they've come to lead the industry because they not only do they have the platform, but at least until recently, it had been very low cost. They've raised the cost recently, but so that they don't have that anymore. But it's been one of the faster ones. Studies have shown that faster transactions tend to lead to fewer missed transactions. So that can be huge for a small business using Shopify's platform. Shopify also has an ecosystem behind that. So and it covers most of the services that an e-commerce merchant might need, like email marketing, payments, there's so many things that I can't think of right now. But raising capital, just anything that almost anything that the e-commerce merchant would need, you can do within the Shopify ecosystem. And those two things have given it a very huge competitive advantage. So, yeah, I'm kind of fully invested in it right now personally, so I'm probably not going to add to my position. But if you don't have any shares, it might be time to at least start dollar cost averaging in this. Could it fall further? Sure, and for that reason, I wouldn't go all in per se. But yeah, if you're interested in it, I think now is a time to start buying the stock. Tyler, I think you're muted. I don't.
Yep, I was.
Okay.
Of course, I do that all too often on these live shows.
Yeah.
Like I was about to say, I do the Charlie Munger. I have nothing to add with this one because not something I follow too much. But this is a challenging one, and I'm going to try to do my best to navigate this question. But Cinta asked 9 minutes ago, are rate hikes and geopolitics just excuses? Is the sell-off exposing years of liquidity-driven growth? The reason I say this is challenging because, I try to avoid the geopolitics thing a little too much because I think we can tend to bias our opinions based on politics and you might even hold biased views on somebody's future views on other things based on what they say politically. So I'm going to try to ride this without touching the third rail as much as possible. It's a little challenging, but one thing that we do have to keep into account is, I think part of the reason we've seen a bit of a drop off is for a lot of things, and I guess you could say liquidity driven, maybe not, but the market in general, and I'm talking broadly about like the NASDAQ 100, talking about the S&P 500. These markets have been pretty richly valuated as of late. I mean, obviously they are dominated by great companies doing wonderful things, the Nvidias, the world, Amazons, Microsoft, growing at great rates, but also trading at very, very high multiples because the expectations of future greatness is baked into these prices. And so when expectations of greatness are not met, that can lead to sharp drop-offs. I think one of the first examples that we saw here early in January, before we even talked about tariffs and geopolitics, but early January, we had the DeepSeek moment, if you will, where there was this question about, hey, maybe AI is going to commoditize much faster than we originally anticipated. Maybe these AI compute models are going to become much more efficient on a power basis, so that all of this compute power that we're expecting, maybe we don't need as much, and maybe the growth rates are going to slow down a little bit. And so when you start to chip ever so slowly away at that expected greatness multiple, it can change the narrative relatively quickly. Now, for every individual company, there is something like that along the way. We can mention, like I just said, with Nvidia, and anything tied to AI had that sort of moment. Even like the picks and shovels businesses related to AI kind of had that thing. If you want to get into other businesses that are a little bit more related to rate hikes, real estate, oil, things that use a lot of leverage. Yeah, rate hikes are a real thing. They're a tangible element of a business, because if you use a lot of leverage and you have to turn over your debt, you have to refinance your debt, you're going to have to pay higher interest rates to do so. It's been the one of the concerns for the commercial real estate market for a long time, because unlike most Americans, where you can get a 30-year fixed rate mortgage, you can't get that in commercial. You can get a 5 to maybe 10 year, and then you have to turn it over and over and over. Most commercial mortgages are in the 5 to 10 year range. And so if you have to turn over every 5 to 10 years, you're 20% of your debt more or less is going to have to, every year get re-rated at these higher interest rates, and higher interest rates means less free cash flow to your equity investors, likely means slower dividend payments, things like that. So there are real consequences. I wouldn't say they're just excuses. The market can sometimes use that as an excuse, as a reason to lower the valuations, because perhaps that higher interest rate has an effect. Perhaps it doesn't, depending on the quality of the business and how leveraged they are. But overall, everything's going to be impacted to a varying degree. How much people are willing to invest in new ideas, because it changes, what are the alternatives out there to make investments. So I wouldn't say they're just excuses, but the market can sometimes react a little manically or erratically related to these sort of things, such that maybe something that shouldn't constitute a 10 to 15% drop off can result in a 10 to 15% drop off. We often think of these things a lot in this sense, where like when something happens at a 10 to 15% drop, like, oh no, that doesn't make sense, the market's overreacting. But when the market jumps by 25%, that's just, it's doing what it's supposed to do, when that too could be just as irrational. So I think, I don't know if I've directly answered the question enough, but it always is a pull and tug of all of these things. It could be a little bit of liquidity driven growth that had higher valuations that are getting, checked in by less than ideal news. It could be a little bit of rate hikes. It could be a little bit of this deglobalization, supply chain resiliency, any euphemism you want to do, that goes towards more localized production, more localized consumption, that is going to require things that will sap profitability to a certain degree. I think they all have a certain effect. The degree to which they have an effect can vary wildly, and it's our job as investors to kind of sift through the wheat and the chaff at an individual company level, how much those things actually impact the story.
Yeah, I mostly want to echo what Tyler said on this issue, but unlike Charlie Munger and Tyler Crowe, I do have a little bit to add. If you look at the Shiller PE ratio, for those of you who don't know what the Shiller PE, it's the S&P 500 divided by 10 years of earnings. Right now, it's at 35. That's not exactly a record high, but amid this recent pullback, it's coming off at least a multi-year high. Just because the ratio is high does not necessarily mean the stock market's headed for a down is going to have a downturn soon. But like I said, it is historically high. So so any bad news makes the market a little bit more susceptible. And the market always goes in cycles. So at some point, it's going to have a down cycle. Does this cause a much bigger down cycle? Time will tell, but it's always something to watch. So like Tyler said, I wouldn't call rate hikes and geopolitics just excuses. Those can legitimately derail a stock or even the entire market in some cases. But it is something you just have to keep watching, though. But yeah, just keep in mind the market is high, so it is more vulnerable than it would be during most time periods. So moving on to other questions. I'm glad T Stock asked this. It's about Tesla. Thoughts on Tesla? I emailed the owner for 5 things he did last week to boost the stock price. Haven't heard back. I guess that's a reference to his Elon Musk's work at Doge. But yeah, the Tesla stock is down more than 40% year to date. So that is pretty dramatic. It's hard to say what's to come because of that, because sales are down a little bit. I think revenues were down modestly in this last earnings report, and the stock just seems to be in free fall right now. And I will say, I think it reminds us of a lesson that I think when people look back at the 2020s, it's going to be a reminder that alienating half the population for no reason, namely politics, doesn't bode well for a stock. That didn't work for Anheuser-Busch a couple of years ago. When they offended the right. Now, I guess what Elon Musk is doing is offending the left, and they're dumping Teslas on the market right now. And sales are down, and there's a lot of uncertainty because Elon Musk also has so many things on his plate. He's running several companies and he's running Doge, which is I don't. It's hard for me to fathom how somebody can manage that much. You hear about the right wing perspective on Elon Musk, and you hear about the left wing perspective, depending on which news outlet you look at. You don't really hear much about the investor perspective, and given how divided Elon's attention is, that could be very concerning for Tesla investors. I think that point deserves more attention, in my opinion. I don't know when the free fall in the stock is going to end. I can see it making a comeback, and if it succeeds with AI, like Kathy Wood thinks it's going to succeed, it's going to go up massively over the next few years. Does that happen? We'll see. But it's in a very interesting place right now. If you're looking to buy some shares, I might take a small position here, but it looks like a falling knife right now, so I wouldn't make any big moves one way or the other on the stock right now.
I'll keep my thoughts on Tesla brief because it's a tough one to talk about. But for the longest time, Tesla has been not priced, or the stock has not been priced because of its automotive business. It's been priced for the future endeavors that it says it's getting into: the robotaxis, the AI, the humanoid robots, a lot of the futuristic ideas that have been baking in this business for a very, very long time. We've been talking about robotaxis and automated driving for close to 10, 11 years now with this company. And so the company has always, for a certain degree, has, especially recently, I would say the past 3 or 4 years, has been priced that a lot of these ideas of greatness, ideas of grandeur are going to happen, or there is a high likely probability that they're going to happen. If you look at it just as if you strip out, the future concepts and just, say objectively the car company and just look at the car operations, it's hard to look at this business from that lens and say, yep, this is how this business should be valued. It's a relatively low margin business. Automotives, yes, they took market share for a while, but it is going to hit cyclical points. The margins are always extremely competitive in automotive. And so if you're, I think maybe some people are looking at automotive sales from political divisiveness, but for the most part, if you were investing in this company at the prices that it has been at, you weren't really buying it for the car company in the first place. You were buying it for all these future endeavors. And whether or not what has happened recently calls that into question is where you start to need to make that assessment. It kind of goes to the occupied head of the company. Are the efforts that they are putting into these things moving at the rate they should, or is perhaps leadership perhaps a little too distracted to execute on those things and deliver on those? I don't know. I don't have enough information on Elon Musk's lieutenants at Tesla driving forward its robotics, its automation, auto taxis, to make a fair judgment on that myself. But if I was, for somebody who was invested in that stock, I think that's a legitimate question you have to ask, because so much of what you are betting on are those ideas and not just the car company itself.
Yes.
I'm trying to see if I can questions that I can hit recently, because there's a lot of great questions, but a lot of things that are a little bit out of my expertise. So I'll do this one that Kent asked 12 minutes ago, and I can't hit all of them. I can hit 2 of them, because Kent asked, along the hour topic, please share your thoughts on tickers DECK, which is Deckers Outdoors, Cart, which I believe is Instacart, but actually that's the one I'm punting on because I don't know Cart at all, and ticker ABNB. It's Airbnb. Nice easy ticker to remember on those ones. So I can talk about Deckers and Airbnb, and I'm sure Will has some thoughts on, maybe he has on Instacart, and he can help fill in the gaps here. But
Unfortunately,
for me,
I haven't covered Instacart, but I could talk a little bit about Airbnb.
sure. So Deckers Outdoor, a shoe company. It used to be well known for its like Deckers flip flops, but its kind of core engine of growth for the last couple of years has been UGG boots and Hoka. I think it's Hoka One running shoes. Those nice big puffy running shoes. I've got a pair for trail running. They are absolutely fantastic as a product. I will endorse on that end. But as far as the stocks dropping, obviously year to date, the stock has gone down quite a bit. I am of a couple of minds of this, because one of the things that Deckers has done well in the past couple of years is identifying underdeveloped or underappreciated elements in shoe wear. Uggs, for example, Hoka One was not a well-known brand, but they bought them very, very early and nurtured these brands. And I think that's kind of been the reputation that Deckers Outdoor has had for a while. The monumental success with Hoka's, Uggs, obviously, but I think and as a result, I think as recently as a few months ago or a few weeks ago, the stock was trading for over $220. It's down to $115. So at $220 per share, that was a pretty sizable premium. And we're talking, a PE ratio. Oh, I can even look it up because I have my data provider right here up as we go. Oh, maybe not. Maybe not right now. Yeah, here we go. Fiscal 2024, it was trading at 32 times earnings for almost any business. And perhaps I'm a little bit more valuation sensitive, but almost any business at 32, 33 times earnings is kind of expensive. Like, you have to really, really earn a reputation in the market as a stable earnings generator that is going to be able to, last through time. As good as Deckers has been over time, it is also in the consumer discretionary space that sells really expensive shoes. And so there is a legitimate concern on, the cyclicality, the availability of the discretionary consumer spending going towards higher end running shoes or fashionable, maybe semi-fashionable UGG boots, depending on your thoughts on those. So I think, just it's down quite a bit. I'm sure a lot of people are a little shell shocked at it, but 18, 19 times earnings for a business that's growing at a decent rate, but it has that, cyclicality built into it and the sensitivity to economic outlook. That's a legitimate thing. And, you kind of have to value appropriately. I'm not saying that the company is going to tank from here, but it is going to be valuation sensitive. And so I think that's the component there. As far as Airbnb, same idea. If you look across the entire hospitality space right now, it's not just Airbnb, it's hotel companies, it's airline companies. Everybody's talking about, concerns and softness in discretionary spending. So going back to Deckers Outdoor as well. So it's less about like the operational performance of these businesses, because I think they're both doing relatively well, perhaps not quite as growing quite as fast as people had anticipated. Certainly with Airbnb, I know there's always the stories of like, well, they're going to get kicked out of these cities and the new regulations. That story's been going on for years, and we really haven't seen like tangible impacts for that. And there's still a pretty legitimate like international growth adaptation of the Airbnb model overseas, where it can certainly grow there. And man, for a business that's got a ton of cash just sitting around, I really wish they'd get a chief investment officer and manage that like an insurance float. But I'm going to give my 2-second thing I can't stand about Airbnb, and it's stock-based compensation package. You're doing great. I love you. It's wonderful. I'm happy for you. But man, do you $1.4 billion in stock-based compensation in a single year? Whew, baby, that's a lot. A lot of people might not think that's a big deal, but over time, you shell out that much stock-based compensation year over year over year, it's going to dilute your investors pretty fast, no matter how much you buy back stock, because that's negative return stuff for you.
Yeah, I really like what Airbnb has done. I mean, they really have spearheaded. Although Verbo started the vacation rental business, Airbnb has really spearheaded the growth of it and really made it kind of an industry. Unfortunately, and even though that they've marketed well, they've gone into new things such as experiences. But despite all that, their growth just hasn't been what it needs to be, and it was very high when the stock first IPO'd, and like now it's down to what? Let's see, we had revenue is only expected to grow by about 10% this year and 11% the following year. That's much slower than where it had been. So I think investors are a bit put off by that. I think it's had a lot more competition from hotels, because hotels have not just sat there lying down and taken the market share hit from Airbnb. They stepped up their game some, attracted some of those customers back, and for a lot of customers, a hotel probably makes more sense than renting an Airbnb, depending on how many people are with you, what type of vacation you're having, etc. So, and and Tyler mentioned the regulatory headwinds and all the various municipalities banning these short-term rentals. So, I would have liked Airbnb better, but I am a little concerned by that slowing growth rate. Although I still see some potential there. But looking at the valuation, it's trading at about 29 times earnings right now. It's not a record low, but that is historically low for a growth stock like this. So it's still one to watch. It just seems very frustrating because it never seems to gain any ground that it can hold on to.
Yeah, and I don't have any thoughts on Instacart, so we can punt on that one. And I see you have a question already lined up here, so why don't you go ahead and take it?
Yeah, excuse me. Shotgun Santa asked, the trade desk symbol TTD. Can you give me a summary of what they do? Stock hasn't seen this price since March of 2023. 16 Motley Fool Rex over this price. Why wouldn't we be buying now? Well, the short answer is I think you probably should start buying now. Again, like Tesla earlier, it seems to be in a free fall, so maybe you don't go exactly all in. But for those of you who don't know what they do, they help advertisers and ad agencies manage digital campaigns. And they've had a different approach to it than say an Alphabet, and plus they kind of have a neutrality that Alphabet wouldn't. If Alphabet's managing your ad campaigns, of course they're going to direct you to all the Google sites where Trade Desk has more relative neutrality because you have Meta in this space now, you have Amazon, you have a lot of others. So it probably the stock, and it has continued to steadily fall since that time. Just looking at the valuation, though, I think let me pull that. Bear with me a second. But I think with that, it might be time to start looking at it again. You're still looking at a PE ratio of 71, which for a growth stock, that's actually not high. I mean, it's high. It's high from an S&P standpoint. But then you look at the forward PE ratio, it's just 31. So considering the rapid growth it's enjoyed in the past, I think that's a little bit low here. I don't know when it's going to stop falling, but it will at some point. I think investors are going to look back and see this as a low price for the stock.
Another one of those. I can't help you on that one, so I'm going to move on. Swing for the fences. This was a question for both of us, and Will, I don't know how much you're familiar with Blackstone and other alternative asset companies, but Swing for the Fences 88 asked, what are your thoughts on Blackstone being down pretty big from recent highs? Current valuation overly pessimistic with the firm's opportunities is the question. So we just did an hour on Brookfield Corporation, Brookfield Asset Management, very much in the same vein, a large asset manager who has fingers in the pie in a lot of alternative spaces. So they do a lot of real estate. They do private equity for businesses. They have a private credit. They have an insurance arm. Basically, a lot of finding almost any way to inhale capital in some way and deploy it into assets in another is really the name of the game for an asset manager like a Blackstone. So the reason that I don't know if I can explain all of the reasons why Blackstone is down, but part of the reason we could say this is happening is, number one, we have seen Blackstone in particular has had this weird thorn in its side. They did it was kind of like, it was a private real estate deal that, anybody could get into. It was called BREIT, Blackstone Real Estate Investment Trust. It was a private REIT where, it had limited money in, unlimited money in, but limited the money coming out because it was investing in assets. It didn't have the liquidity of like a publicly traded REIT where you can just kind of trade shares when you want. And so they've had like liquidity events where people have been trying to draw out, and they've had to limit draws on this. And for various reasons, it was real estate. A lot of fears in real estate of higher interest rates, lower valuations for real estate, things like that. So the Blackstone has had like this, kind of little thorn in its side as of late. But relative to the rest of the business, this is a relatively small part, because this is a business that has, I think, at this point, more than $1 trillion of assets under management in these various entities that it owns. Why it could be down, number one, like I said, assets have valuations, and part of the it's funny, you hear all of these alternative asset managers saying like, oh, we got all this dry powder and we're seeing all these incredible opportunities because valuations are down. Well, the converse of that, and the thing that they don't say, well, if all the valuations are down for the rest of the market, that probably means that the valuations of the assets that you have on your books are also down. So if you for some reason you need to sell some assets, that it's probably not worth as much as you're currently valuing it on your books, which could be a little bit of a concern. I don't know if it's enough a reason for the stock to be down 20% year to date, but that could be a possible reason. Like we mentioned towards the end of the Brookfield conversation in the prior hour, higher interest rates means that a lot of its big institutional investors, the people that are buying the private funds, investing in the insurance products, the private credit, some of the things that we don't necessarily see in the publicly traded space, it's a more competitive market for those pensioners. They can go to a more diverse set of assets these days because interest rates are higher. In the United States, interest rates are higher in Europe. There are more viable assets that pension funds and insurance companies can go to meet their mandates without having to go to alternative asset managers who, through the 2010s, when interest rates were practically nothing, like they were the only game in town if you wanted to get some sort of yield on your assets that wasn't something as risky as publicly traded equities. For institutional investors, you really have to spread that risk around a lot more than just buying stocks all the time. So that could be a multitude of reasons. I'm sure I'm missing a few of them, but if you're trying to put a thumb on it, I think a lot of it has to do with that. But one thing Blackstone has proven in times past is when stuff starts to really go sideways in the market, they can do some really incredible things. They bought, I think it was like Hilton hotels, like somewhere towards the bottom of the Great Recession, and turned that into one of the most profitable trades of like all time when they sold it again. So Blackstone does have a history of doing quite well in these sort of markets. And so despite the decline in price, I don't know if I would buy it at 37 times earnings and a 2.9% dividend yield. I can't remember if it's a variable dividend or not, but it's certainly one that I want to keep an eye on. Oh, variable dividend. So 2.9%, it might be a little deceiving.
And like he said, like Tyler says, I have nothing to add there, so I will move on. About 4 hours ago, Ed asked, what is a better value today, Shopify or the trade desk? I just talked about both of those. I would probably have to say the trade desk here. It's been sold off a lot more aggressively. It, because Shopify hasn't sold off as aggressively, it might recover a little bit faster. But I think in terms of overselling, I would clearly give the crown to the trade desk. I think missing your own revenue estimate that isn't a good look. I'm not gonna defend that per se, but they were. I'll defend it in the sense that they were on top of that, and I don't think that's going to happen again in the future. I think the selling has gone a little bit too far with that one. It's been a lot more extensive with the trade desk with Shopify rather. So I'm going to say Shopify, or I'm going to say the trade desk in that case.
I'm going to ask a follow-up question.
Okay.
Related to this, because I'm going to add a third variable to this question. Shopify, trade desk, or maybe just sit on cash and wait for a little while?
That's a good question. I would probably lean towards sitting on the cash. Maybe just because trade desk has fallen so far, I might nibble on it here, put a little bit in, but I would mostly sit on cash right now.
That's probably where I would have landed as well. So I'm gonna hit this question from Kelly Theis Tice. I hope I got that right. Question. Oh no, I'm sorry. That's not the question I want to hit, because ANET is something I don't know anything about. Apologies, Kelly. I want to hit this question from SB because that's way more in my wheelhouse. SB asked, any thoughts on ticker BLDR, Builders First Source? This is a business that makes structural building components out of wood. That sounds a little ominous, but basically, like, I don't know how many of you used to work in construction, but if you've ever seen a pre-made roofing truss, there's a decent chance that Builders First Source built it. Or if you've seen like these, they're like pre-built structural beams for like laying down flooring or something like that are pre-made, pre-cut to length and stuff like that. Builders First Source is the type of company that builds this. So like if I'm on a job site and I'm building I'm putting on the structural elements to go from the first to second floor, instead of having to like custom build a piece of a stringer basically that will go to hold up the floor or something like that, where it's got to be a certain depth. I can use these composite pieces because it uses way less wood. It's way cheaper, but it's similarly structurally sound. It's similar to like look at a bridge with trusses and things like that. They basically build those out of wood, pre-built, and you bring them on site. It's fantastic. Anybody that's worked in construction, it's way better than trying to custom stick built all these things. So, and it's part of the reason I think why Builders First Source has been so spectacularly successful over the very long term. The 590 distribution and manufacturing centers across 43 states. So very, very prominent across the United States. Excuse me. It's in many ways, if you're trying to build quickly, you're going to bring in one of these composite built either trusses or anything like that, structural products. It's a revelation, in my opinion, from somebody who worked in construction 25 years ago. Why the stock has been down big? Because despite it being up 2,000% over the past 10 years, it is down 40% year over year. And it goes back to one of the big themes in construction, housing, residential, because Builders First Source is very largely tied to either single family home construction or like, smaller multifamily things like 2-3 stories, basically anything that's built out of wood instead of steel and concrete. The reason we've seen a lot of these companies down in this space is going back to the higher interest rates. As interest rates rose in 2022, it's basically like it was like just throwing a giant pile of sand in the gears of the housing market. These higher interest rates meant that people who had been buying and selling homes, especially during like 2021, 2020, a little bit earlier, where we had rock bottom low interest mortgage rates, a lot of people bought homes. So it pulled forward a lot of demand. And then when interest rates started to rise again, everybody got scared to sell their home because they were like, whoa, I have a decent mortgage. Maybe it's at 4.5%, 5%, but now today we're at like 6 or 7. It's harder for me to buy a home because it's harder to justify at these higher prices. And so it's been, like I said, sand in the gears of the housing market. And, construction rates have gone down both, multifamily had a nice boom year in 2022, 2023, but that's subsided. Multi or single family home construction has been on the decline for a couple of years now. Existing family home sales have, been some of the lowest rates that we've seen since like the mid 90s. So home renovations aren't really happening that much either. It really is a factor of the residential construction market that we've seen a big decline in this business. I wouldn't say it's like a structural issue with this business. I think they've been a fantastic operator for somebody who builds and distributes building products. It's had fantastic growth and good returns. Balance sheet wise, nothing is, setting off any alarm bells in my mind in terms of being able to cover its debt and things like that. So it just seems like it's a cyclical business, and it just happens to be in the midst of a pretty rough cyclical downturn. How long that lasts, I don't know. Maybe it's lower interest rates starts to, clear the sand out of the gears, or maybe we just all kind of eventually get used to higher interest rates because life happens, and we'll start to more slowly reintegrate into a more normalized housing construction and sales rate. I don't know which one is going to be the solution to it. Either one of those might take a minute for them to materialize, but that's kind of how it is when you're investing in cyclical industries. You're eventually going to get whacked on a downturn eventually, and sometimes in severe cyclical downturns, as much as you may have to hold your nose when you look at the stock and hit the buy button, sometimes that's the more attractive times to do it.
Yeah, that's the best time, in my opinion, at least in most cases. Um, T-Stock had a question for both of us that came in about 5 minutes ago. Tyler and Will, can you each name one big down stock that you're considering buying now? Well, I was considering the trade desk, but I can't buy it now that I've talked about it on the air, so that one might wait. I will say I did add some shares of AMD last week. Talking about stocks down big, that was almost $230 a share just just over a year ago. I think now it's in the 90s. So $99 a share at that range. I did add some shares there. So I guess AMD is a short answer to that question here. Although I did a couple of months ago, I also bought Celsius after that fell 75%. That's kind of more or less where I bought it now. But that's another one that you can look at as well.
So one that I've considered buying more of, because it's in my portfolio, but I would say is down pretty big recently. Unfortunately, I have to mention it because that puts those plans off for at least a few more days. Who knows? I mean, I'm on this show a lot. I'll probably mention it again, and it'll take me weeks to actually buy it because I'll have to keep quiet about it. But it's First Solar. Solar panel manufacturer, mostly to the utility space, versus it doesn't have a lot of exposure to like the residential market, a much more challenging market these days. I think utilities are pretty good. From its peak back in June of last year, the stock's down about 48%. It's been pretty rough for a multitude of reasons. Interest rates, political reasons. We can throw 15 reasons into the excuse soup and see what we can concoct here. But the thing that gets to me about this business, it is a cyclical industry, just like I was talking about with Builder Source. And despite it being in solar, everyone thinks of solar as a growth industry. It's a cyclical industry disguised as a growth industry because it does go through long periods of over and under capacity that you do have to pay attention to. Otherwise, you end up buying at the top, which is never great. But the thing that gives me a lot of confidence, despite it being down so much recently, is it has a massive backlog of orders. I think it produces right now, I think they expect to produce like 20 to 22 gigawatts of capacity in panels in 2025 this year, and they have a backlog of like 68, 69. I can't remember the number specifically, but it's somewhere in the mid to high 60s in terms of like gigawatt backlog. So it has multiple years of production backlog just sitting in orders that they need to ship out. So there's, even if we do go through some lull in the business, it has a pretty robust backlog to push product out to without it like drastically impacting sales. Its capacity is sold out. And this is how it typically goes. They're developing some new panels that looks like it's going to be a stepwise change in efficiency, which could make it a much higher addressable market. One of the big faults with solar has been, efficiency, like converting potential power at like 18% rate, which, doesn't look great. There's some of the things that they're looking at now could get efficiency closer to the 30% range, which would be a monumental step for the solar industry in general. And so I think with some of the technological developments that are deep in the bench, its operational excellence management has been fantastic, of always keeping a net cash position, never getting too leveraged or making very risky moves in terms of production capacity and things like that. With a business like this, I see big drops in the stock more as opportunities than as great risks, because it's a business that has more or less earned my trust. And so that's one that is down big that I wouldn't mind adding a little bit more to.
Okay, and Ed asked about an hour ago. I wanted to touch this question since we have about 4 minutes left. Does the market sell off have anything to do with the mindset of the Fed cutting rates? I would say probably. I don't think you're going to hear the Fed saying, "Oh, the market's tanking, so we're going to cut interest rates." They always have some other excuse like the economy. But if the market takes a downturn, you usually usually is a sign that interest rate cuts are coming. So that they'll never admit it, but I think that has a significant amount to do with an interest rate cut.
Well, I guess my two thoughts on this is, one thought is the Federal Reserve has two mandates. It's employment and inflation. Those are the things that it keeps its eye on. And if it can, tamp down inflation, it's going to jack up rates. That's what it does. If it needs to boost job creation, employment, it's going to cut rates. And so, the playing field here is if they think that they can, lower rates without raising inflation, then they'll do it. And so the reason that they're not cutting, they seem to be holding steady, is the concern that cut rates will raise inflation. So, and it's funny that you asked this question, that the sell-off has to do with the mindset of the Fed cutting rates, because I feel like for the past 3 years, or since interest rates started to go up, the whole conversation in the market is says, well, the market will rip when they start to cut rates. And it was the idea of like, we're going to get past inflation, they're going to cut rates, and the market's going to take off again, because lower interest rates means higher asset values. And so I find the question very interesting, because the thought of interest rate cuts now is a negative sentiment, because an interest rate cut would suggest weakness in the economy, that they need to boost employment and growth. And so I find it seems like a very, very hard pivot to the narrative that we've had from the past 3 years, where Fed rate cuts were going to be a catalyst of growth, to today, people asking if Fed rate cuts are a sign of trouble ahead. I don't know, just a casual observation on how things can change pretty quickly when it comes to macro and market narratives.
Yeah, that plays into it too. Just because there's a Fed rate cut does not necessarily mean investors are going to pick up on that and bid up stock prices. That happens. I think that happens more often than not, but it is certainly not a guarantee. I think we've had some interest cuts recently, interest rate cuts rather, and I think people were expecting more of an effect on the housing market than would actually materialize. So they try to do these things. A lot of times they succeed, but at the end of the day, the market is the market, and it will sometimes respond to those incentives and sometimes not.
Yep. And I think with that, looking at the questions, I think we may have nothing that we can really address here without going over our time. So I think this will be a relatively good time for Will and I to say our goodbyes. And we're going to bring in Andy Cross, Motley Fool Chief Investment Officer, and I believe it's Brian Orelli coming on in the next hour as well. Do I have it? Yes.
Correct, yeah.
So Brian Orelli, Andy and Cross are going to be joining us for recession resilient stocks, which is a nice theme to play off of after going from an hour of stocks down big. So looks like we've got a couple minutes left, and here we go. Look at that, top of the hour. Here comes Andy. Here comes Brian. Give you a nice long-winded introduction for both of you.
Good morning. Yeah, hello guys. Thanks, Tyler. Thanks, Will. Thank you for the great hour.
Enjoy the next hour.
Cheers. Have a great show. Hello, Brian Orelli.
Hello, Andy. How are you?
I'm good. I'm doing fine. Good to see you. Thank you. Thanks for joining me here today.
Yeah, no problem.
We're going to talk. We're going to talk recession-resistant, resilient stocks. Of course, Brian, I think as you and I have been through this, I think many times, no company is purely resilient from a significant drawdown. All stocks will pretty much get hit. But we thought we could take lots of great questions. Thank you for joining us here in Fool24. Take lots of great questions. Just talking about maybe some businesses building off the past hour that could maybe do a little bit okay if the markets are pulling back and the economy is starting to maybe slow down a little bit. So I think many of us are thinking about this a little bit. So please hit Fool24, get your questions in there, and we'll get through them as much as we can. Brian, any thoughts with, I thought, Brian, one fun way to maybe start this is just thinking about the kinds of businesses, qualities, factors that you might look for. We might talk through about what makes a company somewhat resilient or resistant from a drawdown, turn down in either the economy or the markets.
Yeah, I mean, I think in healthcare, generally that's where I invest and make my recommendations. And I mean, I think generally healthcare is fairly resilient because, of course, people generally need healthcare. But within healthcare, I think there's quite a few, things you need to think about for an individual company and whether it will actually be resilient in a potential recession. One is just the product. It's assuming the company has a product or is developing a product. Is that product elective or is it required? Right. So something like ELOS that has they have a Botox competitor. That's not going to be as resilient as something like a cancer drug, right? Where you're not going to take your cancer medication because there's a recession where you might cut back on your aesthetics products because there's a recession. And then, even within cancer, you have to be somewhat, especially if we're talking about short term, the sort of like severity of onset can have a lot of effects on whether a product is used. So like during the COVID-19 pandemic, a lot of people weren't going to their doctors. And so even like blood cancer companies ended up having lower sales because blood cancer doesn't get diagnosed as, like the symptoms aren't like you're in a whole bunch of pain, you're going to the doctor immediately, yeah. Right? There's sort of, it's sort of a buildup of issues that eventually the doctor starts, thinking, oh, well, maybe this is cancer. And then they go, but people weren't going to the doctor because they didn't feel that bad. And because it was COVID-19. And so, they knew they didn't have COVID symptoms. So they were trying to stay out of the doctor's offices. Right. And so the same thing can happen during a recession where patients that have, like, let's say blood cancers may not get diagnosed as quickly. Now, eventually, if we're talking about long-term, maybe it doesn't really matter because eventually those patients are going to get diagnosed at some point. But the downside is that if they get diagnosed later, they may have lower prognosis and therefore be on the drug for a shorter amount of time. So while they'll still eventually end up taking the drug, they may end up having lower sales per patient for that short amount of time when patients are being diagnosed later in life.
Yeah, Brian, I think you hit on a theme that jumps right to the top of my mind when I think about these kinds of businesses. And 307 Fool put in 3 great companies, and I want your reaction to one, because one jumped to my list is when I was thinking through stocks that I would consider and have recently is more a company like Vertex Pharmaceuticals. So companies that they have demand that is such that through different periods and different times are either required usage or will consistently have demand, even if the market or even if the economy starts to go through a little bit of a slowdown. And so I wanted your reaction. 307 Fool says PGR, which is Progressive, Berkshire, and Vertex would be some strong companies in a recession, in my opinion. Thoughts? Vertex jumped to the top of my list. What do you think about that?
Yeah, I mean, I think certainly for the cystic fibrosis market, people aren't going to stop taking their cystic fibrosis drugs. They clearly help patients live longer and more productive lives, and with less issues from their cystic fibrosis diagnosis. That they basically, I mean, they're not quite cures, but they're substantial increases in the lives of the cystic fibrosis patient. So they're not going to stop taking them just because there's a recession. Assuming and they can probably get medication out. If they lose their insurance, they can probably get medication outside of the normal insurance channels. And so I think that that's a very should be a recession resistant area. Now they have this new pain drug that's for acute pain. And so that would be mostly prescribed after surgeries. And some of those surgeries are going to be elective surgeries. And so those elective surgeries could, in theory, the number of elective surgeries could go down in a recession. And then therefore the number of patients that might want to get prescribed Vertex's new pain drug could also go down. But we don't have enough data on the pain drug because it just launched like in the last month or two.
Yeah.
And so we don't quite have enough data on that to see where, how much of the sales are actually occurring. So it's not clear, what a recession would do to that drug.
Right. And most of Vertex's business is tied to Trikafta anyway. So it's not.
Yeah, but I think the valuation has gone up considerably since the approval, and I think that's not due to the cystic fibrosis drugs. I think that's due to the hope that their pain drug is going to do well, and so that I think there's some built-in sales in that for that pain drug, and if the pain drug doesn't do well, because of recession or just because they can't capitalize on the potential market for the non-opioid pain medications, and doctors continue to prescribe cheap opioid pain medications that are available as generics for these acute pain indications, then it I think the stock could be overpriced at this level personally.
I don't know top of my head about the correlation between some kind of recessionary event and elective surgeries or surgeries. I imagine they're fairly elastic, so they would drop. I just don't know by how much.
Yeah, I don't know by how much either. I mean, we saw that with Intuitive Surgical during
COVID.
During COVID, but then I mean those diseases aren't going away, right? So yes, you can put off your surgery, but you can only put it off for so long, right? And you're usually putting it off because you don't have insurance that's going to cover it, and so eventually the patient eventually gets on insurance and did it. So the only time I've actually bought Intuitive Surgical was when I thought it wasn't priced right, and that was during the pandemic when it dropped because there was all these the surgery count went down, and it was like, well, these patients aren't going to go away. They're eventually going to need the surgeries, and so I bought it then, and it's been a nice return from there.
It's just been incredible, not just the rebound, but you can see. I remember following it just during that COVID period. You can see the number of surgeries dropped dramatically. Stock follows, and then as they started, things started to come back. You could just see the reaction from the business and from the stock.
Right.
So that's a great, just from a mental fortitude, time, just thinking through as we were let's just say potentially we are going into a little bit more further of a drawdown period in stocks or businesses like that kind of business. While it might take a near term hit because of options to not take some product or buy some product, the demand for that product hasn't gone away. It's just shifted. Right. It's basically just time shifted, right?
Right.
It just gets pushed out until hopefully there's a little bit better
Unlike,
time.
let's say, a Starbucks, right? If you don't drink Starbucks today, you're not going to drink 2 Starbucks tomorrow.
That's right.
Right.
That's
but
right.
if you don't have your surgery today, you're probably going to have your surgery down the line at some point.
Yeah. That's right. By the way, just very quickly, 307 Fool, I talked about Progressive and Berkshire, both tied heavily to insurance companies. I think insurance can be a good spot, and Progressive's done very well. A balance between brand, demand. They've grown their premium business. They grew 20% last year. They grew their premiums in force, very healthy. They continue to balance between technology and a brand and marketing spend. And they were very efficient in their underwriting discipline last year, and that really showed up. And so I do think, insurance is one of those things that you can cut your insurance, but it's not the wisest thing to do. And so I think that tends to be a little bit more of a sticky business. And one of those payments, while our rates have gone up over the past 2 years, sometimes dramatically, we're not going to see that going forward, probably anytime soon, I don't think. And that's probably a bill that you're going to continue to pay going forward. You might be a little bit more picky on choosing your different provider, but I do think that's probably a little bit of sticky. And Berkshire's, fortress-like balance sheet, and probably one. And that's why both Progressive and Berkshire, and even Vertex too. I was just looking. Vertex, Brian, is only 9%. Vertex is only 5% from its 52-week high. Progressive is 3.5% from its 52-week high, and Berkshire is 4.4% from its 52-week high. So all those businesses, if you think about the market, is down 9% from its highs. I talked about this in a show today, 9% from its highs. And the average stock in the S&P 500 is 20% off its 52-week high. All three of those businesses just mentioned have shown that kind of resiliency. And I think for the stock, and I think that's because the expectations that the businesses can navigate these markets pretty well.
Yeah, I think just the one thing about insurance is I think health insurance might be a different animal, only because most people are getting their health insurance through their employer. So if we're in a recession and there's job cuts that are involved in the recession, then they may go off the insurance rolls, and therefore the number of patients on the business may go down. But on the same hand, also people who are still employed may be less interested in going to their doctor for routine things because they don't want to pay their copay or whatever, and so then therefore the amount that the insurance companies have to pay may also go down. So it may be a wash. They may have less members on their less premiums coming in, but the amount that they're paying out in medical costs per patient may actually end up going down as well. So the net effect on the earnings is maybe washed out.
Yeah, and Berkshire and Progressive are much more closer tied to either reinsurance or P&C, the property and casualty and commercial lines, but less on the health side. But you're absolutely right, Brian, for that. Brian, any other factors that you consider when you think about these kinds of businesses that could be a little bit more resistant?
I think if you're invested in biotechs, what you want to do is make sure that biotechs that don't have drugs on the market yet. I think you want to just make sure that they have plenty of capital, because in a down market, you don't want companies to have to raise additional capital through secondary offerings. And I don't know of any biotech that's gone from IPO to being profitable without doing multiple secondary offerings, as selling additional capital, right? That's the whole business model. Is you IPO, get some capital, develop the drug further along, the valuation goes up, you raise more capital, higher valuation, so you don't dilute shareholders as much. Well, in a depressed market, that valuation is going to be lower, and then you're going to end up diluting shareholders more at that lower valuation. So you just want to make sure that they have plenty of cash to get to their next inflection point, and ideally a second or third inflection point in case one of those isn't successful, and then they can raise additional capital to continue to develop their drugs at a higher valuation and not dilute shareholders as much. And then the last one I'd say is just maybe consider going for picks and shovels in the biotech industry. So companies where the biotechs are the customers. So contract research organizations, lab supplies, that sort of thing. They are maybe more resistant because the biotech sector may be continuing to grow even if the stock isn't growing, and that would allow them to continue to sell more of their products or services to the biotech industry. The one downside, especially for lab products, is that those companies tend to also be dependent on academic research organizations, and if grant funding goes down, then that could affect them, even if the biotech industry itself is actually continuing to grow.
Yeah, and we're seeing maybe even a little bit of a double whammy with what's coming out of Washington on some of the spending. I was wondering about that because I follow and have invested in MedPace, which is tied to as a research organization, similar to I think Akiva as well. What is your set? Just a little bit off this topic. Where do you stand right now? Where are we in the biotech landscape? Is it? I know it's been challenging a little bit with the higher interest rate environment, but what are you seeing in the biotech landscape, especially when it comes to capital?
Yeah, the valuation's definitely been lower, and that's resulted in maybe less secondary offerings and therefore less development of additional drugs. So like a biotech might have would have normally had a phase 2 drug and then started to move a second and third drug into clinical development. If they're trying to conserve their capital, they'll only develop that phase 2 drug, or they might have in previous years, when there was a lot of capital around, develop that phase 2 drug for multiple potential diseases, where now they might go after the one that they think is the most lucrative, either on a risk reward basis. So either it's a big market, and so, or they think it's a lot very likely to succeed, and go just after that one indication, and then try to get a higher valuation, and then raise more capital, and then go after the second indication. So I think the contract research organizations are suffering a little bit right now.
Yeah.
There's still quite a bit of venture capital going into the market, and so those are most of the venture capital is going into preclinical companies, but they eventually turn into clinical companies at hopefully at some point down the line. And so and most companies are not being able to IPO preclinical anymore. I mean, that was a sort of a trend maybe 4 or 5 years ago. There was enough capital in the and biotech was such a big hit that companies were able to go public even with only preclinical pipeline of drug candidates. Now you basically need phase 1 going into phase 2 clinical data. So that means the venture capitals are promoting them longer, and that's because they still have capital, even if the public companies don't want to do secondary offerings. There's plenty of cash, I think, still in the venture capital from the venture capital funds, that they're providing capital to create some of these demand for clinical research organizations. But it does seem to be down a little bit. If you look at MedPace Holdings, they not only give what their revenue is right now, but they give their booked revenue for the future. And that was for the fourth quarter, that was down year over year.
Yeah.
So that says that in 2025, they're going to have some challenges to end up, their probably revenue is going to go down year over year. But I mean, I think this is it's a good company. It's going to be maybe a short term hit, but it's a very a lot of biotech companies use them, right? So it's not like their reputation is going to be hurt, even if there's just less clinical trials going on.
Yeah, I think so too. So Brian, you just mentioned like demand for the products, so the stickiness, the ones that are going to be in continued demand, balance sheet strength, control their funding environment, and then a little bit maybe picks and shovels, maybe a little bit less on the a little bit more on those that are supporting companies that may be in the biotech space. And I think outside the healthcare market, it's very similar. It's those products that are continued in demand, that are almost not easily given up. I think the protected margins is something I look for. Companies that can maintain those margins, if not continue to even boost them during tricky time, during difficult times. That's hard to do. You know, when revenues go down, margins you lose a lot of the operating scale. But if you can find that balance sheet strength is, I think, absolutely key to be able to maintain the balance sheet. And then I like to see a management team that can navigate the tricky waters, maybe proven before, or that I feel have the strength to be able to, you know, kind of get through those markets. So those are some factors that I think that are worth considering. And when you think about some of the businesses that we've just talked about, and some others, we'll talk about some other ones, we can put them through the test and see how they come out. Brian, Ed has a question about ISRG. That's Intuitive Surgical. Who is the biggest competitor, or is it a moot point where it's a losing proposition to compete against them?
I mean, I think it's a losing proposition to compete against them in their current indications, right? So they started out in prostate, and then they went into gynecology, and now they've moved into more general surgeries, and they have such a large base, and there's so many doctors that are already trained on the Intuitive Surgical Da Vinci system that I think it's really hard to assert them there. Where there's potential for competitors to assert them is in the places where Intuitive Surgical isn't being used. Their Da Vinci system and their new system isn't being used regularly, and they're certainly they're battling for opportunities for growth in those new indications. They're sort of somewhat dependent on the doctors themselves to develop those techniques. They're not the ones that are necessarily developing the techniques. It's the individual doctors that are going out, and they're listening to the doctors and giving them the right tools. They now have a new multi-port system. So instead of entering through one part of the body, it's got two arms. The arms can go into different ports, different areas of the body, and then that allows them to do surgeries that they wouldn't have normally been able to do on a single port system. And then they have the new system that's more designed, I think, for the heart. And so, I think there's room to disrupt them. And all the companies that I know of are like large medical device companies that are probably the most likely to develop them. And you wouldn't necessarily buy them just for that one medical device, because they're such a large medical device. They've got billions in sales, and they're starting from a small base on the one medical device. So like a Johnson & Johnson, I'm not sure you would buy Johnson & Johnson specifically for their ability to potentially disrupt Intuitive Surgical. But I don't think Intuitive Surgical has any, they've got a huge moat in the fact that they have all these trained doctors that aren't going to go out and try a new system, and get trained on a new system when they have a system that works perfectly well. The issue is when there's a new, when there's a surgery right now that's being done open, right, where they make a big incision and go in and do it, and now we're trying to do orthoscopic surgeries. Then that's when we're in that transition. That's where the opportunity is for companies to compete against Intuitive Surgical.
Yeah, they have that razor blade model, and you mentioned the training that they do, even during like medical school, just to get people into the Da Vinci system to be able to use those, is just really continues to be pretty impressive. Globus Medical, GMED is the symbol, is another one that does robotic surgery. They made the big acquisition of Nuvasive, and that integration is continually going on. I think it's actually going on, fairly well. From some of the numbers they reported, but that's another one that does some right. A little bit less.
They're specific they're specific in neuro, right? So and so far, Intuitive Surgical hasn't been into neuro. So,
yeah, I mean, Intuitive Surgical, the and this is one reason why I think the stock, holds in there. It sells at an elevated multiple every time, and it's earned that multiple over time. But it's really on a volume game. It's really if demand, because you mentioned, like, it's for whatever reason is going to fall off over the next X amount of months because of recessionary fears. That's probably going to impact. That will impact Intuitive Surgical, but that's not something that they'll push off. Patients are going to push off forever. They're going to come back when financially it makes a lot more sense for them. So I think that's the real value to Intuitive Surgical, and I think it is one that I think belongs on the list. And asked about CRISPR. I don't know if you follow CRSP closely, Brian.
Yeah.
But Ed said, "Do you think it's time to give up on CRISPR and deploy the capital elsewhere?" That's CRISPR Therapeutics, CRSP.
Yeah, the company has, they obviously have one drug on the market. It's Casgevy, which is partnered with Vertex Pharmaceuticals. They own 40% of it, and CRISPR Therapeutics owns 60% of the expenses. The drug isn't cash flow positive, so they're paying in 40% of the expenses. Eventually, they'll get 40% of the profits from that drug. The downside is that, I guess it's a one-time cure, right? So they've had to work through the issues with the insurance companies. This has been a problem for all, one-time cures, mostly gene therapies, and now this CRISPR-based therapy, where you're curing the patient, so you have to charge a lot because you're only going to get one payment out of the patient or their insurance company. And so that becomes a challenge in our current insurance company market, where patients are moving around to different insurance companies in different years, right? So if you have Cigna right now and you want to get this large, you want Cigna to pay this large payment, they're going to pay it, but then they don't get the benefits of you not having the sickle cell crisis and having to be in the hospital and whatever down the line, right? Because you may be on a different insurance. So I think eventually we're going to end up with some sort of pool system that's run by the government, where the insurance companies pay into a pool. The pool pays for the insurance, and then everybody's getting the benefit of these products in the end, right? I mean, eventually you'll get Cigna will get Aetna's patients, and Aetna will get Cigna's patients, and eventually it'll all work out. But there's got to be a way that the insurance companies are dealing with this, and it's been challenging. It's been a challenging environment for the insurance companies to figure out a model where they can afford to pay for these gene therapies and CRISPR therapies that are one-time cures that are multi-million-dollar price tags, without having the insurance assurance that they're going to get the benefit of that in the long run. So,
is that pooled approach being discussed? Is that like a viable option?
I think it's sort of being discussed in the background. I don't think that we're quite there yet, but I mean, I think it's the only
financially viable way. Is that what you're saying?
Yeah, I mean, it's the only, and so I don't know. Carl was mentioning that a lot of these patients are actually end up spending down they end up going on Medicaid, right? So they end up spending down all their income and the amount that they because they're oftentimes very sick, right? And so then they end up going on Medicaid. Right. Or Medicare if they're old enough, but typically Medicaid, and then the government ends up paying for it anyway, right? So the government is in their best interest to eventually to set up some sort of system so that these patients can get the insurance to cover it earlier. So I think it's going to happen eventually. I haven't heard it. I think there's too many other issues that lawmakers are worrying about that they haven't set it up yet eventually. And maybe we haven't also reached the number of one-time cure gene therapies. We're probably still in less than 10. And I think once we get, into the 20s and 30s of gene therapies or CRISPR therapeutics, that that are able to do these one-time cures, then it makes more sense, right? If there's just a couple of them, then it's sort of harder to do this idea of a pool. But I think once you get to it, there's got to be some level where then it makes sense for them to start talking about it and doing it. So
Fool says grocery stores, healthcare, insurance, auto insurance, dollar stores are recession proof. I think we talked about all of those except for the grocery store. No, except for the store. So dollar stores, grocery stores. It is interesting. Like we're starting to see a little bit of cracks even in some of the dollar stores. I know there's a question for me, maybe from from Matt about between Walmart and Costco. Sadaf asked about Walmart or Costco. I think Walmart is probably one that I would lean to right now. I've talked about Costco. I still want to own it. And hopefully I'll get a chance. Just want to get it. I think that even that great business is the valuation had been a little bit stretched, but I think we talked about health insurance, Brian, where it really depends on the payroll, on a lot of it on the payroll numbers. So depending on how those numbers, fare, I think could be the tricky part with there. I think dollar stores have been okay, but I do wonder with potentially increased elevated inflation if they and perhaps even if employment numbers drop, we're starting to see a little bit of lack of income generation from the employment numbers when it comes to the earnings power for a little bit more of the demographic that would be spending at dollar stores. Their pay is not increasing as much as in the past. So that could be a little bit of a tricky spot. But I think a company like Walmart, both Walmart and Costco, I think would be in pretty good shape, simply because of their scale. But I would probably tap Walmart at this point right now if I had to pick just one of those.
It's kind of crazy how long dollar stores have been able to sell things for $1, right? I mean,
yeah, I think so. Or some going up to like $5. Is that right?
Yeah. And I mean, as some of them, I don't know, when in my dollar store, there's dollar stuff and then there's stuff that isn't $1, right? But even then, it's still like sort of crazy that they've been able to, in such an inflationary environment, been able to keep things at $1. I mean, I know they've done things like lower the packaging size, right? So you're actually getting less per your $1. But it seems, I don't know, it seems like a crazy business that you would price things at one without, you'd name your whole company after something that you weren't able to change your prices on,
Yeah. It's, there's a question just popped in about TJX too. And just the ability to just source products so effectively to be able to maintain discipline on the pricing side is a real art, and the dollar stores have done it so well. And TJX has done really well. And I think from a shopping perspective, they'll do okay. I mean, again, like I kicked off the hour with Brian. I mean, if we go through these prolonged periods where there's just an economic slowdown, even if it's just, growth levels are just not as high as they used to be, it maybe not even a recession where GDP is going negative, but it's just a slowdown. A lot of businesses are going to be under pressure, and any businesses that might have done well and the stocks have done well and the margins got a little bit elevated, it's just those businesses, those stocks are just gonna, and that's what I think is hitting TJX, is just that the stock had done so well because the performance of the business had done so well, and even that business, I think the multiple is just maybe just getting a reaction to that in the short term, and that's what's impacting a company like TJX. But their ability and the dollar store's ability to source their goods from an inventory perspective, manage that inventory really well, find the products, work with the distributors. TJX does that better than anybody. Work with the suppliers, their buyers, and their buyer training is very effective. And that's a real secret sauce that I've learned just following it more recently with Tom, is TJX. And I just think it's probably more of a reaction to the stock price performing so well last year. Bestie's asked about Markel. I'll just quickly hit this, then Brian, take whatever you want. Insurance. What about Markel in a recession? The MF seems to have moved away from Markel for no clear reason. I think Bestie's one reason is we were just specialty insurer for the most part, Markel. And what they do kind of differently is they run a very active equity portfolio, unlike most insurers like Progressive and Kinsale Capital, those companies, which tend to manage their book and then manage their investments really with very safe assets, so they can pay off all their liabilities and what they own. Markel runs a little bit more like a Berkshire model, MKL, where they invest in equities. And Tom Gaynor, who has been there forever and kind of built and managed that book. And I just think there may be some questions: are they really effective at doing that? So in some places we kind of pulled back on the enthusiasm for the stock. But I do think they're one that, again, I think insurance companies in general will do okay. In some parts of the place where Markel operates in the excess and surplus lines, the more unique kind of prop parts of the market, there might be a little bit more willingness to maybe hop and look for other cheaper providers, other alternatives, to really being able to be an effective operator. That's where someone like Kinsale does really well. KNSL does that very well from an underwriting discipline property. They have very, very profitable underwriting operations. So I think they have the edge there. Markel will do well if they're taking advantage of cheap stock prices, and that does well for their investment portfolio over time. So I think again, I probably would put maybe Kinsale ahead of Markel in that spot. Markel's valuation, I think, is reasonable. It's not, I don't think, super cheap like it had been in the past at various points, but it's reasonable.
Kent asks about GE Healthcare. The ticker is GEHC. Does that meet a recession-resistant stock criteria? I think the one downside of GE Healthcare is that they're generally selling very expensive equipment to hospitals mostly. And if there's a recession, there may be a cutback on the ability of the hospitals to deploy large amounts of capital. They may want to hold on to it as reserves. And so they could, in theory, have some pullback on potential sales that that's a long sales cycle, sometimes up to a year between when they start meeting with the company, the customer, the hospital and
system,
when they actually buy the product, right? And so there's a lot of opportunities as they move up the chain of command on people signing off on the sale, for somebody to somebody to say, oh no, we're not gonna, we don't have
pushing it off, right?
Yeah, we don't have that in our budget, we can't do that. Now again, this is like Intuitive Surgical. Those products are probably going to get bought eventually, right? It's that they're, if you've got an old X-ray machine and you're thinking about buying a new state-of-the-art X-ray machine, but your old X-ray machine, works fine, but you have to, you're paying for whatever the service contract, and you want the newest model that has extra, widget, extra ability that the older model doesn't. You may put it off during a recession because you don't want to spend that capital. You want to hold on to that capital in case you need it for something else in the process of being, with the general process of budgeting for a hospital. But eventually, that product's that X-ray machine's gonna need to be replaced. And so if that's the case, then it's one of those things where you may be able to buy a dip in the stock and eventually end up with a better return compared to the general market from that.
Yeah,
dip.
GE Healthcare provides all those amazing machines, and they're getting more and more sophisticated. It's a little bit more of a low single digit kind of grower, Brian. It's not one of those ones like the super high growers, but they're very effective. It's a very large company, 40 billion or so. Company serves all over the world. I think 60% or so of their sales are in international markets. Have to see how that plays out, because they have manufacturing facilities all over the world. They have a lot here in the U.S. They have some in Europe. I think they have some in Asia as well too, to supply products to those clients. So we'll see how it all works out with a tariff. But that is one that also kind of jumps to mind as one that's like, oh, you know what? That might be a little bit in the whole context of stocks. A business like that might be a little bit more of a kind of steady one during rocky times. And if somebody, we had recently recommended it, and if someone wants to think about that kind of business for their portfolio, I think GEHC is a pretty good fit in that way.
Yeah, and even if they have a little bit of a slowdown, we're talking about a difference between 8% growth versus 6% growth versus something that's growing at a 30 or 40% clip, and it gets cut in half or a 3/4. That's a much steeper valuation change in the expectations, and therefore the stock is going to go down substantially more. So I'm not sure that, as we said, nothing's really resistant, right? Completely resistant, right? Your expectations that you can buy a stock that's guaranteed to go up in a recession, I think is pretty low. I can't think of one where I would be 100% this stock is going to go up during a recession. So you can expect that it might go down, but it probably isn't going to go down as much. And again, I think that there's a potential for a buy on the dip sort of opportunity for a company like that, where eventually those sales are going to materialize.
Yeah, thank you. Yeah, thanks for saying that, Brian. It's so true. There's just no guarantees in investing in general, but certainly, like as we're talking about resistant stocks during recession periods, even the greatest businesses will often fall. If you look at the history of corrections or bear markets, like very few businesses or stocks are spared during that time, and it's just usually can be a great opportunity to pick up a great long-term business for a long-term investor, a great business at a better stock price. Thanks for joining us, Fool24, Andy Cross, Brian Orelli. Thank you, whether it's you're watching us as one of our members here at the Motley Fool or on our streaming service and offering out on YouTube. Thank you for joining us at the Motley Fool. Let's see what else we got, Brian, here. A lot of great questions. Ed asked quickly, I'll just hit this one, Brian, jump in and take whatever you want. Are the expectations for Adobe too great for them to overcome, and will it just be an average to below average performer? Ed, that is there've been just lingering conversations and just concerns around Adobe, why they have so many great strengths and assets, especially in a market that just is there's so many newer offerings with generative AI. Like, how much is that really a threat to Adobe? And is it more of a once great software business, really revolutionary and disruptive in the marketplace, but just going forward, it's just going to be more of those kind of a middling kind of not a bad growth performer on the business side, but the stock generally is going to reflect that. And so it's basically probably going to grow at its cost of capital, or maybe its growth rate, if it's basically fully valued. And, that might be in the high single digits. And so it could be a money maker, but more and more, like, is this really going to have the qualities to make it a great outperformer against the market in general? And so a lot of thinking going about, and I haven't gone through the whole call last night and picked through the earnings. And I think there were some okay spots, but I just think the concerns around Adobe being one of those breakout kind of companies at a valuation that's reasonable, but breakout from the business side is just, there's more and more concerns around that. So I think that does reflect some of my thinking. Is it might be an okay performer, but maybe not one that I would want to overweight a portfolio in.
And Jose and I talked about it in the 7:00 hour yesterday. So if you want to catch that, you can check out that replay and get
any conclusions. Did you have any?
I didn't have any opinion, but Jose had some opinions. I don't want to speak for him, but I think I'm pretty sure he's a shareholder, and I don't know. I was half probably looking up my next question.
Well, I am too. I'm a shareholder too, and yeah, and I know. Anyway, yeah. So I'll go listen to that, and so just some questions on Adobe, and it's not like businesses can grow. and they can do fine. And if the stocks are fully valued, the stock basically grows at kind of its cost of capital growth rate, somewhere in that kind of range. And that those can be fine investments. But if you're trying to find stocks to beat the market, to outperform that the market is missing, and we're buying them at good prices because of the valuation and the stock prospects, I don't know if I'm quite seeing that in Adobe.
Bessie's asks, sort of like what to do now in a recession. Besides not doing anything now, what would you do now? What are the businesses you are looking at and think are opportunities to buy more or less of now? I mean, I think it's a hard because, we can't predict the future, right? So if you knew exactly when the recession was going to happen, I don't know, you could go to all cash and then, try to buy back in. But, I sort of predicted the pandemic decline. Like I got to the point where I was writing about it every day and the stock market hadn't reacted yet. And I realized that, okay, the stock market's probably hasn't figured this out yet. But I didn't sell any stock then, even after I realized that, because one, I could have been wrong. But two, I didn't know when I was going to buy back in. And I certainly wouldn't have predicted the recovery that we ended up having in the stock market after the recession. And I probably would have been, sitting on the side in cash, thinking, okay, well, we're up a little bit, but we're going to get another pullback. And, then, a month later, oh yeah, we're up a little bit more, but we're going to, eventually it's going to go back down and, be a U, more of a U than a V. And then I would have never bought back in. So I was happy that I just, held on to my stocks and didn't sell and didn't have that that puts too much worry on me, that I just don't need, I don't need that stress level of trying to figure out when to buy back in. And, and then of course there would have been the stress level between when I bought and when it started dropping, where it's did I make the right decision about, whether to buy? So I'm not sure that you can do much other than just buy good companies. And then, when there's opportunities like now, I don't think we're not currently in a recession, right? But the stock market is going down. So there's a difference between a recession and a bear market, right? Or a pullback, correction. So, I think in those instances, if you're like me and you're adding to your portfolio still, you're not pulling out of your portfolio, you're putting into your portfolio, it's a little bit easier, right? Because you don't have to worry about it. Just buy the companies that are on sale right now. And eventually they're, 5-10 years from now, they should be good buys if you make good choices here at this current valuation.
I think that's a great point, Brian, and thank you for making it, because I think many investors, especially newer to the markets, think that you can, oh my gosh, people are talking about a recession and they're talking about recession-resistant stocks. Why don't we just kind of get out of things right now, sit on the sidelines, patiently wait, and then when later on, go back in or go back buy this stock. And like Brad Gerstner was saying the other day on one of the financial media shows I heard him on, he's like, there's no one going to ring a bell that says, hey, now is the time. Okay, hey, we got the all clear. It's like a lifeguard at a pool where it's like, hey, Adult Swim, all the kids out of the pool. Now it's time to go into the pool. Great. We got the all clear. There's no traffic cop going to do that for us. And so having the stress, as you said, Brian, it's just very difficult to do because when people get out of things, they tend not to go back into them. And that's the big worry. And we saw that during the great financial crisis of 2008, 2009. So many individual investors got out of the markets and they just never came back in. And just think about, the market bottom on March 9th, 2009, and just between that time period and, to even 2015, all the way up to 2020 and the COVID crisis, loss compounding of earnings is just massive. And then when the things start to rebound, of course, people are like, oh gosh, I missed the bottom. It's too late to get in now. I'll just wait for another pullback, and then it just never comes. So mentally, I think it's very important to say I'm committing to be in the market as much as possible. This is the approach I'm taking. I might make some tweaks, like maybe, there's ones that I'm a little bit less confident on, maybe pull back in and use that cash to get ones at better prices that I either own or maybe I'm eyeing up. But for the most part, you want that capital. If you are looking at 5 years, anything less than a few years, that capital is generally, we say, is reserved for safer assets, because you're going to need to tap into it. And when the market does go through these drawdowns, corrections, bear markets, they can last. 2022 one lasted for 2 years or so before it rebounded back to its high. So that cash should be safely put away someplace. But if you are thinking out next years out, the more capital into the market tends to have worked out better historically, and I think that will still be the case.
And I have to say, just adding additional capital makes it easier for me to look at my portfolio and see that it's down, right? So I've gone through 3 or 4, bear markets now. And every time it's been it's a lot easier when you're putting in capital to know that yes, my portfolio is currently down, but I'm buying it at a cheaper price, and I don't need this money for, I don't need it. Back then it was 20, 30 years. So it really felt like a lot. Now it's, maybe 15 years until, I would be potentially pulling it out of the market. And so it's, there's still plenty of time for it to grow. And so basically you're buying at cheaper prices and better valuations. And that's going to help your portfolio in the long run by continuing to add capital to it.
Yeah, 100%. Bestie's asked about WSO. How will WSO fare in a recession, and how are they affected by this tariff war environment? WSO is the Watsco company. That's let me look here, $20 billion company. It does distributions around HVAC systems, ventilation, heating, those kinds of things for all kinds of just different facilities and buildings. And so that business should hang in there. You can hold back on that spending because it is construction related. So there might be a slowdown, I think, at that period. And certainly there have been times when Watsco's book of business has slowed down during challenging economic times. But in general, especially if rates are fluctuating down and starting to move a little bit south, and that starts to encourage a little bit more building, they should do well, because they do have that strong business of providing the services, the solutions, and providing the services. Now, from the tariff side, there will be some probably impacts there, depending. Again, we just don't know how the tariffs are all going to play out. I kind of take everything at its word that's been said, but I'm also optimistic that they will be able to work out some solution over the next X amount of months, hopefully shorter than longer. So they're going to be impacted probably a little bit by that, depending on their what they get charged for the goods that they have to sell into the solutions. So that's probably going to be an effect on them. But in general, I think Watsco and that type of business could be a good one for a recession, more on the recession resistant side.
So Ed asks about why not load up on Trade Desk, the ticker's TTD, at $55 and sell your underperformers. I don't actually have an opinion on the Trade Desk, except that it seems like a good company, and it seems like they had one. From what I've heard, from what I heard from other people who are more experts on it than I am, that it's it was sort of maybe a 1 quarter issue, and it was a change. They were having trouble having their customers change from one platform to the other, and that may be a short-term issue. I think I'd like to maybe expand this question to a more general. Should you dollar cost average down, right? If you have a company that you already own and it falls substantially, do you add to it? Do you just watch it? What are your sort of thoughts, Andy? And I mean, I would say I have generally not added to my losers, mostly because, in biotech, they're oftentimes losing for a reason. There have been some rare occasions where I thought that a company that I bought just got stupid cheap. Like for instance, Twist Biosciences. I bought it once. I bought a starter position, and it dropped. I don't know, maybe 80% or something. And I just thought it got to like stupid cheap level. And so I bought like, I think 2 more times, ended up quadrupling my number of shares. So I bought less, at the lower price, but I quadrupled the number of shares that I had. I bought like 100, and then I bought 100, and then I bought 200 or something, because it kept falling. And so now my 2 lower buys are up substantially, and because it's 3 times the amount of my higher one still hasn't gotten back to the level, the stock hasn't gotten back to the level of the first one, but my overall average between the 400 shares in this case is a positive. So I think there are opportunities when, and maybe if you think the trade desk is stupid cheap at 55, maybe it makes sense to add, and lower your cost basis, where, I think there's other companies that fall for a reason that is justified, and maybe you don't want to add at that level because the fall is just, the current valuation is now accurate for the fall, so.
Yeah, there's a little reflection. Yeah, Brian, there's a little reflection on like, was that first one, like, that I maybe stretched in a little bit. The valuation was a little bit too high, and I kind of got excited, for whatever reason. But looking now, the business prospects, again, looking at the next 3 to 5 years, they still look bright. Maybe there's macro factors that could impact that, but those expectations still look very attractive. And now I'm just paying a better price for that. In the trade desk case, like you said, like moving to Kokai, that transition was a little bit rough. They went through a restructuring at the end of the year. They go through annual restructurings anyway. This one was a little bit larger, a little bit more complex. They just announced the hiring of a new chief operating officer just today or yesterday. I think they announced it. So and it was the first time they had ever really not hit in, I think maybe 4 or 5 years, really never, ever reach their own guidance, their expectations for earnings and revenues. And that was so that I think that was a little bit market shock to the market. And plus the valuation, as we talked about, and wrote about, like, it was just getting a little bit more and more stretched when you started seeing these great businesses get to, 20, 25 times sales like that. So I have not added more to my trade desk as it fell. And I said on the day or two when a stock dramatically falls like that, I kind of like sit back and just let things unfold. Brian, I'm not opposed to building out a position maybe a little bit later, adding to my position, lowering my cost basis, all of that logic, maybe building back up my position to where I want it to be at better prices, all of that. But on the day or two it happens, I always sit back because I think sometimes there could be like some other shoes to drop in the next couple of days. Analyst ratings come out, like, now they downgrade, this to a outperform to a market perform, and the stock sells off a little bit more. So I just kind of sit back and breathe and digest the news, and then kind of like go back and think about it. And I think, buying the trade desk today, I think will ultimately work out okay. I think they still have a great leading position, but I'm cautious on adding and doubling down or tripling down too much on ones that have fallen dramatically, because as you said, Brian, even you said for biotechs, but it could also be for other businesses too. Maybe the business isn't quite as strong as I at first thought, and I don't want to throw good money after bad.
Yeah, and I think that idea that there's the other shoe dropping happened to me with Twist Biosciences, where there was sort of a maybe a bad quarter or two, and they were the business wasn't growing as quickly as it had been in the past, and that that caused the stock to go down. And I didn't buy then, and then there was a short report that slammed it even harder, down, and that's when it got sort of what I thought was stupid cheap. And so then eventually, after that sort of calmed down, it's like then I went ahead and bought. So I wasn't following your advice, but I think it turned out I think your advice is pertinent to that, that at least what I ended up doing. So.
Yeah, and I've also seen stocks rebound like a day or two later. So I've been wrong at different points. This is my personal belief. And again, I think part of this for individual investors, especially again for those who have maybe joined the markets in the past couple of years and have yet to go through just different big downdrafts. I think emotionally, we're emotional creatures. I think it's important for us to kind of respect that and say, okay, well, just sit back, let things kind of unfold. It's already emotional enough seeing your stock fall 35% like Trade Desk did. And then kind of reflect, go back and kind of rethink. So I think that's a personal preference of mine. I have added to ones that have fallen. I just try to give it some space as well. Bessie's asked, anything stupid cheap yet? I don't know, Bessie. Brian, I don't think so. Stocks have done so well the last 2 years, since that low of 2022, really. And they climbed back through 2023, got back to the 2022 highs in 2024, performed so I still think I'm not quite seeing the stupid cheap yet. I think there are some reasonable ones out there that have gotten hit pretty unfairly over the last, maybe even some higher quality ones. But I don't know if you have reflections on that before we pass it over to Danny and Jason.
Yeah, no, I mean, I think that, in biotech, sometimes there's overreactions. Like if you look at Viking Therapeutics, nothing has really happened. And the valuation is about, maybe 50% of what it was at its peak valuation. And they certainly haven't had any bad news. So if you assume that the valuation at the peak was reasonable, then the pullback seems unreasonable, right? So, it does seem, it's sort of maybe getting into the stupid cheap level. I think that the downside is that you could argue that some of that valuation at its peak was due to the fact that people thought it was going to get acquired, right? And that's never a good reason to be investing in a company, is that I think it's going to get acquired, and so I'm willing to buy it at any price because it's obviously going to get acquired at a higher price. And so I think, if you assume that that's the case, then maybe it's not maybe it's not stupid cheap now, it's just regular cheap. So
well, regular cheap's good too,
right?
Regular cheap could be good too. I think and even trying to wait for stupid cheap. I'm not trying to wait for stupid cheap for Costco. I don't think it'll ever get super cheap. I don't think it ever did. I just want it maybe a little bit more reasonably priced than 50 times earnings.
Right.
So, but when super cheap comes, that could be, pretty not so bad. Brian Orelli, Andy Cross, Fool24. It's been great, Brian, talking about recession resistant stocks. Of course, like we said, no stock is immune to these big drawdowns, and as investors, we have to continue to invest through them. But we do think there are some businesses and qualities we talked through that might be ones to look at and consider for portfolios that are looking for a little bit more of that kind of stock. And we're excited to continue to bring through conversations to help all our members and our viewers on YouTube to be able to navigate waters that might be a little bit choppy in the days, months, and even years ahead.
Yeah, this was a fun hour, Andy.
Brian, any other final reflections before we turn it over to? I think we're turning it over to Danny and maybe Jason.
No, I think you hit all that. You summed it up quite well.
What do you mean? What do you mean? Maybe, Jason?
I didn't know who it was. Jason, I did not mean. I hope I did not cast any insult your way.
Looking over my shoulders, like, is there an email I missed here? What's going on?
Sorry, I didn't know. I just didn't see. I saw Danny pop up, and I wasn't sure if Jason was coming behind him or not. So, well, that's great. Well, now you're in some great hands as well too, along with Danny. So, thank you, Brian, and thanks for joining us on Fool24 for the past hour. Jason Hall, Danny Vena, take it away.
Thanks, Fools. Hey, Danny.
Jason, how's it going?
I'm very good. I'm wonderful. I'm excited for the day. We have a planned topic and we have a planned guest that we're still waiting on. In the meantime, I think it's a good opportunity. You can set the stage for who we anticipate that we're going to be talking to. But before I hand it over to you, just want to remind everybody that's watching, we're going to try to take questions too. And it's good for you to know how to get those questions to us. If you're a Motley Fool member, I'm sure that you know. If you're watching us on YouTube and you're just joining, maybe you've never done Fool24 before. We use Slido. Go to slido.com. The event code is Fool24. Since we're taking questions from people watching on YouTube and members of the Motley Fool behind the paywall, we use Slido to have one good place to send those questions to us. I also want to note, Danny, it's important for anybody watching to remember, if we answer your question, we're not telling you what to do. We are not providing individual or personalized financial advice. So please remember that for a litany of reasons, that's not the format that we have here. We're happy to weigh in and give our insights and opinions, but just remember it's not personalized or individual investing advice. Okay, Danny, what's our plan for today?
So I am excited to announce that we will be interviewing Federico Sandler, who goes by Fede. He is the former head of investor relations for Latin American giant Mercado Libre. He's also the former investor relations officer of New Bank. I'm going to read a little bit of his bio here just to give you an idea. He's based in Buenos Aires, Argentina. Prior to his role at Mercado Libre and New, he worked in private equity at a local boutique firm focused on M&A deals and the acquisition of debt financing in oil services, utilities, and renewables in Argentina. Before that, he served as an associate director at Fitch Ratings, where he was responsible for performing credit ratings at public utilities and integrated oil and gas companies, as well as infrastructure and project finance transactions in Argentina and in Uruguay. He holds a double major in economics and finance and a master's degree in corporate finance. I'm happy to say that over the years, I have been able to chat with Federico numerous times when he has come on the Motley Fool. He actually has a little bit of a history with the company that I will let him address once we get him on. I think we're waiting for him to chime in here pretty soon. Once we get him in the studio, then we will bring him on. While we're waiting for Federico to join us, I wanted to share that I have been an investor in Mercado Libre since shortly after the Motley Fool recommended it back in 2009. I bought it probably a month after the recommendation, numerous times since then. That first recommendation, now I hear a lot from folks who are concerned about investing in Mercado Libre that, but what about all these issues? There's hyperinflation in some countries in the region. There's political upheaval. There's economic challenges. Despite all of those things, since 2009, Mercado Libre stock is up more than 9,000%. So, that's kind of a testament to the fact that the company has been able to insulate itself somewhat from all of the potential issues that might drag the company down. So that's something I'm pretty excited about.
I want to add there too, and maybe I want to be sure it's not coming across as pounding our chests, but more of celebrating the successes, and maybe the most important thing, demonstrating in reality how time and wonderful companies with very big markets to grow into is kind of an investing superpower, right? It's a way that we can really create tremendous wealth. And the reality is we're all going to make bad investments too along the way. Nobody's got a perfect record. And investing in the Mercado Libres of the world, not only do you get those wonderful wins, but they help the losers become irrelevant and make up for the mistakes that we make along the way. I also bought Mercado Libre pretty early too, probably 2009, 2010. But I sold that initial investment in 2012 to help buy a house. It was up, and the timing made sense to use that as part of the down payment. The longest held shares I have, Danny, April 2014, and they're up, around 2,300%. So those have done pretty well for me. I have some other shares that I bought around the same time in another account that have done well too. And it's amazing the wealth creation from that. Well, that's enough about us and our investments. Let's let Fatty Sandler talk a little bit here. Hey.
Hello. Hey, guys. How are you? Sorry about the delay. We got an issue with daylight savings, which I wasn't aware about because in my neck of the woods, we don't do that. So fortunately, I was at home and I saw your email right away. So it's a great pleasure to be here, guys. How are you?
We're glad you're here. Now, it's interesting, too. Arizona, I believe it's Arizona, does not do daylight saving time. And one of our members who's a regular watcher, John Gallegos, has had the exact same problem, but he's watching. He's not on camera, so it's a little bit different. But you're
You'd be
here.
surprised how many times. Yeah. No, thank you guys for the time. You'd be surprised how many times it happened to me while I was at Mercado Libre and Nubank with the daylight savings, and like all my meetings would get like completely messed up. So I'm sort of used to it.
And we are very happy to have you here. Right before you came on camera, I went ahead and read the bio that we had that you shared with us. And I think we just wanted to, kind of get started. Could you tell us, our members, a little bit about your history with the Motley Fool? I know that you have a little story that you have told us before, and I think that's a great story.
Yeah, so basically, I have a finance degree. I studied in Boston at Bentley University, and I remember, reading with a lot of admiration all the reports, including Mercado Libre's report back when I was in college. And I had like this full circle moment the first time Danny contacted me to be a panelist at the Motley Fool. So it's been a place that I hold very close to my heart. And although I don't do this often these days because I'm busy doing other stuff, I'm always very happy to join Motley Fool and just talk about fintech and e-commerce, which now, before it was my day job, now it's a hobby. I still do a lot of work on it, but yeah, that's how I ended up in the Motley Fool. I'm really proud and happy to be here.
Well, you've definitely been an asset for us, that's for sure.
And hope I continue to be, because I still do my homework, so I still have a lot of stuff that I can articulate and open eyes about.
I love it. Okay, Danny, how about you want to kick us off with some questions we have for Fede? Yep, you're muted, bud.
I was actually looking at the list of questions as you were speaking.
Perfect.
So, Fede, as the former head of Mercado Libre's investor relations, I know that you're a big bull on the company and its future. So what do you think the company's biggest opportunity is right now that investors are estimating?
Look, I think it's underestimating. Yeah. So I think it's around the fintech piece. Okay. So the biggest fintech opportunity that investors are underestimating lies in the potential for both Pago and Nubank to become some of the dominant digital banks for the underbanked and for the small and medium-sized businesses across Latin America. And it's important to put into context the scale of this underbanked, unbanked market. So Latin America has a population of roughly 660 million people, of which like 50% are around adults, so it's 120 million, and those are unbanked, and these are according to projections from the World Bank. But what I think where I think they're underestimating the power to become one of the largest digital financial service institutions is, number one, in this ecosystem advantage that Mercado Libre has, and I'm speaking about Mercado Libre specifically. But basically, unlike standalone fintechs like Nubank, which has a very strong, and we can talk about a customer acquisition engine through word of mouth, Mercado Libre has a huge marketplace, and it has a logistics business and advertising divisions. So it provides a 360 view of a user and its behavior. So it encompasses buyers, sellers, merchants, and it really encompasses the company to do very precise credit risk assessment. As of Q4, I believe they have like $5.2 billion of a credit portfolio, which contrasts with Nubank's, which is like more than double that, right? Mm-hmm. So that is really important. Another thing that's really important is the regional breadth, right? So Mercado Libre operates in 18 countries, its key markets being Brazil, which is about 52% of the revenue, Mexico with 20% of the revenue. When I left Meli, it was 10% or a little bit less. And then it's growing like gangbusters, way faster than GDP. So the regional growth is really important. I think the fact that Mexico has some particularities that Brazil had 10 years ago. So a significant personal population, unbanked, underbanked, a progressive central bank that wants more competition. So I think having this regional breadth makes them a very important player. And I think investors, in a way, underestimate that part of the business. Also, I think the part of the profitability is important to highlight. So I was doing some back of the envelope math before I came online, and I was seeing that actually Mercado Pago, per Itaú, a report of Itaú, holds a 7% share on Brazil's acquiring market. And basically, if we just take the PE of Mercado Libre, which said 62, the forward PE is like 62 times. It's roughly half of Amazon's. I think you may be missing a significant part of the story, because if we look at if we just use like a multiple of 11 times, which is fairly conservative, and we know that Mercado Pago had $8.8 billion of revenue in 2024, then that gives you a valuation of about 50 billion. So it's like roughly half of the valuation today, you could argue, is composed of Mercado Pago. But the argument that I make today, and that I spoke with Danny like the first time we spoke, is increasingly, because of the size of the addressable market, because of the pain that Latin Americans have in adoption of financial services, and the particularities that both Pago and Nubank have around the cost of acquiring the customer, the cost to serve that customer, the cost of risk of that customer, and the cost of funding that customer, position them to really be the de facto digital bank of Latin Americans, both Nubank and Meli, because they have very similar particularities, although Meli has a marketplace that Nubank doesn't.
I want to, Danny, I want to build on something Fede was saying there that I think is really important. Thinking about the payments business that both of these have, and specifically thinking about Mercado Libre. I watched an interview that Marco Scalpron did, the founder of Mercado Libre, during the pandemic back in 2020. I can't remember who he did the interview with, but he talked about the payments business, and he talked about his history of founding the business from the beginning, and the idea of building an e-commerce business in economies that are, at the time, where even the percentage of unbanked and underbanked individuals was far higher, right? Far higher. So you're building a business for people to buy stuff on the internet that don't have access to the internet and don't have a way to pay you on the internet. And of course, that led to the creation of Mercado Pago, and as necessity, right? You have to build the mechanism for people to get money to you, and
safely. Because what's very interesting that
right. That's exactly the question I wanted to get to is do we as investors, when we think about the risk of investing in Latin America, and we say Latin America and North American and European biased investors, we do the same thing with Africa, and we take these multiple dynamic countries with different markets and different regulatory environments, and we just call them one thing. But thinking about my question is thinking about Latin America as an opportunity to continue to push forward with the growth of opportunity to be the digital bank for so many more people. Are we undervaluing the trust aspect? You were talking about being able to do it safely, because we know that the amount of dollars that move across Mercado Pago that are unrelated to Mercado Libre are larger than the dollars that are related to Mercado Libre. So I'd love to hear your thoughts about how do you evaluate it, and do you think we're missing the opportunity?
Yeah, I think especially investors that maybe are not so familiar with the region, I think they might have underestimated what a good job Mercado Pago has done over the last 6 or 7 years, especially improving the brand equity of the business outside of the marketplace. So when I started at Meli in 2015, the payment volume on platform was multiples that of the off platform. Online payment volume was basically just online. You didn't have MPOS devices. You didn't have a wallet. You didn't have any credits through the mobile app. So more like a Nubank feel. And what's happened, and this has been accelerated by the pandemic, is that more and more users have been more willing and able to leave their existing financial services that they use with banks, because the digital experience is not so good. And what the pandemic sort of broke around, and we spoke offline with Danny, is that, and this I experienced this at Nubank, but it's very similar to Meli, is before the pandemic exploded, the biggest gating factor for people to adopt a Nubank or a Pago as a main banking relationship was because you don't have any branches. Okay, so in Latin Americans' head, pre-pandemic, having branches was very important to making sure they felt very good about where their money was. Now, after the pandemic, because both Nubank and Meli are digital native companies who are, technology first, they're fully vertically integrated, they can manage significant scale. Most of the bank apps in my region sort of imploded. And after the pandemic, the reason because you don't have any branches went from reason 1 to reason 7. So increasingly Latin Americans not only have leapfrogged from having nothing to a computer, but what the pandemic has enabled is this trust in giving more of your relationship to players like Mercado Pago. So even in an instance, and I spoke with Danny about this, where GDP contracts and people maybe make less money, there's such a strong shift to online consumption and usage of online digital financial services that it's sort of a tailwind against the macro headwinds. So in spite of the economy contracting, you can still see businesses like Nubank or Pago growing, at a very fast pace for a very long time, because they are serving better the existing people who have maybe a checking account, and then they're penetrating into regions where banks simply can't touch for the one reason that they have branches and their cost to serve is so high that it doesn't make sense to go chase a customer that has $50 to deposit. So it's like a paradigm shift that mobile technology enabled, and the pandemic sort of accelerated it.
So, Fede, I wanted to take a step back for a minute. So, the way we describe Mercado Pago to our users is similar to PayPal, but maybe you could explain to our members some of the nuts and bolts of how Mercado Pago works and how the service has kind of evolved since the early days.
Yeah, so it was inspired. Basically, it's very true what you say, Danny. So eBay was a 20% shareholder almost of Mercado Libre until 2016, when they had PayPal bolted in, I believe. So a lot of the initial inspiration around payments, around payment processing, fraud prevention came from PayPal. Now, I think one of the things that make Meli a very special business is that they are a global-minded business, and they are able to tropicalize a lot of things that they see globally beyond the US, so India, China. And around 2016, the management, the Pago management, they flew to India and they saw what Paytm was doing, and then they flew to China and they saw what Alipay and Tencent was doing, which is the two payment apps. So Alipay, and I can't remember the other one right now. But basically, what they realized is that there is a significant segment of the population that is completely unserved, and that you have a lot of information from these customers, and that you can move beyond just processing online payments to physical payments with QR codes, with MPOS devices that are a lot cheaper than what the acquiring banks were providing to the large establishments. So basically what Mercado Pago is today, it's a financial services hub for retail, so for individuals, where they can do credit card, personal loans, they can do checking accounts, so a whole banking experience. But it's also moved into banking the SMEs with loans, with cards, with insurance. So, but what they basically are moving from is from a PayPal, I guess, 1.0, where they process payments online and then to offline, to a full suite of financial services that had a lot of verticals. So you can basically insure your car through Mercado Pago's app. You can take a loan. You can ask for a credit card. You can get a personal loan. So they're basically becoming not only the go-to place for buying stuff, but the go-to place for banking. And by the way, they've also started to get the banking licenses so they can actually take deposits. It's not the case in Argentina for some reasons, but they already have a banking license in Brazil, and they've already applied for a banking license in Mexico. So it's much more than just payments processing. It started there as a way to reduce the pain and improve conversion rates, because what happened at the beginning, Mercado Pago in the marketplace sort of operated as an escrow. So if I buy an iPhone and you send me a rock, Mercado Pago could hold those funds and deal with the situation and return you the money, right? Before Mercado Pago, there was less trust. So basically, as Mercado Pago penetration increases in every country where they are, which it's already encroaching into 100% everywhere where they are, the conversion rates and the repeat usage increases substantially because fraud prevention, fraud reduces, the experience is better. But I think they've been very forward looking into seeing, okay, no, Mercado Pago has the condiments to become one of the largest, if not the largest, digital financial service institutions, which is what they're aiming today in Latin America, not only in Brazil.
Mm-hmm. So when I look at businesses like this that have optionality to be able to grow, and they've built a front-end payments system and some of the back-end things now with offering additional financial services, they expand that. One of the things that we saw a couple of quarters ago were some signs of weakness. We saw a little bit of an increase in the default rate and a little bit more risk in the credit portfolio. And as you start talking about this plan that they're executing on to actually become a bank and become licensed in the different markets based on the regulations in those markets, and I think it's an advantage that they know the markets they operate in. But running a tech forward, move fast and break things e-commerce business, and even the payments platform is very different when you're a lender and the way that you measure and manage risks. So that's been, to me, one of the bigger risks that I see. So two questions. First question, help, and you've answered a little bit with the data and some other things that they built to help them kind of measure risk. But I'd love to hear you talk a little bit more about how you think about that risk, and also maybe what do you see is maybe the biggest risk or some of the bigger headwinds that Mercado, and also new for where they're going to overlap with their businesses, some of the bigger risks they're going to face.
Yeah. So it's very accurate what you say. No, one thing is moving into the e-commerce business with no balance sheet risk. Another is beginning to use your balance sheet, take deposits, be regulated. We know credit is dangerous, but I think here what differentiates, I think, Pago and both Nubank, it's a couple things. So and this applies to both companies. I think you have very responsible management that understands that some of the largest profit pools in Latin America are around credit, right? And you have basically you lead both Mercado Pago and Nubank in the 4 pillars of digital banking. Call it whatever you want: digital wallets, digital banking, fintechs, whatever. First of all, you need to lead in the cost to acquire that customer. Okay, Nubank's cost to acquire is around $6. About 80% of its customers comes to word of mouth. This is a very low acquisition cost, similar to that of Meli. Because Nubank and Meli have no branches, their cost to serve is very low. It's less than $1 per customer, right? And their cost of funding, because they have the regulatory licenses, is very competitive with the banks. And then where you worry about, which is especially in the cost of risk or the defaults, right? The NPLs, is unlike other fintechs, Nubank specifically, but Mercado Credito as well, started with consumer credit because consumer credit is at the core of its business model, right? And like I said, the majority of the economics of the TAM in financial services rely in consumer credit. Now, what they have is a proprietary credit underwriting engine that is self-learning and benefits for increasing scale. So there's two things happening with Mercado Credito's business having higher default rates at the start. So number one, when you start with credit, especially in cohorts that you have no income information and you're basically penetrating the bottom of the pyramid, simplifying things, you're grabbing, let's say, $500 and you're lending to 5 people. If that guy pays you back, then you increase the credit line. For the other 3 that don't pay you back, you basically send it to a loss. So in the initial cohorts, when you start lending, your NPLs tend to tick higher, but that normalizes as you have data from them. And we're seeing from the data at Mercado Libre that is occurring. That is number one. But there's another one that I think Wall Street and some Brazilian investors still don't grasp very well, which is in US GAAP, you have a accounting norm called expected credit loss. Mm-hmm. And in Nubank, you have an accounting norm called IFRS 9, which is different from the bank GAAP, the accounting principle. So banks provision, for the most part, in 99% of the cases, as incurred. As you incur the losses over 90 days, you go provisioning. Nubank and Meli, because they are subject to US GAAP and IFRS, they actually have to go through a very complex actuarial calculation that takes into consideration macroeconomic growth and many other variables. So it's very likely that because you have a fast growing portfolio and the economy is sort of going south in some of our countries, you're provisioning more than what you're actually going to get.
Because you're having to project your provisions, or you're projecting. And that's what we see with U.S. banks versus in arrears with, right. Okay. Got it.
But so when I see compression of the gross profit margin because you have more provisioning, is these guys are pressing the gas and the accelerator on the credit. Is just a temporary drag on the margins, but eventually this is going to turn from a drag to actually a tailwind. But it's very important to understand this, because I think that's where investors are a little bit less comfortable. And quite frankly, I don't think there's two other businesses in Latin America who have as many data points from a consumer. So Nubank and Meli are able to shift your credit line based on your consumption, your immediate consumption pattern. So let's say you and me make the same amount of money and we get the same credit line, but I Ubers, I go to the supermarket, I do responsible spending, while you got fired and you started going to bars and doing risky expenditures. What happens? No, but it's true. This is all through machine learning and AI. Basically, the credit line of your credit line will increasingly reduce, and mine will increase. And when you compound that exactly, and it happened to me both with Pago in Argentina, with my behavior when I started using it more and more, and it started offering me more and more credit lines. And in Brazil, it was super interesting because I'm not Brazilian, but I was an employee of Nubank. So they made me a social security number so that I could have an account. And I basically, because what made me a good IR is that I basically know how to describe the business, right? To describe the business, you need to understand the product. So basically, long story short, I traveled to Brazil for my vacation when I was IRO of Nubank. And basically, within a week of me spending with Nubank, I got, like 300 reais, 200 reais of incremental credit limit from zero. So that's how smart the systems are. So that's why, that's why I think when I think about moats, right? What is Mercado Libre's moats today? Absolutely the logistics network. Absolutely.
Right.
But in the future,
competitive entry, and then the data and the analytics for the payments and the digital banking.
Exactly. So the second moat of Mercado Libre is going to be the underwriting engine that Nubank has today. They are the NASA of credit underwriting. So I am pretty comfortable with that. In terms of risks, I've been very consistent in this. I think both Nubank and Mercado Libre have three risks. Number one is competition. Okay, so you never know what the neighbor is going to do. We don't know if Mr. Bezos, although it's increasingly less likely that it'll happen, will dump billions and make the market very, irrational. But competition is a factor, right? Both for fintech and commerce. Then you have the second risk, which is execution, not minor. You are driving a Ferrari in a road that is like this at 200 miles an hour. That is mitigated because you have the most competent and most engaged management at both companies. And then number three is regulation, right? So both of them operate in regulated businesses. And although both Meli and Nubank are on the good side of the regulator because they are the lowest cost producer and they're generating an amount of financial inclusion that has never seen in humanity, you have had some, in instances, for example, in COVID, with some left-leaning ideas like let's make banks, charge no interest, or a specific something specific that could occur from a regulation standpoint. But I'm pretty comfortable because the level of financial inclusion that both Nubank and Mercado Libre are generating in Latin America, they're increasingly becoming more and more friendly to the regulator, because the regulator is seeing for the first time in history how with mobile technology and basically software, you can begin to formalize and bankerize entire segments of the population who were in the fringes. Brazil is a perfect example. I haven't seen one single paper bill in Brazil since 2016. So 17, sorry, one.
That's awesome. So you're talking about things that are going to help supercharge and drive the economy forward.
Oh yeah,
Regulators
because for example, let's exactly. So for example, Brazil, which is I think the most progressive central bank in the world, PIX. Basically, Brazil, the Central Bank of Brazil built PIX, which is basically rails that are alternative to the banking rails, which is free, immediate, and basically every bank and financial institutions needs to be plugged into it. What happened is that once PIX was made mandatory in November 2021, the institutions that were the quickest to get PIX keys from their users, who was it? Number one, Nubank. Number two, Meli. And then last, the banks. Why? Because the banks were more hesitant to onboard PIX because they were putting at risk their debit interchange. It's a significant portion of their revenues. But see, this is where the customer-centric businesses, they don't care about the short-term profits. It also had some debit interchange impact on Meli and Nubank, but they understand that the future and the prelude to open banking is PIX. So more and more of the volume is going to go to PIX. But if you can actually build good credit solutions around PIX, you're going to lock in your customer. So again, I think when you look forward at who, I'm not saying that banks are going to disappear. Not at all. I think banks are going, especially in Latin America, are going to have a huge place in investment banking, in trade finance, in private banking, in many of these verticals. Now, banking you and me, it's going to be tech companies. It's going to be the Pagos and the Nubanks of the world because they're beautifully positioned because of the 4 pillars that I spoke, but they're also customer centric. So they don't put profits before the customer. They put the customer before the profits. And that's very revolutionary for bankers because in banking, it's been in everywhere in the world is how many fees and products can I shove down your throat that you don't need? And this is what Nubank and Pago came to change. That's why they've been so disruptive because now banks need to basically fight for deposits. Before, they deposit my salary in a bank, they turn around, invest it in treasury bonds, and everybody's happy. Now they have to compete for the deposits, and they are not very well geared for that. From a technology perspective, but also from a shareholder perspective, because these are guys who want dividends, who don't want to invest for the experience, more of a short-term view. So it's going to be complicated for retail banks. It's going to be an uphill battle. I'm not saying they're going to disappear, but it's going to be uphill.
So, Fede, we've got some questions that have started to come into the queue from our viewers, and one of them is actually very close to a question I was going to ask anyway. So I wanted to go ahead and get that question out there. So there's a question from Swing for the Fence 88. I'm putting y'all on the spot here. I apologize a bit, but in the spirit of smart investing, how much of a competitor is StoneCo, ticker STNE, to Mercado Libre, and what do they do best in class? And I wanted to expand on that a little bit because, you know, we haven't really talked too much about the competition and who the competition is for Mercado and for Nubank in Latin America. So in terms of StoneCo, PagSeguro, etc., who do you see as Mercado Pagos and as Nu's biggest competition?
Yeah. So I would make it twofold. I think there's 2 stages. I think the biggest competition today for Pago and Nubank is actually cash and the incumbent banks, and that will continue to be that way at least for the next 3 to 4 years. Because still, in my neck of the woods, any metric that you get, whether it is customers, assets under custody, lending portfolio, any metric that you get, the incumbent banks have about 80 to 85% of the market share. So cash and the incumbent banks are the first competitor. Now, I think when we look at the acquiring business and basically the acquiring business, I think there is some overlap. So Stone has a merchant focus. They also have a credit portfolio, but I think the top rival in Brazil is more of a Nubank because they come in the future because they compete in all of the verticals. I think PagSeguro and Stone are more merchant focused into serving merchants, which I think hasn't changed that much. But if you look at the merchant spectrum, you would have sort of like Pago here in the bottom playing in the micro nano SMEs. Then you have with a little overlap with PagSeguro, which is growing a little bit into the larger SMEs, where it sort of overlaps with Stone, which serves already either large SMEs or large businesses, which overlap with the traditional acquirers, right? But if I think about, beyond payments processing and beyond merchant acquiring, the only player that has a regional presence and that offers the amount of, financial services products that Pago does is Nubank. Number one, but also I think there is a step function of quality in terms of technology and management at both Nubank and Meli, and then there's like a step function lower on the rest. And not it's something that's not minor. Both PagSeguro and Stone only play in Brazil. So they're stuck in Brazil, which is a large market, but it's like a third of Latin America. There's still another 2/3 that they don't play. So they are interesting businesses, but I think that's why I think the closest competitors right now is cash and the banks, and that's how it's been for the last 6 or 7 years. But I think eventually, where they're gonna butt head to head are gonna be Nubank and Pago eventually. But I think the TAM is so large and the profit pool around credit so large that it's gonna be like financial services. So Bank of America does well in spite of Citibank doing well, and this is gonna be a similar dynamic. I would remove especially in the fintech business, the zero sum mentality. I would have that mentality in e-commerce because of logistics, but not so much in fintech. There's space for a few to do quite well.
So I want to highlight a couple of things you said that I think are really important. So again, with StoneCo, they're very merchant focused. The entrepreneurs that are starting
and large merchants. Right, and large merchants. They won't be serving, the guy that sells you coconuts in the beach for the most part.
Right, exactly. So that's that's really key part of their business. So I just wanted to emphasize that. And the next thing we have Pro Shop Guy's question. I think we're going to take that next, right, Danny?
Yeah.
So Pro Shop Guy, now trying to see it around my microphone stand here. Any comments on the Argentina economy, particularly after we've seen a leadership change? So that's a large market and there's opportunity there, but how do you view it?
Yeah, I think it's very positive. So the one thing that I think has occurred in Argentina, and I remember talking to investors and they looked at me like I was crazy, is the acceptance network that Mercado Pago has in Argentina. So today in Argentina, there is literally nowhere where you can't pay with Mercado Pago. Even tips or people in the street will give you their alias so you can send them Mercado Pago. So I think what's happening in Argentina is there's been a shift in government policy from a policy of printing money to sustain a high level of government spending to actually stop printing money and actually have organic investment drive the GDP growth, okay? But Mercado Libre has such powerful secular tailwinds that even with an economy that has been, slowing down, when you look at Mercado Libre in Argentina in terms of items, which kills inflation because some of your GMV growth in FX neutral basis still has some inflation, it's been very, very healthy. So I think, we're going in Argentina, we're going through a transition from a sort of a left-leaning, fiscal deficit approach to a more liberal, business-friendly, genuine growth approach, which I think bodes very, very well for Mercado Libre. Which, by the way, I mean, in Argentina, it was not anymore. It was a walled garden for so long, meaning nobody wanted to come to Argentina to do business because it was so hard that basically the moat of Mercado Libre in Argentina, it's even steeper than anywhere else. I mean, literally, like the only game in town was Mercado Libre for like 15 years. So yes, now you start to see a little bit more of the shipments from abroad into the country, but Mercado Libre is also doing it. So you can also get items from abroad through Mercado Libre. So I think net is very positive. I think we should tackle inflation and excessive government spending, and I think that's happening, and that's going to make a revaluation of the currency and actually have positive, healthy growth. But I think it looks very good for Meli, and I'm going to close with this, and I think this proves what I always said when I was IR, which also applies to Nubank. But these businesses generate so much tax revenue for the taxman.
Right.
Are digitalizing and making more transparent the economy because you're digitalizing transactions that before occurred in cash, and you're bringing in so many SMEs to grow their businesses that I find it really hard that Mercado Libre becomes either a target for political reasons or they get impacted negatively because of macroeconomic performance, because the secular tailwinds are so strong that they trump the macro headwinds. And I remember even studying, and this probably is still true. I remember trying to calculate when I was at Meli, the correlation of local currency GMV, right, with local currency GDP in each of the countries. And the correlation was very small, which means that basically the force of people buying online is way stronger than the economic contraction.
So, Fede, before we go on, there was a couple of comments from our viewers that I wanted to share with you. This is from Cinta a few minutes ago. Love you, Fede. You're the best in Motley Fool when it comes to energy. You got a lot. No offense, Jason and Danny.
I'm so offended. So offended. No,
and the
not at
other
all.
was a comment. He loved your comment about the guy that sells coconuts. He loved that.
Oh
Yeah.
yeah, but
Very
it's
good.
true. It's incredible. Like the guys will whip out, like he's with a bag with the cooler and the coconuts, and you're gonna go pay in Brazil, and like he never whips out the money. Like he whips out the POS, and you basically tap the POS and you pay them. Boom, that's done. That's it. And I'm talking about not even like the beaches in Sao Paulo. I'm talking the northeast of Brazil, where literally there's like nothing, and you have the guy with the POS there.
Danny, you and I are old enough to remember when Mercado Libre paid a dividend.
Yeah,
So,
I started when they paid a dividend.
I actually got some of those dividends, and that was a long time ago.
Yeah, me too. So the company doesn't pay a dividend anymore for obvious reasons. The capital needs to spend on the business. But Matt's question is, what needs to happen before Mercado Libre begins to pay a regular quarterly dividend again? So I want to put a little bit of a spin on that. So I want you to vision forward. Think about the company from today. How long is the tailwind of growth when it could potentially get to the point where its cash flows are so substantial that it would be able to continue to fund its growth internally while also having enough cash left over to return to shareholders?
Yeah. So that point is hard to. Yeah, go ahead, Danny.
I was just going to say, and I know from our conversations that since you don't, work there anymore, you don't have any material information.
No insider info here, right?
Yeah. So what Fede has given us is his best guess.
Yes, my best guess based on managing IR for 6 glorious years and then another year at Nubank, and obviously I still investigate the company obsessively. But going to your question, I think what I've seen at Meli, it's interesting. It's like every time you think, because this is why Meli is such a cool company, because the way I see Meli is like a holding company that has a whole bunch of startups under that are all connected to the holding company. So I would say, when we reach e-commerce penetration of maybe 25, 30%, and you have a primary banking relationship of maybe 50 or 60% of your customers, maybe you begin to pay a dividend. But the thing with Meli is that they grow so much that they find other alternatives to invest as they keep growing. So, my best guess would be that. But then you have other businesses that you're growing. You have the advertising business. Then you're going into the streaming business, but not doing movies, but trying to generate more lock-in and engagement for the loyalty program. You still have so much to do in countries where you don't have Mercado Pago, like in the Caribbean region and in other smaller countries. So I think there's a whole bunch of things that can return more to shareholders than a dividend. But I think framing where the dividend payout would come, it would be when you have a way more mature e-commerce business where penetration of e-commerce is double what it is today. Today is in the teens. US is in the 20s. China is like in the 50s around. And when you have cemented more of your leadership position in financial services. So the way I frame this, that's why I always say it's Nubank and Meli, not Nubank or Meli, is because what's happening is, especially in Brazil, but also kind of in Mexico, is Nubank is being like this icebreaker that is breaking this this monotony of the banks, right? Because they have a high cost to serve. They serve a segment of the population from the middle to high class are very comfortable, but they can afford to ignore the lower classes. What's happening is Nubank is breaking that ice, and Pago is coming right behind it. So if we think about a situation where in the next 3 to 4 years, if we look at the largest banks in Latin America, Nubank and Pago are in the top 5, we are unlocking a lot of value that today I am very positive most of the market is not giving it the credit that it deserves.
So I wanted to ask Fede, U.S. investors continue to hear a lot about the hyperinflation that happens in some parts of the region. So what's your take on the overall health of Latin America and how it impacts Mercado Libre? I know we've talked about this before, but we have a lot of viewers that probably haven't heard that conversation.
Of course. No, of course. And I actually come from a hyperinflationary country. So I remember when I was young, and I lived in Mexico, but my family and I am from Argentina as well. But I remember that they would reprice in the same day. So if you bought in the morning, you had to buy in the morning because in the afternoon it was more expensive. So it was like, we're experts in hyperinflation in Argentina. We're also serial defaulters. But that aside, there's two dynamics that happen with hyperinflation, if that would be the case, which we already experienced it, and Mercado Libre did incredibly well. Remember that on the commerce business, Mercado Libre is for the most part a take rate business. So if prices go up 10%, the take rate will capture that. So that sort of passes through, not to Meli's margins in a scenario of hyperinflation. We've seen this in Venezuela, where they deconsolidated the operation because basically inflation was really out of control, but the business is super profitable. Believe me, they mint money in Venezuela. The day things normalize, they're going to be the owners of the game. But sort of the take rate nature of the business hedges you from the hyperinflation. And then on the fintech side, something that perhaps is not as appreciated is that usually the effect of high inflation is higher interest rates, right? Because you want to tame the inflation. And because Meli and Nubank's lending portfolio is between 4 to 6 months, you actually can reprice very quickly without having that balance sheet exposure. So it's not that Meli has, a portfolio of 30-year mortgages in their balance sheet, and that as inflation rises, interest rates go up, and the value of those mortgages get reduced. So they're able to pivot real well in inflationary environments. That's why, even though the Amazon playbook worked really well in Europe and the US, when you're dealing with 33 countries, 33 regulators, 33 very, very distinct geographies, Mercado Libre has gone through the red tape. They've done all the work, and they know how to manage this in very different scenarios. And that's why I believe both for the commerce business and the fintech business, they are the risk of hyperinflation impacting negative the business is mitigated. It's not that it's going to be entirely mitigated, but for the most part, I feel comfortable with the risk.
So I want to ask a question here that we got from Sadaf that kind of gets into some of the things that we've talked about with expanding products, expanding the fintech services, and also the geographic expansion. Sadaf asks, thinking about Mercado Libre, is Mercado Libre going to or should grow? I think the should is more important. Expanding more geographically or adding more services? Which do you think should be the focus?
Yeah. Look, I think I'm going to answer the question in two sides, because I think the future for Meli and Nubank here sort of splits. I think Meli has no business abroad Latin America, just because there's so many things they can still do. And because the brand is so well recognized and has such a dominant position, that I think it would be suicide to go fight Amazon in the US or try to, put a toe in Europe, because then you have all the Amazon infrastructure and it becomes a game of burning money. So I think now we have a very comfortable, dominant position in a continent that has 650 million people, which lack financial services. They still have low purchase frequency. They can still buy more online. So I think Meli will stick to Latin America and win. I think Nubank is a different story. Nubank doesn't have logistics. Nubank is platformizing their technology so they can actually go to other geographies, which could be even the Hispanic market in the US, and launch quickly, right? So once they get their regulatory license, they could launch the platform, connect the core banking system to MasterCard, and actually be up and running. So I don't imagine Meli, and I actually would be very concerned if Meli would go beyond Latin America. But I think if we continue to see Nubank in this trajectory with growing RPAC, growing market share, and all the metrics going north, I think that in a 5 to 6 year horizon, we're going to see Nubank going to another country beyond Latin America.
So I have another question I want to ask Danny. This one's just, I want to make sure I'm watching the clock and I'm seeing it tick down. Right. And we've talked a little bit about some competitors and peers with Nubank and with Stone, but C Limited fits in there too. And I want to expand that question beyond C Limited.
Yeah.
What do you think is the viability for companies maybe that are based outside of Latin America, moving into some of these markets and being able to establish a beachhead and be viable competitors?
Yeah. Look, so it's hard. So Brazil is crowded already. So let's review. You have Meli, 800-pound gorilla. You have Amazon, 800-pound gorilla. You have Americanas, which is pretty big. Magalu, which is pretty big. Via Varejo, which is pretty big. You have C Limited, with distribution centers already installed. And then you have the Chinese players like Temu, Shein, AliExpress. So it's really, really crowded. And here the name of the game is called unit economics and logistics. Okay.
Mm-hmm.
And I don't think, I think it's going to be very hard for a player. Maybe C can make it work in Brazil, but it's going to be very hard to make it work in other countries without burning significant amount of cash. I think they do have a very important role in Southeast Asia, potentially with Brazil, because they've done some of the investments. But I think it's going to be harder to move beyond Brazil. In fact, they closed all their offices beyond Brazil, C Limited, because of the level of investment and low traction. So I think that the Chinese players, which have increasingly made more noise, they have a role to play, but I think it's on the segment of customers who don't want fast products or high quality products. They're buying for price. They don't care about the delivery times. It's coming from China. So I really believe that because Mercado Libre invested so aggressively in logistics in 2016, 17, 18, 19, they sort of marked their destiny and cemented their competitive position, so that we can think today, how does e-commerce look in Brazil in the next 7 years? I don't know. But what I do know is that Mercado Libre will have a leadership position because of all these investments. So that's the way I frame it. I think there's space for others. I think there's an opportunity for international players to sort of bite into the local players. But at this point, it's what I spoke to Danny over our calls. I think the logistics network is just so broad. The delivery times are so good. The assortment is so good that you would have to invest a significant amount of money to move the needle, to remove Meli as a dominant player. I think it's what Marcos used to call escape velocity. I think we're there in e-commerce.
So Federico, we had a question here. One of our studio guys asked if you could talk about Spider Investments.
Yes. Yeah, Spider Investments is a really interesting business. So it's basically a PropTech business that enables you or people to buy properties in the United States almost through the app, right? With rental income tied into it. So when you buy the property, it already has a tenant in the house where they have reviewed for the credit history. They reviewed his profile. The company does the property management for you. So basically what you're buying is the cash flows of a house without the hassles of owning a house. Why is the value prop very interesting from a Latin American perspective? Is because there are many Latin Americans that want to save in dollars and they want cash flows in dollars. So basically, think about Spider as a technology layer between the purchasing of the house and the tenant, where all the noise gets managed by the app. So you get your rental income into the app. So it has a fintech angle too. So you get your rental income into the app. You can actually send that income to Bank of America or Chase or wherever. And by the way, these are properties that are not in traditional real estate locations that have low cap rates, like could be San Diego, which is beautiful but has low cap rates, or Florida or New York. It's actually alternative markets like Pittsburgh or Cleveland, where the cap rates are higher and the potential appreciation of the home is higher. So it's a very interesting business. Obviously not the explosive growth of Meli, but I'm actually a customer. I own 3 homes and it works really well. So,
and do you do investor relations for them?
I did. Unfortunately, right now I stepped down. Obviously, Danny, my mother passed away, but I've been busy with other things, and I've had to basically for the time being, I've had to not participate, but I helped them building the model and building all the investor presentation, but we weren't able to go out and talk to investors. The situation happened right before, so. It's sort of I was almost to make it to the shore, but I didn't. So I'm not there. I'm not there anymore for the time being.
Fair enough.
Danny, go ahead.
I want to see if we can hit this question in under about 2 minutes and give Jason a chance to get something in there. Cinta asked, is Mercado Libre a fintech company with e-commerce, or is it an e-commerce giant with fintech? what do you see driving the long-term growth, and what risks arise from misidentification?
Okay, so I think it started as an e-commerce business that had a fintech bolted into it, but eventually it's going to become a fintech that has e-commerce bolted to it, because in my view, and I already gave some numbers around it, I think Mercado Pago will be more valuable than the marketplace. Okay, so in terms of just the addressable market, the lending market, the credit market, just for the audience to have an idea, secured lending in Brazil, only the market of secured lending is the size of the entire financial market of Peru. Okay, so it's a very, very large market, which Meli and Nubank are beautifully positioned to win. In terms of risks, I think what I see is as you lean into more financial services products, the regulatory risk naturally increases because you have a bigger loan portfolio. You have to be subject to certain central bank regulations. But like I said, I think they've been building this from the ground up for a long time with very competent people. And that's what gives me the comfort that they're going really fast, but they're executing with the best talent that they have, which mitigates the risk of them, crashing the Ferrari. And I would say this for both Nubank and Meli. I think the brand, right? The brand and the purposes that both companies have attract really good talent. So if you walk around Buenos Aires or São Paulo or Mexico City and you grab, a young engineer or someone who is related or who wants to work in tech, I guarantee you they're gonna tell you Nubank or Mercado Libre in their top 5 places where they want to work.
Okay.
Usually banks don't come up in that list.
No, not at all. All right. So Danny, I don't get the last word. They don't want to hear from me. They want to hear from Fede. The people want more Fede. So here's my question. We're going to move beyond these.
I'm always available for the Motley Fool. Always available.
So here's the question. Moving beyond these particular companies and thinking about somebody that knows Latin America, the different markets and countries there, looking out 10 years from now, 20 years from now, even, if you were to predict what country in Latin America do you think US based investors 10 or 20 years from now are going to look back and say that is a market that I should have invested in? This is a big opportunity. Okay.
Mexico.
All right.
Mexico.
That's why.
No doubt.
Don't hesitate. Tell us how you really feel.
That's fantastic.
Mexico, because it has the particularities of Brazil. So when you look at the population, very young, 50% of the population is under 30. So they have what we used to call in the IPO roadshow in Nubank, the demographic dividend. So as they grow, the relationship with Nubank or Meli is going to be more intimate because they're going to buy more on the marketplace. They're going to take more loans. So you have it's a very engaged population, mobile first, digital native that is young. So I think there's going to be. I actually make the argument that both for Meli and Nubank, Mexico eventually becomes as profitable and almost the size of Brazil because yes, the population is smaller, but the GDP per capita is higher. So it has a lot of potential.
Outstanding.
That's fantastic. Yeah, that's great.
Well, Fede, we are at the top of the hour, so unfortunately we're going to have to end it here, but I wanted to end it with a comment from one of our viewers. Matt said, Mr. Sandler, I think you're a little better than mediocre, which is what it says on your X page at doing investor decks. So, and I completely agree with that.
I'm going to edit that.
You're a real gem, Fede. There's no doubt about that. You're absolutely a gem. All right, Danny, we're going to turn it over. We got Rachel and Toby coming in for the earnings hour. They've got some companies to report they're going to talk about. Fede, again, thank you so much.
Thank you, guys. Have a great rest afternoon and can't wait for the next one. Take care. Bye-bye.
All right, Rachel, it's time to talk earnings with all of our friends here. Get your earnings questions in for us, Fool. We're talking about earnings. A couple companies specifically we were thinking about focusing on here are Ulta Beauty and Dollar General. Is that right, Rachel?
I think Dollar General, DocuSign is about to report, I believe, as well.
Oh, nice. DocuSign. Good stuff. Let's talk
right after the close of the market. So I'm just waiting for that to be uploaded.
So I got Ulta. I got Ulta's slide here. I don't see anything from them yet. I'm going to head to DocuSign and see what's going on with DocuSign. I'm very interested in this report as well. DocuSign doesn't look like they have quite released yet. So
I'm
we're
also
waiting on both
looking
those.
at Crown Castle. As remember, we were going to talk
right.
about that a bit yesterday. They're supposed to also, all of these are reporting right after the bell. So we keep refreshing their IR pages to be like, can we look at the report? So that should be up here in a minute as well.
It's going to be a fun hour here. Crown Castle is coming up here. Let's see. Yeah, they told us, right? They said they had delayed it. I don't see another delay, but yesterday they filed like 20 minutes, right? After the bell, they put this little press release that said, "Yeah, stay tuned for tomorrow."
So there's one company I could kind of talk about in the meantime while we're waiting.
All right, what do we got?
Didn't talk about this so much during earnings season, but Snap, the parent company of Snapchat, they reported in February, actually. And I don't think we really covered it a whole lot. So I thought it might be interesting to kind of briefly hit on how that business has been doing. Anyone who's followed the stock has seen, shares have cratered quite a bit in recent months. I'm trying to look and get an exact figure here. So the market cap for this business is still around 14 billion. So this is still a big company, right? But shares are trading at about $8.37 each. And the stock is down about 30% over the last year. And, there's been some struggles with the business recently. They obviously were once this really dominant force in social media. They're still a very popular app among their users, but they've been dealing with issues like increased competition. There's been struggles with their monetization strategy. We obviously are seeing the evolution of user preferences. There are so many different social media apps that are, drawing user eyeballs these days, right? And so there has to be a real differentiation. And I think that's something that Snapchat has struggled with, particularly amidst the continued prominence and rise of TikTok among younger demographics. It's an increasingly competitive social media landscape. There were also some major changes. Apple's changes to their app tracking policies that have made it harder for apps like Snapchat to, collect user data, which is crucial for targeted advertising and revenue generation. And as a result, there has been kind of a range of factors that have led to some declining revenue and struggles with the business. How they make money, like a lot of these other types of social media platforms, advertising on the platform is huge for them. So they allow businesses to run various types of ads, including dynamic ads, local sponsored lenses, and ads within Snapchat stories. They also have a monetization program where creators can earn money by sharing a portion of the revenue that's generated from ads placed within their public stories or spotlight videos. They do have some income, I believe, from paid subscriptions, but a lot of that goes back to advertising. So they reported their results for 2024 back in February. Their revenue for 2024 was about 5.4 billion. That was actually up 16% year over year. So they did have nice double-digit growth on the top line. But they are operating at a net loss. They did bring in net income in Q4, but for 2024, they reported a net loss. So they did shrink that a bit compared to 2023. They had reported a net loss of about 1.3 billion the prior year. They brought that down to about 698 million net loss for 2024. They did deliver positive free cash flow and positive operating cash flow in 2024. Their free cash flow was about 219 million for the full year. Their operating cash flow was about 413 million for the full year. Now, looking at the final 3 months, Q4 revenue was about 1.6 billion. That was a 14% year over year bump. They did report a profit in that final 3 months, net income under GAAP of about 9 million. They also delivered free cash flow of about 182 million in the 3-month period, which was a nice bump from the 111 million in free cash flow they reported in Q4 2023. So kind of a mixed bag with the business. They did note that daily active users are increasing. They've been deepening engagement as well. So daily active users were 453 million as of the end of 2024. That was a 9% year over year bump. They have been growing their Snap Star program, which features a whole group of different content creators, and that has been something where more and more creators have been joining the program. That actually led to a 40% year-over-year increase in the number of creators posting content on Snapchat in Q4. And they've also had some ongoing momentum in other areas. For example, their sponsored snaps and promoted places strategies grew their number of unique Snapchatters reached by advertising partners. That actually delivered a 30% increase in advertising reach on average in the US in Q4. They've also been incorporating some generative AI features into their platform as well that has helped to boost some retention there. So, there's still some things to like about this business. I think the fact that there's just such a competitive landscape that Snap is operating in, that they're finding it difficult to differentiate themselves in, is where my concern is. It is worth noting that advertisers are still flocking to the platform. Their active advertisers on Snapchat more than doubled in Q4. And that was also a major driver of the double-digit revenue growth they reported, as well as the fact that while they were, again, not profitable under GAAP for the full year, they were able to deliver a profit in the final 3 months of 2024. So a bit of a mixed bag there. This is a business I follow. Obviously, this is a space I follow pretty closely. So this is one of the businesses that I have on my watch list. It's not one that I currently own. I've kind of stated my concerns as to why, but I thought it was worth touching upon, as I think it's still a popular stock for some within the Fool universe. And it is a very popular still social media app. They're just dealing with a competitive landscape. They're growing their advertiser base. They are growing revenue. They're working to be more profitable. Maybe this could be a turnaround play, in the next 5 years or so. Hard to say at this point.
Nice. All right. We have results from both Ulta and DocuSign right now. Which would you like to look at first, Rachel?
Well, I was actually able to get the results for Ulta down here. So maybe we hit that one first.
Let's look at Ulta.
This is a company I've been talking about a lot recently. They've been dealing with some big shifts in the business. They obviously had a new CEO that started in January that succeeded Dave Kimball, the longtime CEO. And I think there's been a lot of hope for what that could mean for the business, moving forward. They are, I believe, only located in the US, Ulta Beauty, and they have really a wide range of beauty products, salon services. So they're really reliant on that brick and mortar model. They do have a robust e-commerce presence, and then they also offer all these different, salon services, but they've really seen a slowdown in growth in the last few years. Looking at these numbers here, somewhat in line with what we've been seeing recently, right? So net sales were actually down slightly, or about flat in Q4 compared to the year ago quarter. So net sales in Q4 of 3.5 billion compared to 3.6 billion in the year ago quarter. However, comparable sales increased 1.5% year over year, and that was again in Q4. Looking at the full year, they reported net sales of about 11.3 billion compared to about 11.2 billion 1 year ago. So a slight uptick there. Net income of 393 million, or $8.46 per diluted share. Looking at the full year, net sales increased 0.8% in 2024 to 11.3 billion. And they said that was primarily due to a new store contribution that was also partially offset by the benefit of a 53rd week of sales in fiscal 2023. Comparable sales grew also less than 1% by 0.7%. Net income was 1.2 billion compared to 1.3 billion a year ago. So this is kind of in line with what we've been seeing. Very slow or decelerated growth. They're still profitable, but it's not an uptick. I think this is something where, again, something I've mentioned is I'm curious to see what that new strategy under the CEO will look like. I don't think we would necessarily see that take shape for a few quarters. It's worth noting they did report operating income of about 516 million in Q4. They reported net income of about 393 million. Their net sales in Q4 actually decreased slightly year over year And then, of course, overall net sales in the full year increased by less than 1%. So not a bad report, not a great report. I don't know what sticks out to you, Toby, as you're looking at this.
Yeah, I think it's probably fine. Sales did go down, but we did have that difference in weeks, right? 13 versus 14. So
the stock is trading up after hours.
It's up about 4.5%. Yeah. Comp sales are decelerating.
Yeah.
But it's okay. I think people expected this to be a little worse than it was, and so that's why you're getting this net store. So the store openings were a little weaker than they were last year, but for the full fiscal year, they're quite good, right? So 60 versus 30 into the full fiscal year in terms of store openings, 8 versus 11 for the quarter. So I think that's fine. There's probably just some timing issues there, but for the last year, they have accelerated the pace of store openings in the last fiscal year. So that looks fine to me.
Yeah, they beat on revenue and earnings per share from what this is probably part of why the stock is trading up after hours. And obviously we don't make investing decisions on that, but we always talk about what's happening with the stock after they report. They beat on revenue and earnings per share. So even though revenue grew very slightly for the full year, decelerated slightly in Q4, even though earnings per share were roughly flat year over year and even a slight deceleration, this was still above what analysts were projecting, which I think is what you're seeing in the movement of the stock. They also did, in terms of their outlook for the new year, they did release their outlook for fiscal 2025. That was actually a slight raise from what they had previously been projecting. So for their fiscal 2025, they're looking at net sales of 11.5 billion to 11.6 billion. That would be up slightly from the 11.3 billion that they just reported in this last year. They're hoping to open 60 net new stores in fiscal 2025. Comparable sales at most, they're targeting will grow 1% or be flat year over year. They are targeting an operating margin of 11.7% to 11.8%. But again, this outlook is a bit higher than what had been projected previously. So not bad. Seems to be more than what Wall Street was targeting.
Yeah, it's not bad. It's fine. There's nothing in here that gives me any great concern, nor anything that makes me change my opinion for the better necessarily. Just kind of did what you needed to do, so that's fine.
Yeah, it's like if I'm looking at this company, they are operating in a very dynamic environment where the likes of Sephora and Elf and some of these other big beauty retailers that are continuing to really disrupt the mass and prestige markets are doing exceptionally well. And Ulta Beauty has still a lot of reliance on the brick and mortar model, which they've also had really effective partnerships with some of these other, bigger retailers like Target. That's been something that's been helpful to them. But they're dealing with a lot of competition and also an environment where consumer spending is shifting, if not declining, when it comes to discretionary purchases. So, given where this business has been at the last few years, I think this is a business that could turn around and get back to more notable growth in the coming years. As I said, I'm very curious to see what direction it will take under the new CEO. Growth has kind of stagnated at this point, but they are still profitable. They still have a lot of cash on hand. So those are positives. And even though their outlook for fiscal 2025 is pretty moderate, it's still more than what was expected. So there's some positives to be aware of there, but I don't see this being a massive growth business anytime in the near future.
Yeah, I think that's probably right. DocuSign. DocuSign looks pretty good, Rachel.
Does it? I haven't looked yet.
Yeah, DocuSign reported their
Pulling it up
report
now.
is pretty good. Stock is up a little over 4% right now. It was down like 6-7% today, right? And then after we do have a decent bump, a decent recovery of much of that after hours right now after the earnings report. But it looks like a good report. I'm going to go ahead and share my screen here because they did give us a nice little slideshow. And so why not show that as we are as we're going through this report. We can talk about things. So here's DocuSign. Here's, you guys can see here the quarterly numbers in Q4, 28% international revenue growth, 9% year over year. Billings up 11%. This is the first time they've had double digits, I think, in the last 4 quarters in terms of billings growth. So that's nice to see. Nice free cash flow, decent operating margins. You'll see the trends here in a second. They show us the trends. So that's nice. This is just kind of the marketing spiel here. Wonderful, wonderful, wonderful. Okay, so we don't care about this. Financial review. This is what we're going to look at, right? So you look at this. Highest revenue growth in the fiscal year coming in Q4 and accelerating from what we saw last year in Q4. So that's good to see in terms of revenue growth. This is going to be basically the same right now because subscription revenue is 98% of the total. So it's basically all we've got here, which is good. Billings growth, you see that 11%. They haven't been in double digits since Q4 last year in terms of billing growth. So that's really good. Looks really strong, getting back to where we need to be there. So I like that. Nice growth in billings. Gross margins, pretty good. Like it's basically been steady this year, between 82 and 82.5%. This is fine, I think, for the gross margins. Operating expenses as a percentage of revenue, you'd like to see this low, right? And it's not. It could be better, but it's at least it's not growing more, right? So that seems fine to me. Cash flow, look at that nice boost in cash flow we got this quarter, right? For free cash flow, for operating cash flow, higher cash flow than we've had in over a year. Good stuff, right? Good stuff to see there. And decent guidance, it looks like, looking forward here. It's seems fine. Seems fine to me, Rachel, in terms of guidance. So I like this. The trends look very good for DocuSign. We're getting a little bit of acceleration in revenue growth, a little bit of acceleration in billings growth. Cash flow keeps growing, like what we see here. So I think decent quarter for DocuSign. Is it fantastic? No, but they're definitely moving in the direction that you expect them to move in if you're a shareholder here. So I think it's good news.
Yeah, I think this is a pretty solid report. And again, for anyone who doesn't maybe follow the stock as closely, they still make most of their money from subscription fees for their e-signature platform, and they have a whole range of subscription plans that cater to various customer needs, including everyone from individuals to really large enterprise clients. And while growth may not be at the rate that we saw in that uptick during the pandemic, this is a solid business and one that I've continued to really like. They're profitable, their revenue is growing steadily, and as you mentioned, that was a pretty solid fiscal year of revenue and earnings from them. Total revenue of about $3 billion, up 8% year over year. Subscription revenue is almost the entirety of that amount. That was up also 8% year over year. GAAP net income of $5.08 on 210 million shares compared to 36 cents on 209 million shares a year ago. They're continuing to expand their offerings for customers as well, and repurchases of common stock were up significantly, about 683.5 million of share repurchases compared to about 145.5 million in the same period last year. I like that free cash flow as well. Free cash flow in Q4 of the prior fiscal year was about 249 million, about 279 or 280 million this year. So this is a good report, honestly.
Yeah.
Looking at this, they've also been leveraging AI into their e-signature platform. Their AI-powered agreement management platform was just launched this last year. The CEO said it's been a transformative year for them, and that's been a huge aspect of it. And they see that as being a driver as well of their revenue growth and profitability. So pretty solid results from them, I would say.
Yeah, that was good. Now we have Crown Castle, Rachel. Crown Castle.
There's been some big news there.
Indeed, my friends. As I suspected, given the delay and the phrasing they used when announcing that delay, they have in fact concluded a deal to sell the fiber segment.
Yes.
So
And their small cell business
so it's
too.
the small cells and fiber solutions being sold for $8.5 billion. Looks like they're selling that to who are the buyers? EQ. Let me see if they have an actual. I don't want to just bury in the earnings release. Do they have? No, it's the same thing. Come on, guys, make this easy for me. All right. So it's in the earnings release instead of a separate press release, but it's up at the top here. All right. They announced a definitive agreement to sell all the fiber segment so that's being sold to two buyers, EQT, Active Core Infrastructure Fund, so that's an investment fund, is buying the small cell business. Zayo Group is buying, Zayo Group, I guess, is buying the fiber solutions business. Maybe that's why it took a little bit longer than expected, because they had two parties, two negotiations going on in here. Expected to close in the first half of next year, assuming we get all the regulatory approvals necessary for that. And they say they're going to use the proceeds. It looks like it's an all-cash deal. They're going to use the proceeds to repurchase or pay back some debt and fund some share repurchases. That's basically what they're giving this money away, right? They're repaying debt, they're paying out some share, they're buying back shares. The goal here is to kind of improve their credit rating, right? Maintain their investment grade credit rating. So it's a debt reduction plan, basically, for that. And they announced this back in December 2023. So this is a little over a year in the works now. It looks pretty good.
Yeah, I can dive into this a little bit more as well.
Let's look at this a little bit. We can get into the earnings report as well. But that part of $8.5 billion, assuming I'm trying to see if there's any nuances to that price here. I'm not seeing it off the top here. So yeah, it looks like just $8.5 billion in cash.
And
now they are reducing the dividend.
I was going to mention that, and that's part of their overall restructuring here. For anyone who doesn't know this business, so Crown Castle, they're a real estate investment trust. They're in the business of leasing wireless communication infrastructure, including cell towers, small cells, and fiber networks. The small cell and fiber networks are what they're about to sell off. But they lease their wireless communication infrastructure to wireless carriers and other enterprises. So they generate revenue through site rentals and network services. Site rental revenue is the main source of income for Crown Castle at this point, where they own and lease land, they construct towers, they lease that space to big clients like wireless network providers. These include companies like T-Mobile, Verizon, AT&T, and that is a major driver of their business. They're, as a real estate investment trust focused on communication tower infrastructure, they, like many other REITs, leverage triple net leases for their tower and fiber assets. And this means that tenants are responsible for most of the costs of operating those properties, including things like property taxes, insurance, and maintenance. And that triple net lease model, enables them to pass off a lot of their operating costs over to the tenant, which makes the actual innate REIT model much more capital light. So in a triple net lease, the tenant, so in this case, a wireless network provider like AT&T, Verizon, or T-Mobile, pays all of those property expenses. And then as a REIT, Crown Castle's business model revolves around owning and leasing out that communication infrastructure like towers to wireless network providers. And these triple net leases are common and really efficient way for REITs to manage property expenses and pass the risk of those expenses to the tenants. Crown Castle's leases with wireless network providers are often long-term and renewable. And so that provides a really stable stream of income for the company. A lot of their key infrastructure components that they build and lease out are cell towers, rooftop antennas, and then these small cells and fiber networks are what they're in the process of selling off. They have a network of over 40,000 cell towers and approximately 85,000 route miles of fiber across the US. Now, why would they be wanting to sell off their fiber business and their small cell business? They have faced some challenges recently. The sale of that fiber business is, I think, really key for them as they're working to work down what has been a pretty substantial debt load. A significant portion of their revenue right now comes from a few major wireless carriers, companies like T-Mobile, AT&T, Verizon. They had actually had to cancel thousands of greenfield small cell nodes. Again, they're selling off their small cell business now, and that have resulted in numerous asset write-down charges. And so they ended up delaying, as we talked about yesterday, their Q4 earnings release due to that strategic review of their fiber segment, which I think had raised some concerns about operational efficiency, but follows on lengthy discussions that have been ongoing for some time about selling that business. So why they're selling their business now, their fiber business, their small cell business, both of which have comprised smaller parts of their overall revenue, but have really also dragged down on the business as a whole. They are really shifting their focus to become what they call a pure play US tower business, which means they'll concentrate on owning and managing these telecommunications towers and other related infrastructure. And then by divesting their fiber business, I think they're hoping to really unlock significant value over the long term, improve their balance sheet, pay down debt, and then really concentrate their capital on expanding their core tower operations. And they believe that that business is going to be a much more stable and predictable source of revenue over the long run, particularly with the ongoing need for carriers to invest in wireless infrastructure. And then as Toby had noted, this is a $8.5 billion sale of their fiber segment. It's a really strategic shift to transform them into a pure play tower business. Now, something else you had noted, Toby, was they're changing their dividend structure, essentially. Now, they do believe that as a pure play US tower company, they'll have a unique opportunity to enhance shareholder value, they say, by providing focused exposure to what they believe to be the best market for wireless infrastructure in the world, which they believe will continue to experience significant and ongoing demand. But they said, along with the sale of our fiber segment, Crown Castle is also announcing changes to its capital allocation framework. The company currently expects to reduce its annualized dividend to approximately $4.25 per share, starting in the second quarter of 2025. And then following the closing of the transaction, Crown Castle intends to set their annualized dividend at an amount that approximates 75% to 80% of adjusted funds from operations, which excludes amortization of prepaid rent. And then they believe, based on their current expectations around future performance, that they'll be able to grow their annualized dividend in line with the growth of AFFO. And obviously, any dividends remain subject to the approval of the board of directors. So I do think this move to sell off the fiber business makes sense. This has been dragging down on operations as a whole, as well as I mentioned they're within the agreement, they're selling their small cells. They've had to write down quite a few asset impairment charges related to issues with that network and part of their business. So this is an interesting move for them, and not perhaps a surprise to anyone that's followed them, but I think could be really instrumental to the growth of the business moving forward.
Yeah. Yeah, I mean, it's lets them focus a little bit more, I think, on the core assets here. And I'm guessing, let me see what's is the stock down?
I have to check. I haven't looked at that yet. So site, I hadn't really.
It's up slightly after hours.
Oh, okay.
Up a little bit, it looks like. So it looks like it's well received. And I think I don't follow this company super closely, but my guess is that this dividend decrease was kind of expected, along with the sale. So now it's the annualized dividend is going to be between 75 to 80% of adjusted funds from operations. for the company. Now, you'd expect it if they were even if they were going to maintain that level prior, you'd expect it to come down because they're losing a piece of the business, right? But I guess that's not too big of a deal, I don't think. $4.25 a share is what they're going to target starting with the second quarter here. And so at $95 a share, let me do some math here, Rachel. We're looking at about a 4.5%. But that's just for the quarter, right? Did they? No, annualize it for it. So 4.5% yield that's the annualized is what they're looking at right now. So not terrible.
And it's, it's worth noting this is kind of instrumental for the business too. I mean, they have been dealing with massive, impairment charges related to their fiber network, their small cell network. And I think the shift in strategy to focus on their tower business. I mean, you look at they reported a pretty significant net loss in 2024, right? Of about 3.9 billion compared to a profit of 1.5 billion a year ago. So that was a like 360% nosedive in the wrong direction. Now, site rental revenues were down just slightly year over year. So they reported site rental revenues of about 6.4 billion in 2024 compared to about 6.5 billion in 2023. So that was a 3% change. Now, adjusted funds from operations, which can be a more useful metric for REIT businesses, that totaled about 3.04 billion in 2024. But on profitability, they reported a roughly 5 billion goodwill impairment charge for their fiber business in 2024. So that significantly impacts the results you're seeing here. And I think that very much feeds into the fact that they're saying, this is not working for us. We need to sell this business. We need to really strategically shift over to our tower business, which we think is going to be the biggest area of growth for the company over the long run. They do anticipate there's still going to be some losses attached to the sale of their fiber segment in 2025. So for anyone who follows this company, that's something to be aware of. If you're tracking their financials moving forward, a huge part of that 3.9 billion net loss that they reported is related to their fiber business. And I think they're expecting anywhere from 700 to 900 million of some loss impact related to the sale. So that's something that will probably take some time to change in terms of the impact on their balance sheet.
Yeah. All right, cool. So Matt had asked me, he saw that the Viking, Mississippi longship was built at a shipyard located in Houma, Louisiana. My birthplace, by the way, Rachel. Houma, Louisiana. Do you think that will be their last U.S. built ship? It depends. It depends, Matt. Depending on how I think it depends on how their U.S. business goes. If they want to have more ships doing these U.S. river cruise ship, you're going to have to, the ship's going to have to be flagged in the U.S., right? Built in the U.S. And so if they want more, I don't know why they wouldn't use the same port, the shipyard. I think they'd still do Houma. So I think that depends entirely on how this business goes. If they're seeing good uptake from this, if they're seeing big demand from the Mississippi River cruises, and I think they're going into Tennessee as well with that ship. You may see a couple more if they think that's good. That's a good business to move forward with. If it's kind of a flop, they might not do that. So we'll have to see how that goes. It's relatively new, so it may take a little bit before they decide how much they want to expand this, if at all. But to the extent that they want to increase the U.S. river fleet, I think you should expect another one coming out of Houma. Is my guess.
I'm looking through
the trade desk. Steve Mitchell asked the trade desk: table pounder or new normal? Stock price now the same as in Q1 23. Yeah. Not much happened in 2 years if you look at it, but making 17 times EBITDA indeed. So I like the trade desk right now. I think it's a good one. I don't know that I would be pounding the table for it, as it were. Like anything right now, I tread a little bit cautiously, but I think if you have been looking at the trade desk and have not gotten in, and are looking for an opportune time to do so, it does look like a decent opportunity to me right now. It is one I like. I think it should be a market beater over the next 5 years. That's my belief. But yeah, don't go crazy with it, right? I would approach it the same as I would any other company I'm buying. I don't look at it and say this is a absolute can't miss. You have to buy this stock. It's a compelling opportunity, but there are others out there too. So think of it in that context.
There's a couple other companies might be worth talking about, but there was a question that came in from Besties about comparing Crown Castle with AMT, which is American Tower Corp. That is obviously another REIT in this space. So American Tower Corp, ticker AMT. Besties was saying, how do these two compare? AMT is not a pure tower play, is it? It has a data center segment. How has that been going? So I don't follow this company quite as closely, but I do know a bit. So I wanted to actually pull up their recent results as well. So just give a little bit more of an update in terms of how they're actually doing after we did quite a dive into Crown Castle. But for anyone who doesn't maybe follow this business, so they are also a real estate investment trust. American Tower Corp, they're a leading independent owner, operator, and developer of multi-tenant communications real estate. So they own and manage a wide range of infrastructure for wireless, but also broadcast communications. So they lease space on their communication sites to many different types of tenants. So whereas Crown Castle is very heavily reliant on wireless service providers like AT&T, Verizon, T-Mobile, these are also tenants of American Tower Corp, but they also work with wireless data providers, radio and television broadcast companies, government agencies, and municipalities, as well as just companies in a wide range of industries. They operate in 22 countries on 5 different continents, and they also offer a variety of services to support their tenants. They are expanding into data centers. As Besties noted, they've been expanding their portfolio to include data centers as well as edge infrastructure to enable faster and more efficient wireless networks. So their core business model revolves around owning, operating, and developing multi-tenant communications real estate, which is primarily leasing space on towers and other sites to wireless service providers and other companies for their communication infrastructure needs. Both American Tower and Crown Castle are real estate investment trusts, both own and operate and lease communication infrastructure. But Crown Castle, they operate primarily in the US, whereas American Tower is a massive international enterprise with, as I mentioned, communication assets in close to 24 countries. American Tower has a much larger portfolio. They have interest or ownership in roughly 225,000 communications assets, including data center facilities, whereas Crown Castle owns and operates and leases more than 40,000 cell towers and about 90,000 route miles of fiber, primarily in the US. So they're a much smaller enterprise. The other thing is American Tower is much more diversified. Again, these data center facilities are a huge and growing part of their business, along with their other communications infrastructure. Crown Castle has historically invested heavily in fiber infrastructure, which of course they're now working on selling and divesting their very unprofitable fiber business. So some big differences there. Part of the reason American Tower has been expanding so heavily into data centers is they actually acquired a data center REIT called CoreSite back in 2021. And that's been huge for them in terms of expanding their portfolio and gaining exposure to the data center industry. American Tower, I think their market cap is roughly twice the size of Crown Castle's. I actually like American Tower a bit better than Crown Castle, even though I follow Crown Castle a little bit more closely. But yeah, these are definitely two different, very different businesses. There's some overlap for sure, but American Tower is a much bigger enterprise, a much more diversified enterprise. They are, I think, doing much better from a financial perspective. And again, their growth into data centers and expanding, continually internationally and not having such a reliance on fiber networks like Crown Castle has been notable. Now, Amtower, their most recent earnings that we have, I think, is for their their full year, which I hadn't had a chance to dig into very much, but I'm just pulling this up right now, so bear with me. So they actually reported their 2024 results at the end of February. So their total revenue increased 1.1% year over year to about 10 billion. Property revenue increased just shy of 1% to about 9.9 billion. Net income increased 67% year over year to about 2.3 billion. They also noted that adjusted funds from operations increased 7% year over year to about 5 billion. So they have been in the midst of a strategic growth plan for the business. They've also been working on 4G densification, early 5G upgrades in emerging markets. And then they said we've had another exceptional year of leasing at CoreSite, which, as I mentioned, is that data center acquisition they made. So despite the fact that they have been dealing with some fluctuating profitability, they actually reported a net loss, I believe, in Q3. They still managed to pull in, a GAAP profit for the full year, which was 67% increase from 1 year ago. And then again, adjusted funds from operations, which is a much more reliable metric for these businesses, grew by the upper single digits. They also reported free cash flow of about 3.7 billion in 2024. That was up 27% year over year. So while both these businesses have had their struggles, AMT from a financial perspective, from a diversification perspective, I think is doing much better. Now, Crank House could be a turnaround maybe with the sale of their fiber business, but for all the reasons I mentioned earlier in the hour, I think that it's going to take a while for that to take effect.
Yeah. Can we talk about another bit of acquisition news here related to Berkshire Hathaway?
Oh,
no, it's not Warren Buffett buying like a $800 million.
Do we have breaking news, Toby? I haven't seen this.
We do. It broke about an hour ago.
Okay.
But it's not like a major Berkshire acquisition. So if that's what you expected when I said Berkshire Hathaway, calm down.
No, I'm moderating my expectations.
Simmer down. And it's not an official announcement. These are rumors. But it appears that Compass is in. This is reported by the Wall Street Journal in advanced talks to acquire the real estate business of Berkshire Hathaway. So this is Berkshire Hathaway Home Services. They've got about 820 offices across the country and another 270 franchises there. Berkshire Hathaway Home Services and Real Living are the brand names that you might be familiar with. I've seen Berkshire Hathaway signs around here for sure. A little over 5,000 employees, I believe. So it's the real estate brokerage business. No rumors, no news on what a potential price would be for this. They acquired this back in 2000, so they've owned it for a quarter of a century here. And Compass, do you follow Compass at all? I don't really.
I don't know that company very well, no.
Yeah, no.
Interesting, though. I'm trying to read about
so
this.
that's some interesting news. Normally when we talk about Berkshire, right? What are we talking about? We're talking about acquisitions, right? You rarely hear about divestitures from them, but we do have that in this case. And it's interesting, Rachel. So we got we'll see if this goes through. This would be a bit of a consolidation, right? Compass is a brokerage business, right? So we would have a consolidation, which means there's going to be an antitrust review here, I'm sure. I don't know how intense that will be. I just looked up here, but Compass had about 29,000 agents across the U.S. in 2023. Now that's agents, and the Berkshire unit has about 5,000, a little more than 5,000 employees. I'm assuming they're not all agents, right? Some are back office personnel and whatnot. So much smaller than Compass. I don't know how big. I don't have a good sense of that industry to know where they fall relatively. in terms of size. I don't know how intense antitrust scrutiny would be, but it's it'd be an interesting. It'd be probably a nice size deal, I would guess. Compass has grown through acquisition. I believe this would be one of their largest, at least recently, if this stuff going through. And they had about, in 2024, Compass had about a 4.5% market share in the U.S. This would obviously bump them up a little bit, but they're not like, we're not talking massive market share. It's a very fragmented industry, real estate brokerage. So we're going to keep our eye on that and see if we get official news out that this has leaked now.
Yeah,
I would expect some comment by Berkshire.
They cited people familiar with the matter.
Yeah, right. So maybe we get some announcement tonight or tomorrow morning before market close. Otherwise, I expect not much comment, if any at all, until at some point over the weekend before market open. I suspect Berkshire will say something before Monday morning if we don't hear something tonight or tomorrow. You typically don't let things go that long without some kind of comment when there are rumors out there. And we'll see. So maybe by tomorrow, maybe by Monday, we'll have some kind of news on this and see where that goes. So there you go. More the deals are happening, my friends.
Deal making is happening because
I like it. I love deal making. I can say now I like many of our members. I would like to see a deal that says Berkshire buys X company for a couple $100 billion.
Yeah, so you got me excited, Toby.
That'd be a massive deal. Well, no, I mean,
that's what I was thinking.
A couple $100 billion would be a massive deal. It's probably going to be substantially less than that, but
yeah.
I don't even know how much cash they have. Do you know that off the top of your head? I don't know why.
I'm not sure. So Compass is the largest residential real estate brokerage in the U.S. by sales volume.
And still only 4.5% market share.
Yeah.
So
and
that's
they
how fragmented it is.
Very, very fragmented. And their core revenue model, they collect a portion of commissions earned by agents when they facilitate real estate transactions. But they also have this major, technology platform. They have a very tech driven business that helps to simplify the home buying and selling process. They offer programs like Concierge, which helps sellers prepare their homes for sale by covering the costs of renovations and staging, as well as private exclusives, which allow sellers to list their homes privately and keep them off of third-party sites. And they operate in roughly 72 markets across the U.S. with 300 offices. So kind of that classic model, but very tech-driven to meet the demands of the modern age. I actually am curious about their financials because this is not a company I have followed as closely. And so looking at this, I'm very curious. How are they actually doing?
And, what did we see earlier this week, right? Redfin is being acquired. So there's some consolidation happening in this space. Is it driven directly by all the changes we've seen to the legal landscape with the NAR settlement? I don't think that's driving tons of this. Probably just coincidental, although maybe people are rethinking some things after that. But it is, it's interesting. See stuff happening in this industry, right?
I actually found some numbers because I was curious. So Compass, they reported back in February as well. So their Q4 revenue grew about 26% year over year. Organic revenue about 21% year over year. They grew their quarterly market share by 65 basis points to 5.06%, so about 5%, 5.1%. 122 million in operating cash flow in 2024, 150 million prior to the NAR related settlement, which is worth noting. They brought in free cash flow of about 27 million just in Q4. They also increased their principal agents by about 21% year over year when they finished out the year. They also closed about 50,411 total transactions just in Q4 2024. That was an increase of 24% year over year. So that's interesting. Gross transaction volume was 54 billion just in Q4. That was an increase of 29% year over year. And then their end-to-end proprietary technology platform that allows real estate agents to perform their primary workflows is significantly impacting sales volume in a positive way, as well as how transactions are managed. So they said title and escrow attach rates improved more than 800 basis points over the last 4 quarters. They also said that their industry's premier all-in-one client dashboard that helps connect buyers and sellers with their agent launched in its beta form in October 2024 and nationally just in early February. But even in the first week after launch, agents sent 14,950 invitations to clients and saw a 43% increase in client engagement as measured by a change in weekly active users. For their full year 2024, they're targeting free cash flow positivity. In Q1, they're looking to deliver revenue of 1.4 to 1.5 billion, roughly. Looking at their balance sheet. So they delivered a net loss they operated a net loss of about 155 million in the full year 2024. They finished out 2024 with cash and cash equivalents of about 224 million. Interesting.
Are you interested in this company? Is this one you want to look at more?
I want to look at it more. I don't like that they're operating in a net loss right now, and I'm curious how that's going to deepen with an acquisition. Right? Is the mathing?
Yeah. Well, as far as Berkshire is concerned, if your check clears, we're good to go, right?
Well, right. That's the thing. So I'm curious. I'm intrigued. We'll say I'm intrigued. I'm cautiously intrigued.
All right. Yeah.
Oh, well, there you go.
Nice. Ed had asked, Ed just a little bit ago, do you think that after the stopgap is passed, assuming it is passed, so avoiding government shutdown, that the markets would level out and regain some of the losses? I hope so, Ed. I think there's reason to believe maybe because, look, big picture, if we get a bill that avoids a shutdown, that eliminates some near-term uncertainty, right? Uncertainty is bad. Markets don't like uncertainty. So I would assume that stabilizes things a little bit, but I just wonder how much people are really paying attention to that versus, tariffs, right? That's what's in the news. So hopefully that would give a little bit of balance, a little bit of stability, but we'll see. I have no ability to predict this market. It's a little bit crazy.
There was
what do you want?
Well, there was a question that came in that I wanted to hit really quick that came in from I read asking about Crown Castle again. Is there much of a risk for loss of demand for cell towers due to an increase in satellite communications? So these are kind of 2 areas that sort of work hand in hand, but one doesn't, replace the other. So satellite communications are expanding, but broadly speaking, the demand for cell towers is probably not going to be significantly impacted by that. Satellite technology is more suited for extending coverage in hard to reach areas rather than replacing terrestrial networks. So for example, satellite to cell technology can extend coverage to areas where traditional cell towers are difficult or even really expensive to deploy, but it's not designed to replace traditional cell towers, particularly in densely populated areas. And there's also limitations of satellite technology. So satellite communications can face bandwidth limitations. There's latency and cost issues, and that can tend to make them less suitable for a lot of the high demand, low latency demands and needs that most users have. So we're seeing a demand for cell towers that is continued and growing. And there is also growing use cases for satellites. And as I mentioned, these can have a greater impact on rural areas where building out cell towers is costly and challenging. But even there, cell towers are likely to still remain important for certain services. So satellite communication has a lot of strengths in terms of extended coverage. They can offer temporary coverage support if there's terrestrial network failures, but there are limitations. They can travel long distances, satellite signals, but that can lead to higher latency, which is essentially a delay, as well as potentially lower bandwidth compared to terrestrial networks. There's still some technological challenges challenges there. There's some signal strength concerns. So cell towers still remain crucial. They provide wide area coverage, low latency. They're still really essential infrastructure for everyday communication and data usage. They're generally less expensive to deploy and maintain than satellite networks, which is also why they're often highly favored in densely populated areas. And they're designed to handle large volumes of traffic. So there can be a complementary approach for both satellite communications and cell tower, but it doesn't really replace the need for that.
All right. 3 minutes left. I kind of want to hit this question from a couple days ago, from Spiffy, with a caveat that I'm going to answer it a little bit differently because we can't give individualized advice here. But Spiffy says, "Good morning, fools." I hope you're watching now, Spiffy, because it's not morning, but that's fine. As someone who has no income outside their investments, is it a good approach to sell losers held 4+ years and buy higher conviction names? Again, we cannot give personalized advice, so we can't say yes, good, no, not good approach on this for you specifically or for anybody, right? So I can't give you that answer. What I can do is throw out some ideas about how to think about this, right? If your investments represent your income, that's how you're getting income. If that's where you are right now, so I live on my investments, I'm generating from my investments. One of the first questions I would ask myself in that scenario is, with respect to any specific investment, how is this helping me in terms of generating income? What is it doing for me? Now, it doesn't have to be a dividend stock, right? The answer could be, it's growing my portfolio. I'm getting growth out of it, which I will then later sell some shares, or maybe it turns into a different player or whatever, right? Because when you think about income, it's not just dividends, it's also its total return, which could include selling shares in the future, right, to generate that income. That's fine. Could include using options to generate income. That's fine too, right? But if you're in an income generation scenario, that's what you do for your portfolio. I think every investment has to have some, it has to play a role towards that goal, right? You have your goal, your investment should help you achieve that goal. We know what your goal is, income. So you ask yourself with these losers, how are they helping me achieve that goal? If the answer is they are not, I would suggest they are candidates for sells. Right? If you say they are not contributing anything to my goal, they should be candidates for sales. And whatever the goal might be, right? Even if, bigger picture, it doesn't have to be income. It should just be whatever your goals are, each investment should contribute in some way to achieving that, right? Now they could contribute there, right? Because if you look at losers and you're thinking about selling them, the cash you raise could be some income, right? So they could help you that way. So I might suggest to you, Spiffy, that if you look at those specific losers and say, as holdings in my portfolio, they are doing nothing to contribute towards my goal, maybe you turn them into contributing assets by selling them in that way. Something to think about, right? So I would just approach it that way. Think about your goal, force everything in your portfolio to work towards that goal as you're constructing it. And hopefully that helps you make a decision here. And with that, I think we're at time, Rachel.
I know.
We're up. That's the end
It
of
flew by.
It did. It flew by a lot. Berkshire, by the way, my friends, has $334 billion in cash as of the end of the last fiscal year. I don't know what that number is now. That is a record for them. So they could go hunting, and if this Compass deal goes through, maybe they have a little bit more to put to work at some point. So we remain, as always, watchers of Berkshire to see what they do with their cash. All right, we're going to have, we're joined by Will. I'm heading out. Will and Rachel are going to take you guys through the next hour. See you later.
Thanks so much, Toby. All right, fools, welcome to another hour of Fool24. I'm staying on. I'm joined by Will for this next hour. We're going to be talking consumer goods companies, some of which have reported earnings just today, some of which more recently. This is just broadly our theme for the hour. So if you guys have any questions about these companies that we're going to be talking about, or just general consumer goods stock questions, we will do our best to answer those. We'll also try to work through some of the questions that are here in the queue from the last few days. Will, how's it going?
I'm doing well. How are you?
Doing good. There's a few interesting companies that have been reporting in the last few days. We touched a little bit on Ulta in the last hour. We can definitely touch on it again in this one, as I'm sure, might have some additional thoughts to lend. I know Dollar General is another one. Another couple of companies I've been following, American Eagle Outfitters and Vera Bradley also reported. So these are kind of interesting businesses as we're looking at this space and we're kind of getting into the tail end of earnings season and seeing some of these stragglers come in with earnings. Will, what are, any of these companies that you've looked at today? We talked a bit, like I mentioned, about Ulta Beauty in the last hour. I'm curious, maybe if you had any thoughts on that or any other of these consumer goods stocks that have been reporting.
Yeah, with Ulta, I mean, it was a pretty lackluster report, quite frankly. I think investors were expecting lackluster though, because the stock is up more than 2% in after hours. There's a lot of factors. For one, they had a 53-week year and a 14-week quarter last year, whereas this one was 13 weeks. Hence the net sales decreased by about 2%. But that's, I guess, given that dynamic, that's not really too surprising. It's maybe not as much of a drop as that would imply. Net sales for the fiscal year were up 0.8%. And in terms of profits, the profits were up a bit, or actually down for the quarter, 393 million versus 394 million in the year ago quarter. A little bit more for the year, 1.2 billion, just over 1.2 billion for this year. Net income was just over 1.3 billion in the year before. So, again, there a lot. Seems like this business seems to be struggling. I think a lot of it's just that I was listening in a bit, and they said that the price increases were the reasons, basically the reasons for the slight improvement. So, it seems like a really lackluster business. I don't follow this one quite as closely, so I'm not sure as to why they're struggling. I know they're in all 50 states and not international, so they may have to look at an international strategy soon, or maybe go into smaller metros. But it just seems like this business is stagnated after growing so quickly over the last few years.
Yeah, it's been a tough time for this business for kind of a myriad of reasons. I mean, we obviously talk a lot about the impact of increased competition. That's particularly been the case in the prestige beauty segment. You've got more retailers like Sephora that are expanding their presence, e.l.f. There's multiple others as well. And there has been also a somewhat normalizing beauty market compared to some of the spending that we've seen there in recent years. This is partly, I think, a function of shifting consumer patterns as well. There's slower growth that comes as a function of that, and that has also put pressure on Ulta's operating margins, which have been narrowing for a while. And I think the company anticipates further pressure on their margins in the future. You see issues like high inflation, economic uncertainty impacting consumer spending. That's led to a pullback in discretionary purchases. At the same time, there are other businesses like Sephora, like e.l.f. that are still doing pretty well, e.l.f. especially, compared to where Ulta's at. And I think that's partly a function of Ulta's business model. I think it is a slightly older one that is designed for maybe a different type of consumer than we see today. Now, at the same time, Ulta has been working to expand its omni-channel presence. They do have a very loyal customer base. I think it's something like 85-90% or maybe more of their overall sales come from loyalty members. And that's been something that has been true for a while. They've definitely noted that they've been having more challenges as a business recently than anticipated. And I think that that's something that continues to be the case and probably will be the case, moving forward. Something as well that is worth noting is they had rolled out a new system last year that was designed to sort of transform their overall inner operations and unlock efficiencies. And they basically, Ulta migrated its stores to this new ERP platform but there were a lot of operational challenges that occurred as a result of that. And so that they had some major disruption, especially in Q2 and Q3. That's not necessarily something that we'll see being an issue as we move into the new year, but it did impact some of their operations in the middle of last year. Something I mentioned in the last hour and that I kind of hold to with this business is this is one I'm watching closely. I'm curious to see how they will operate under a new, leadership team. Dave Kimball, longtime CEO, retired from his role after 11 years, stepped down from the board, and Keisha Steelman took over as the new CEO of Ulta. And that at the time when that new CEO change was announced, the stock gained a bit, and there was, I think, some optimism from various analysts that this is, the right person for the job as they are, working on comeback plans for the business. I agree with you. This was a pretty lackluster Q4 and full year report. I think that the market seemed to be happy that they did beat what analysts have been projecting, lackluster though it was in terms of earnings and revenue, and they did slightly, raise their outlook as well. They are still a profitable business. They still have a pretty fair amount of cash on hand, even though profitability has fluctuated and dipped, and even though revenue growth is, single digits at best, they have still maintained that gap profitability. So I'll be very interested to see what kind of a turnaround, if any, I think the new management is able to undertake with this business in the coming quarters and year. I do think that if the current situation we're seeing in terms of the macro landscape and shifting consumer spending patterns continues, I think that that's inevitably going to impact all of these businesses across this sector. And obviously Ulta Beauty, which has been struggling more with growth recently anyway, could be hit the hardest. So something to bear in mind. This is a business I like. I don't currently own it. It's one I follow quite closely. And I'm really watching to see what their turnaround strategy looks like for myself personally before I invest in shares.
Makes sense. Just looking at Dollar General, that they reported this morning, the stock was up despite another relatively lackluster report. Q4 revenues 10.2 billion, up 5%. EPS was down. The reason for that is that they've been there was a lot of one-time charges. They're working, I guess, to right size their store count and close underperforming stores. So they invested in that, and that's why the earnings fell. But I don't know if that's going to matter longer term. But just the one-time charge. Outlook a little slower growth, 3.4 to 4.4%. If they beat that would probably be more or less in line with the Q4 performance. So 2024 revenue, or I'm sorry, for 2024 revenue for the year, 46 billion, again up 5%. And you had EPS of 5.11, but again you had that one-time charge affecting net income, so that's where they got hit. Same store sales were up about 1.2%. You have to understand with Dollar General, they pretty much serve, I guess, people you would describe as working poor, and this segment of society has been struggling, especially with all the inflation over the last few years. Despite that, the company has been able to grow. They're going to add 500 stores. This year. They have about 20,000 now. So this is still an expanding business. They also free cash flows were up significantly, 1.7 billion versus just under 700 million last year. There are some concerns though. Rising costs affecting customers. Possibly negative effects of higher tariffs, and when you're dealing with low price points such as the one Dollar General deals with, the tariffs are going to probably wreak havoc because a lot of these product prices are so low because they import them from countries that can manufacture much more cheaply. I don't think they'll be affected to say a Dollar Tree that is stuck to that $1.25 price point. Dollar Tree used to have a $1 price point, but that became too limiting. But when you limit yourself to a price point like that, there's not much you could sell. I remember being in a Dollar Tree where the shelves are a lot more bare. So, at some point you have to raise these prices, and that's going to probably have an effect on Dollar General as well as Dollar Tree, assuming these tariffs are more serious. So, and the industry itself has been struggling too. I mean, you might recall the Big Lots bankruptcy as well, and Dollar Tree has had headwinds with tariffs, and their Family Dollar acquisition, I think, was basically a failure. So I think of those, probably Dollar General is in the best shape of the three, but this is still a tough business, especially with their core consumer being so deeply affected by all these macro forces such as inflation and tariffs.
Yeah, well, it's interesting to note Ulta Beauty is one of the stocks making the biggest moves after hours today. Shares are up about 8% in after hours trading. Dollar General, I actually am curious to check and see how they're doing. They're up about half a percentage point.
Well, they reported this morning, so
yeah,
7% gain, I think, is what.
But 7% gain on the day. Yeah,
yeah,
that's pretty good. That's pretty good, especially from what we're seeing. Well, it's interesting to also think about how a company like this could fare if we had, into further macroeconomic difficulty. We are seeing, so many of these companies we've talked about the last few weeks as we've had our regular consumer earnings hours. So many of these companies' management is, I think, setting expectations for the coming quarters and certainly for the next fiscal year. There's almost always some kind of comment about the state of the consumer, how consumer appetite to spend is shifting. And I think that that's something that is reasonable to expect that will continue, for the near term. Now, looking at a company like Dollar General, they sell a wide variety of merchandise, right? So they do sell essential items, consumables like food, household items, and actually consumables, which are broadly speaking non-discretionary, account for the largest share of their sales. And that's been something that has been true for a long time. So items that are regularly used, like personal care products, cleaning supplies, food, that has been and continues to be the largest driver of Dollar General's sales and growth. And then they also sell seasonal items, home products, and apparel. And they are known for carrying products from national brands like Clorox, Procter & Gamble, Coca-Cola, Unilever, some of these ones, as well as their own private label brands. And even though, as you mentioned, there's been some shifting in their price strategy through the years, they're still broadly known for their low prices, which they've been able to achieve and maintain by pretty careful cost management. They've been very strategic as well about where they locate their stores. So Dollar General stores are often located in areas with limited access to larger retailers.
Yeah.
That can make them a more convenient option for customers. They've tended to also place stores in more rural areas and even in more economically vulnerable areas, which has enabled them to achieve higher customer traffic and sales. And again, by providing essential items for consumers at a much lower cost than one would find at a larger retailer. And so that's been really core, to their business model, prioritizing locations in smaller, underserved towns and communities, focusing on being a neighborhood staple, where you don't necessarily require large vehicles for shopping, but you can go and get your daily items that you need, whether it's food or otherwise. And they have a very lean operating model. They've been able to keep costs low, often by using smaller stores, having a very curated product range, and again, focusing on selling those everyday essentials. So consumables, basic items, milk, cereal, trash bags, then they have their own private label products that represent something like a quarter of their total merchandise. In terms of where they source their products, this is something I think that probably investors are thinking about a lot in the day and age of rapidly dynamic, evolving tariffs that we live in. But Dollar General sources products from a mix of domestic and international suppliers, including major manufacturers. They also produce, as I mentioned, their own private label brands. So they carry products from some of these massive companies like Coca-Cola, Unilever, Kimberly-Clark, General Mills. They've got their own private label brands. They have a global sourcing operation. They do have an office in Hong Kong that helps oversee exporting and importing products. But their distribution hubs and facilities are located all over the world. While they do work directly with manufacturers in countries like China and Mexico, they also have a pretty large manufacturer and supplier base in India, where they're able to produce low-cost items specifically designed for their dollar stores. So that's something to probably be aware of when looking at this business. One other thing I would note is during the recession in 2008 and 2009, Dollar General was a pretty resilient business. Their sales actually soared during that time. They saw same-store sales growth of about 9% in 2008, close to 10% in 2009. And again, that model that I described was something that was very effective then. I'm in no way saying that we are heading towards a similar period as that, but it is helpful to sometimes look at some of these businesses, particularly with the type of model that Dollar General has, which in some ways seems less relevant in a time of considerable economic growth and flourishing, but in a time where the consumer is strapped for cash, where the average consumer is spending less, and where some of these very discretionary focused cyclical businesses might struggle, a company like Dollar General does look a bit more intriguing.
Yeah, a lot of times analysts will call this the ultra discounts segment of the market. And like you said, they sell a lot of essentials. So even though the working poor is struggling, their sales are not going to go away. But the fact that they are struggling, means they might cut back a little bit. I don't know that might affect the dollar spent in the store, just because, but it might affect the amount of things they could buy. So it's kind of a difficult situation in that sense. But I think these stores really attract customers from higher end income groups in some cases too. I don't know if I'm higher end per se, but I'll shop at a Dollar General occasionally for certain things. So I mean, it does attract a wide following, and like you said, I think that what happened in 08, 09 kind of encouraged that, with some of these relatively wealthier consumers were forced to shop in a Dollar General to save money. So maybe some of those consumer patterns stuck with them as they became a little bit wealthier again.
Yeah. Well, and it's interesting, even though they saw a slight decrease in their gross profit rate, which was driven primarily by markdowns. And again, they had a greater proportion of sales coming from the consumables category. So that does weigh on their growth, because again, the average consumer is now focusing more and more on these non-discretionary purchases, but that still does give them resilience. So even though profitability and net income declined, although the company was still profitable for the year, that helped bump their net sales up 5% year over year to about 41 billion. And their same store sales, as you noted, increased about 1.4% year over year. And even though net income was down, they still reported net income of about 1.1 billion compared to about 1.7 billion a year ago. So there's sort of this correlation where the way their model is structured lends itself to resilience. But obviously, consumers are going to be focused more on lower cost and non-discretionary items, which can cut into the margins, but still seems to be giving this business some resilience. And they did also increase their cash flow from operations by 25% in 2024 to 3 billion, which I think is something that was notable as well. They've also been working on really being very efficient in terms of the stores they have in their portfolio. Another factor that impacted their operating profit, which was down about 30%, was charges of about 232 million associated with a store portfolio review in the fourth quarter, and some impairment charges they reported. So it seems to be, honestly, overall, looking at this business, a solid quarter, solid 12-month report. And given what we're seeing from other companies right now during earnings season, particularly in the consumer segment, it's understandable why the stock popped today. I think investors are probably taking a renewed interest in these types of businesses right now. Yeah, and you look at the PE ratio, it's only like 13 right now. Their dividend yield is about just over 3.1%, and the average for the S&P right now is 1.3%. So, this is not going to blow your socks off in terms of growth, but if you're a value investor, you're looking for a little income, this might be appealing at these levels. Yeah. Another company I wanted to talk about a little that I follow a bit is American Eagle Outfitters. This is a company that has been doing really well in recent years in terms of growing their sales and profitability. In terms of earnings, they just reported they actually beat on earnings from what analysts had been projecting. Even though, let's see, actually, let me refresh my page to see how shares are performing. Yeah, shares were down slightly today, up just a teeny bit after hours. But Q4 earnings beat, comparable sales rose 3% year over year. This is another situation where we have management warning about the habits of the consumer. So management said shoppers are pulling back on spending. They issued a mixed, holiday quarter results, which I'll dive into here in a minute. But again, they beat on the bottom line, which is always nice to see. They also posted comparable sales that were better than expected. Now, the CEO said as we're entering 2025, Q1 is off to a slower start than expected, reflecting less robust demand and colder weather. He said, we anticipate improvement as the spring season gets underway, but we're also taking proactive steps to strengthen the top line, manage inventory, and reduce expenses. He said, as we navigate through an uncertain consumer and operating landscape, we also remain focused on our long-term strategic priorities. This is one of many signs we've been seeing from management of these types of companies, as well as companies well outside of the retail sector, talking about how the consumer might be slowing down amidst persistent inflation, and obviously concerns around tariffs and the impact that will have on the wallet of the average consumer over the next couple of years and beyond. In terms of their actual financial results, so this was for their fiscal 2024 and Q4. They recorded Q4 comparable sales growth of 3%, operating income of about $142 million. Their Aerie division revenue reported comp growth of about 6%. American Eagle comp growth was right around 1%. Now, for the fiscal year, they delivered comparable sales growth of about 4%. That was record revenue as well, and they significantly expanded their profits in the 12-month period. They delivered GAAP operating income of about $427 million. Now, total net revenue was $5.3 billion for fiscal 2024. That was a 1% year-over-year increase, and that also included a roughly $60 million impact from having one fewer selling week in the fiscal year. Comparable sales from their Aerie brand increased 5% to 8% on 5% on 8% growth last year. So that was a slight deceleration there. And then again, GAAP operating income about $427 million for the 12-month period. They decreased their inventory by about 1% as they finished out the year. So they said inventory is healthy and well-positioned for the spring season. They also authorized 50 million shares for repurchase under their existing authorization a couple days ago. And that increased their total shares available for repurchase to 68.5 million shares through February 3rd, 2029. In terms of their outlook for the new year, for Q1 of their fiscal 2025, they're targeting an actual mid-single digit decline in revenue. They're also targeting that their gross margin will be down year over year, although they are expecting to deliver between 20 to 25 million in operating income. Now, looking at their full fiscal year 2025 outlook, they are also targeting a low single-digit decline in sales compared to fiscal 2024. They think that they're going to be able to bring in about 360 to 375 million in operating income, which would be down from the 427 million that they just reported. And they are also looking that their gross margin might also be down year over year. So they beat on analyst projections for 2024, profitable, comparable sales and revenue increased slightly. They decreased their inventory slightly, which is good as they're heading into a new year. But looking ahead for Q1 in fiscal 2025, they're looking at single-digit declines in revenue. They are expecting to still be profitable, but they are expecting that decline in revenue and changes in consumer shopping patterns to weigh on their bottom line. So this is, I think, a tale that we've been seeing from many of these types of businesses. It's not surprising. American Eagle, they have their own different brands of clothing and accessories. They primarily target the young adult demographic, both through physical stores and online channels. Their target audience is 15 to 25-year-olds. Their Aerie brand has been a really successful aspect of the business that has grown significantly and been a huge driver of their business over the last few years. They also have an activewear brand that they've been working on growing. They operate not just in the US, but also in Canada, Mexico, and then they have merchandise that's available in more than 30 countries through their network of licensed partners. They have a pretty robust e-commerce business as well that has been successful for them. I like this business. This is not one I'm currently would necessarily be an investor of given the environment that we're in, because it's not one that I already hold. There's probably other retail-centric businesses I'm more intrigued by. They did just declare their regular quarterly dividend of about 12.5 cents a share. The company has, I think, paid a dividend consistently for about a decade at this point. Because share prices have been reacting pretty weakly over the last year or so, that has pushed their dividend yield up quite a bit. So that dividend yield is about 4.5%, which is about, what is that? About 3 times more than the S&P 500 dividend
about
stock.
3 times. Yeah. That's
Yeah.
one thing I was noticing about this. And their PE
Yeah.
ratio too is down to 6.5, which I
Yeah.
know the stock price has taken a tumble since 2021. It was close to $40 a share in the middle of 2021. About 3.5 years later, give or take, maybe a little bit more than that, we're down to $11 a share. So it's kind of looking at their financials. They generated negative cash flow last year, or at least in the first 3 quarters. They have not published the statement of cash flows yet for Q4, but
Yeah. Need to find that.
the first 3 quarters of the year, they had very negative cash flow due to capex, and they still spent $73 million in the first 3 quarters of the year on the dividend. So that they're not going to be able to keep that up long term. So if things don't change, that dividend could be in trouble.
Yeah, I wouldn't personally be a buyer of this for its dividend. And I think you hit the nail on the head there. This is a business that has a lot of popularity with its target segment, but there are many companies in this space that are obviously going to be prone to changes in discretionary spending. But I think that there are other examples of businesses that are much better poised from a financial perspective. They have been really heavily focusing on their growth story, especially that Aerie brand. And you've seen that reflected in the uptick in their sales, as well as some of their improved profitability. But yeah, cash flow has fluctuated, profitability has fluctuated, and the stock has reflected that in the last few years, despite the fact that they've been growing comparable sales and working to be more efficient with their stores and the brands that they control. So this was one of the companies that reported today. I thought it was worth hitting. There's also very much the impact of tariffs for some of these businesses. American Eagle is certainly one that could be significantly impacted. They source just about 20% of their products from China. So they're expecting anywhere from a 5 million to 10 million hit from new duties in fiscal 2025, which would impact their gross margin. Now, given the scale of the business, 5 to 10 million may or may not weigh too heavily on their results yet. But of course, the cumulative effect of that could over time. It is worth noting that the finance chief on the call with analysts, which I've not yet had a chance to listen to, so I'm just reading some highlights from, said that the company is not planning on passing those costs on to the consumer, and they are working to get their China exposure down to under 10% by the end of the fiscal year. It's worth noting that in the 3 prior quarters, they had missed Wall Street sales expectations, but they have made a lot of strides, as we noted, in improving their profitability, even though sales growth has slowed. And, they issued numbers that were in line with analyst forecasts, but did not exceed them. This is a company that's also been working to remodel their existing fleet of stores. That's another factor that's weighed heavily on margins and profitability. So in fiscal 2024, they remodeled around 56 stores. And in the year ahead, they're planning to remodel between 90 and 100 as part of their 300 million CapEx guidance. So they're contending, like many of these other retailers, with an uncertain economic environment. There's obviously many other retailers that are reporting similar dynamics right now. They certainly have less exposure to China than some other brands. I think it's good that they commented on where they source their products from, that they are that they gave an actual number in terms of what they think the impact of those duties will be, and that they do not intend to pass that down to the consumer. But again, that will impact their margins. And they are also working to get that exposure down to the Chinese supplier market by under 10% by the close of this year. So lot to keep track of with this business. It's certainly one I'm following within the retail space.
Okay, well, we're at the bottom. We're actually a little bit past the bottom of the hour, so I'm going to touch on some of these questions. I guess these are probably left over from a couple of hours ago, but I'll touch on the one from Sadaf an hour ago. Does deglobalization or U.S. tariffs pose any risk to MELI, Mercado Libre? I wonder why is participating in the tariff sell-off. Well, I think it's participating in the tariff sell-off because it's just being caught up with all the other stocks going down. A lot of times you have these, broad-based sell-offs. Other stocks get dragged into it, whether they should or not. I think that's what's happening with Mercado Libre. If you know Mercado Libre, it operates in 18 Latin American countries, which are not the United States. For that reason, I expect a very minimal effect on Mercado Libre's performance. Now, they do own a warehouse in Texas that they use to bring goods into Mexico to serve the Mexico market on the e-commerce side. That very small part of the business can be affected. I don't really see many other, at least direct effects happening from tariffs. So if you're looking for a stock that's unaffected by tariffs, or at least relatively unaffected, I think Mercado Libre is an excellent choice in my opinion.
There was a question that had come in about 5 hours ago from Steve D asking about Pure Storage. So I wanted to hit that one. He was asking any opinions on the downturn of Pure Storage. So I actually want to look and make sure I have this right in terms of the stock's performance. So yeah, the stock is down about 4% over the last year, about 22% from the beginning of the year. And there's been a couple factors there. The market definitely reacted negatively to some elements of their recent results. Even though sales and earnings for Q4 and the full year actually beat what Wall Street had been targeting, the business has been dealing with declines in its gross margin, and that was something that investors do not seem to like. That gross margin was about 69% in the recent period, which was down from the 71.9% margin they posted in the prior quarter, and also down from the analyst estimate of about 73.7% gross margin. Now, I tend to think it's a little bit of an overreaction for this business personally. I like Pure Storage. For anyone that doesn't know this one, they develop and provide all flash data storage products and solutions. They offer hardware, software, and platform solutions to help businesses store, manage, and protect their data efficiently. So they specialize in all flash storage arrays, which are an alternative to traditional hard disk drives, as well as hybrid disk and flash systems. They offer storage as a service products, software and platform solutions to help clients manage and utilize their data more effectively. They also have solutions that are specifically designed and tailored for addressing AI workloads. They have been building and providing what is called AI-ready infrastructure, which is a full stack solution that's designed to simplify AI infrastructure, accelerate AI pipelines for their clients. They could be the solution can be deployed quickly, managed very easily. It offers a much higher capacity with a much smaller physical footprint. And they have also related solutions called Gen AI pods. And this essentially enables the acceleration and deployment of different AI applications, particularly generative AI applications. And Pure Storage actually has a long-standing partnership with NVIDIA in this area. So they make money from both hardware and software sales. As I mentioned, they've been increasingly focused on AI-related solutions, including data storage solutions that are specifically optimized for AI workloads. Even though their gross margin did decline slightly in their recent financial report, it's worth noting their full year revenue was up about 12% year over year to about $3.2 billion. They did report operating income of under GAAP of about $85 million. They reported full year operating cash flow of about $753 million, as well as free cash flow of $526 million. Their subscription services revenue grew 22% year over year. I still think this is a business that has a lot of opportunity in their space. They are a leader in the flash storage market, and their continued expansion as there's growing use cases and needs for the products they provide, particularly with the growth of generative AI and other AI applications, has been really integral. They also surpassed $3 billion in total revenue in their last fiscal year for the first time in the company's history. And again, their operating profit improved significantly. So I think the reaction from the market has been, I think it's been a bit of an overreaction. I still like this business for the long term, but those are some things to be aware of if you're following or curious about this business.
Yeah, so there's just one more Mercado Libre question I wanted to address because it touches on a different issue that's been on our minds: inflation, or in Mercado Libre's case, hyperinflation, which I assume is Argentina, which has had a hyperinflation problem. They might be getting it under control now, but it's been definitely an issue for several years now. Sadaf asks, I have heard that Mercado Libre is addressing hyperinflation by investing in lands, etc. Is there any way to assess that the value of those investments are sound? The short answer is I don't know. I mean, I'm not really sure about the disclosure rules with regard to that. They may not be required to disclose what properties they own at all. After all, they are foreign. They're not a REIT. I'm not an expert on the rules, so I haven't really seen that part. I know they are investing in some treasury bonds to help their customers deal with hyperinflation. The thing with real estate is investors often turn to it as an inflation hedge because you can't print any more real estate. So if the value of a currency is falling rather quickly, that should presumably mean that the value of real estate is going up in nominal dollar or Argentine peso or whatever currency you're talking about in terms of those. So I think real estate investments are in general a great hedge against that. So I didn't know that, to be quite honest, but if they're doing it, I think that's sound. I'm not of course some real estate investments are better than others, but in a hyperinflationary environment, I would think that those land prices are still going to go up.
There was a question that came in that I also wanted to hit. Let me just grab that right now. About 5 hours ago from James, saying thoughts on Pinterest, ticker PINS, and Team, which is the ticker for Atlassian. So I follow Pinterest a little bit more closely than Atlassian, but I do follow both these companies, so I wanted to hit this one. I really like Pinterest. This is a company I've reported on a lot the last few years amidst their really changing growth trajectory where they had this significant uptick in growth during the pandemic. User growth was exponential. And then there was a real deceleration there for the business, partly due to normalization from pandemic trends. And I think also the fact that this was a business that reached a much more significant level of maturity in their growth story than perhaps they would have if not for the exceptional growth that they experienced during the pandemic. Now, and especially in recent quarters, Pinterest has been doing a really great job of growing their user base, getting back to solid growth there, improving their profitability, and also doing a really good job of monetizing the users that they have. It's worth noting a huge market area for them is outside of the US, and that is where they continue to see one of the fastest rates of growth, and that's a tremendous opportunity for them. Pinterest derives essentially all of its revenue through advertising. They are an advertising platform for businesses of all sizes across a range of industries. Another reason why the company had been struggling a bit in the last few years is there have been major shifts in advertising spend amidst a very fluctuating economic environment. Advertisers have been more reticent to put money to work, and the cost of running ads has been, something that has been very much factored into CapEx for these businesses, and that they've been much more cautious with. Something Pinterest has been doing is really focusing on delivering exceptional ad results for these businesses at a lower cost. That's something that they have been able to do really effectively. And that has also trickled down to major improvements in their revenue. So they've been working on increasing user engagement and actionable content. So they're seeing more users come to their platform. These users are engaging more actively, and there's been a notable increase in clicks to advertisers. And this is partly because of Pinterest's ability to deliver relevant and actionable content as they've integrated artificial intelligence tools into their platform. They've also been prioritizing advertising tools that drive users towards the purchase phase rather than just looking for inspiration on Pinterest. And this lower funnel focus has been driving really good results for users, as well as in advertiser and advertising money growth. And they've also been working on actively integrating more shoppable features and content into the pins that are on their platform, which makes it easier for users to discover and actually purchase products directly from the platform rather than going through a series of clicks and phases before they find something that's inspiration, click on it, and then get to the actual product or service that they can purchase. Their use of AI has really been something that has provided them with a much more personalized user experience and has helped them improve their advertiser returns. In terms of how the business is doing, revenue was about $3.6 billion for 2024. That was a 19% year-over-year increase. Their global monthly active users increased about 11% year-over-year to 553 million. GAAP net income was about $1.8 billion just for the final quarter of 2024. And that was a notable improvement for them. Most of their profitability was generated in the final stretch of 2024 as they've been working to turn around from a series of net losses over the last few years. They also delivered a free cash flow of about $940 million in 2024. That was a 55% year-over-year improvement. In terms of like where their revenue comes from, so globally they delivered total revenue of about $3.6 billion last year. About $2.8 billion of that came from the US and Canada, $593 million from Europe, about $169 million from the rest of the world. That being the case, though, most of their users are actually located outside of the US. So even though most of their revenue comes from North American users, most of their users are concentrated in Europe and the regions that they label the rest of the world on their financial reporting. So I think something to be aware of with this business is they are prone to fluctuations in ad spend. So if ad spending declines, that will inevitably impact their business. I think they've done a really good job of adjusting to that rapidly changing environment over the last few years, and their move towards more consistent profitability, I think, has been really promising. But that's something to be aware of there. Atlassian has been struggling because they are dealing with continued unprofitability despite the fact they're growing revenue. And that largely goes back to the fact that they are continuing to really prioritize growth and reinvesting their profits, having very high expenses in sales marketing rather than focusing on near-term profitability. Atlassian's investor presentations do often focus on free cash flow as well, rather than net profits or GAAP profits. They tend to view free cash flow as a more accurate measure of the company's financial health. That is certainly an important metric for businesses like Atlassian. So that is worth noting, but it's not the only one. So this has been a company that's been a strong revenue grower, but their losses have continued to extend, particularly over the last 5 years. There has also been some changing sentiment around the company as they announced that their co-founder would be stepping down from his position as co-CEO. Then they had a chief sales officer that's also been announced that he was leaving the company. So some leadership changes, continued on profitability. The market hates uncertainty, as we know. This is a company that continues to invest in their growth rather than net profits, and that's something that has been a continued reality for this business for a while. Their revenue grew about 21% year over year, in the recent quarter. Again, they do have a nice history of growing cash flows, but under GAAP, they are still unprofitable. So there, I think, is a shift that we've seen in prior periods of market unrest, where investors seem to be more hesitant to invest in companies that are still, these big unprofitable software businesses. They did deliver about $343 million in free cash flow, though, in their recent quarter. So that's worth noting. But those are kind of some of the factors that play with that one.
Yeah, so I wanted to get to this question from Hit Player a couple of hours ago. True or false, PayPal will rise from the ashes? That's a good question. I don't, maybe rise from the ashes is a little bit dramatic. I have very mixed feelings about PayPal. I don't hate it per se, but it's acting a lot like a mature business, despite having a market cap of, let's see, where's that? The market cap is around, it's like 66 billion. Yeah, I think they grew by about 3 or 4%. Let me see what they grew. They grew net revenues increased 4% in the fourth quarter, 7% for the year. It's starting to act increasingly like a mature business. Looking at its PE ratio, it's trading at about 17 times earnings, or about 13 times forward earnings. It may be a little bit oversold at that level. I do think, though, it's kind of cheap for a reason. I don't really expect this to be a fast-growing company. I suppose it will rise from these levels. If you're looking for a fast growth stock, I don't think it's PayPal. I personally, in my fintech investments, I've been investing in the developing world mostly. I watched Danny and Jason a couple of hours ago interviews someone who used to work at Mercado Libre and New Holdings. Those are two stocks I own that are heavily into Latin American fintech. There you're dealing with a lot of customers who are all cash. So I think there's a lot more potential for transformation, bringing those kind of customers into the financial system, than there is giving customers new ways to pay. And of course, they'll find new innovations, and maybe some of those will yield value for investors. But I think there's a lot more to accomplish in the developing world. So that's where I'm investing in fintech personally.
I'm going way back in the queue. Some of these questions that have been here a while that may have been targeted to prior hosts, but if we can answer them, we do. Tom had asked if anyone followed ticker CASY, which is the ticker for Casey's General Stores. The viewer was asking thoughts going forward after reported earnings on Tuesday. So Casey's General Stores, they are a chain of convenience stores that is primarily concentrated, I believe, in the Midwest, but they offer a variety of food, fuel, and general merchandise. They're known for their fresh prepared foods like pizza and donuts. And they currently have a presence, I believe, in about 20 states. So they have a network of convenience stores. They sell gasoline and diesel fuel. They're also known for their pizzas, donuts, and other freshly prepared items. And then they carry other retail products like snacks and beverages. They have long focused their business model on being a community staple. A large number of their stores are located in smaller towns and rural areas. They're also known for their pizzas, including thin crust, specialty pizzas. They even have a cauliflower crust pizza, I've heard. They've grown significantly over the years. They actually had a major acquisition that they closed last year, which was their largest acquisition to date. They acquired the chain of Fikes Wholesale CEFCO convenience stores. That was a multi-billion-dollar acquisition that significantly expanded their presence in Texas, as well as other southern markets. It was an all-cash $1.145 billion acquisition. And that also included the acquisition of Fikes' dealer network, a fuel terminal, as well as a commissary to support a lot of these stores that are located in Texas. So their revenue breakdown, most of their revenue comes from fuel sales, but a significant portion of their profits come from sales of prepared foods, dispensed beverages, and groceries. And that accounts for a large percentage of total gross profit. For fuel sales is a major driver of the top line. These consumable items are a major driver of the bottom line. And their focus on being that kind of one-stop shop for fuel, food, and convenience items that are affordable, quality, providing that community-focused retail experience is something that has been very successful for the business. And you could also see how that model could be particularly attractive to consumers if we find ourselves in a situation where economic conditions worsen. So their most recent report was for their third quarter of their fiscal year. It was not a full year of results. But looking at that Q3, they reported net income of about, I believe, let me see if I've got this right, 87 million. And that was compared to about similarly flat year over year, about 86.9 million 1 year ago. So net income was 87 million, flat with the prior year. EBITDA was 242.4 million. That was up 11.4% from the same period a year ago. So they're still profitable. That metric was just flat year over year, although adjusted EBITDA grew double digits. Inside same store sales increased 3.7% in Q3 compared to the prior year and 8% on a 2-year stack basis. They had an inside margin of about 40.9%. Management also noted that their total inside gross profit increased 14.3% compared to the prior year to 573 million. Now, same-store fuel gallons, that was up 1.8% compared to the prior year, and their total fuel gross profit increased 17.4% to 302 million compared to the prior year. That management also said that total fuel gallons sold were up 20.4%, while total inside sales rose 15.3%, primarily due to unit growth, including that Fikes acquisition that I mentioned earlier. In terms of breaking it down by source, so again, overall inside sales were about 4.3 billion in the first 9 months of their fiscal year. Their inside same store sales in that first 9 months of their fiscal year were up about 3.1%. Grocery and general merchandise same store sales were up about 2.6%. Prepared food and dispensed beverage same-store sales were up about 4.4%. Again, that was in the first 9 months of their fiscal year compared to 1 year ago. So this is a solid business. I like this one. This is not a growth-heavy stock, right? This is not a company that probably anyone looks at as a growth investor. It is worth noting shares are down year to date, but the stock is actually up about 30% over the last year. They have a market cap of about 14 billion, trading at a price to earnings ratio of about 27. This is, I believe, also a company that pays a dividend, although their yield is quite on the low end. It's less than 1%. So this is, if you want to invest in convenience store chains, this is certainly perhaps a company that I would be looking at. That's not really a space that I personally have cash into right now, but it was a solid quarter, a solid first 9 months of their fiscal year. Again, that correlation we see between in-store sales and fuel sales and the growth you're seeing from both of those segments, which is trickling down to solid sales growth as well as continued profitability. This is a resilient business that largely benefits from non-discretionary purchases. So that could give them some additional resilience, in the coming months and years. This is a massive business.
Yeah, I don't know if you want to invest in convenience stores. I'm not really sure there's any really great choices. I think 7-Eleven is owned by a Japanese company.
Yeah.
Pilot is owned by Berkshire Hathaway. There's a lot of excitement about Buc-ee's, which was started in Texas, is all over the Southeast and in the Mountain West a little bit now. They're still private, so it's this. I think you don't really have any other choices if you want to be in this sector, in my opinion.
Yeah, it's kind of like when we were talking about Dollar General earlier. There's a real resilience in this particular category of retail. They're just not the fastest growing or perhaps the most exciting stocks, probably not for every investor. Not personally something I've been interested in with my investing journey, but from just a business perspective, this is a pretty solid one.
Yes. So speaking of investors that aren't for everyone, I have one about Walmart, symbol WMT. What do you think of China balking at Walmart asking to suppliers to reduce costs by up to 20% on some goods? Will this affect the Walmart stock price? I think this touches on a lesson, I think, when you're dealing with very large companies like Walmart. Walmart is into so many things. They're into so many markets. I was doing a little research. China is just under 20% of its international sales. International sales were just over a quarter of Walmart's overall sales. So we're talking 5% of the business when we're talking about China. The short answer is I don't think this will affect the stock price much. Will they succeed in getting those costs down? Maybe, maybe not. I know that was a focus on Walmart years ago, where there was a lot of pressure on suppliers, and suppliers were starting to balk, and their customers were starting to balk too, because it took the quality so low that they shifted to other customers were shifting to other retailers to find the quality of goods that they wanted. So I think China is so small. This is such a small part of China, the Chinese sales. I don't see it having a big impact, but it is something you have to watch out for, because you talk about, for example, Alphabet, the Google parent. Well, for example, I wanted to invest in Waymo, their autonomous vehicle division. However, Waymo is such a small part of the company that does not show up in the financials. I ultimately ended up buying Uber, because Uber is one of their major partners for autonomous. So a lot of times, especially when you're dealing with these large companies, small things like that probably aren't going to affect the stock price too much. Unfortunately, in my case with Waymo and Alphabet, that seems to be the case there too.
Yeah. Walmart's one that I follow quite closely in this space. And I think it's one that I liked their recent earnings report. And I felt like, in my opinion, the market really overreacted to what management was saying, which was, if anything, just trying to moderate expectations, while still, broadly speaking, expecting similar growth to what they've seen. They're still seeing really robust growth in their digital sales. They're continuing to grow their advertising business, which is still a smaller part of their overall growth story, but still a really fast growing part of the business. So I like this one over the long term. I think that they are doing well, and I think that the fact that they make something like 60 or 70% of their overall sales from grocery sales, I think that gives them a lot more resilience in this space than, say, a company like Target, which has been struggling quite a bit recently.
Yeah, I agree. They've really improved their business over the last few years, especially on the e-commerce and omni-channel side. So I like them better than I used to, but I guess they still are squeezing suppliers a bit, which I personally think hurt their reputation. So we have about 2 minutes left. I wanted to touch on this question from Kent before we end our hour. Will, you had mentioned earlier today that you had purchased AMD, symbol AMD, recently. Could you share how you made your decision? Well, it's pretty simple, because I've been following this for a long time. I bought AMD at pretty much the bottom of the 2022 bear market. It went from roughly the 70s in my case to, I think it almost got to 230 last March. It has since pulled back. It's now below 100. I took a relatively small position when I bought back in 2022. I saw this as a great entry point. That the forward PE ratio had fallen to, I think, around 20 or 21. For a growth company, that's extremely cheap. Now for a slow growth company, say a Dollar General, that may not be so impressive. But when you have a low PE ratio with that, along with high growth, that usually is an indication that you could, at least you have a good shot at making some long-term returns. For that reason, I increased my stake in AMD.
Yeah, there was a question I want to hit really quick. We have like a minute left. This was a question that came in about 8 hours ago, asking about Fulgent Genetics. So I wanted to answer that really fast before we switch over. But Fulgent Genetics, they have been dealing with a business that was heavily reliant on COVID-19 testing revenue a few years ago. Obviously, as demand for that has, waned significantly, that has also, impacted the business. They do have a more diversified business at this point. They're known for their clinical diagnostic business. They provide molecular diagnostic testing services. that analyze DNA, RNA, and proteins. They have a pretty comprehensive genetic testing group of diagnostics as well that they offer. And this is a business that has been seeing more improvements in their growth recently. When they reported their results at the end of February, their total revenue was about $283.5 million. Their core revenue grew about 7% year over year. They had a fair amount of cash on their balance sheet, but they're still operating at a net loss. They've been burning through some cash, although they delivered cash from operations of about $21 million in the year. For me, this is a business that needs to be more diversified in terms of their offerings, and I think was too heavily reliant on COVID testing and has been really struggling to recover since that time. So it's one I'm watching, but it's not one I'm a buyer of right now.
Okay, it looks like we're at the top of the hour right now, so I'm going to make my way out of here as soon as Danny makes its appearance. So
yes,
it's good being with you, spending time with you, Rachel, and
likewise.
Another hour, so we'll be on a lot next week. So I look forward to that.
Looking forward to it, Will. Thanks.
Thank you.
All right, fools. Well, you're stuck with me for one more hour, and then I promise I'll leave. And Danny's back for this hour.
Okay. They'll get me